If everyone could please start making their way to the main stage, the opening remarks will be made in the next 5 minutes. Good morning, ladies and gentlemen. The market stage is about to begin in 2 minutes. and welcome to CCData's Digital Asset Summit 2023. We'd like to say thank you to LMAX and all of our supporters, and of course to you all for being here today. Just a few points on housekeeping. So there aren't any planned fire alarms, but if you do hear one, then you should run. That was a joke. You should actually just go to convene at the muster points, and there will be signage in the event of that happening. Now, on to the order of today. So my name is Katie Evans, and I work at Swarm. Swarm is a regulated DeFi platform for institutional investors, and we're focused on the issuance and trading of tokenized securities. Why am I telling you this? Well, a lot of what I just said, regulation, institutional adoption, and tokenization is going to feature in today's events. And I'm going to be guiding you through a very carefully curated agenda, which has been expertly put together by the fantastic team at CCData. So on to the order of business. So our keynote this year is going to be delivered by the Lord Mayor-elect. So the Lord Mayor position is responsible, or one of their roles is responsible for promoting the financial responsibilities and freedoms of the City of London and our agenda, financial agenda, if you will. So I think it's quite reassuring to know that the Lord Mayor-elect actually wrote his own blockchain, created his own blockchain back in 1995. So without further ado, please help me in welcoming Michael Mainelli to the stage.
Good morning, everybody, and welcome to CCData's Digital Asset Summit. I'd like to thank Charlie and the team for starting this off, and also for Katie. I've been here a few times, but I've never been here as Lord Mayor-elect, and it really is a delight to welcome you into the city, and I'm pleased that this is happening in the city. Many of you, despite having worked in finance and using the moniker the city, may not be using it quite the way I do. I'm describing specifically the City of London, and that is the square mile, 1.2 square miles actually, which isn't square, inside the old Roman walls for the most part. And as you know, that's about 600,000 workers generating just around 10% of GDP and around 13% of tax. Ask yourself what the other 30 million do all day. You know, it's an interesting zone and an interesting area, and I'm very proud to be part of it. It is, in fact, the world's oldest continuous workers and residents democratic cooperative. That's really what it is. We've been having elections since 640, and I'm very pleased to have been elected Lord Mayor last Friday, and I will be taking office on the 10th of November. And of course, the world's oldest procession is the Lord Mayor show. So please come on the 11th of November and celebrate. It's free, it's fun. You know, grab your local 10-year-olds and take them along with you. Now, clearly the city has been seen to be a financial center, but actually that's fairly recent. I came into the city in 1984, just as things were starting to change. The very first proper investment, it was in 1986, when in Deptford, City set up its FX processing units and derivatives processing. So it's actually quite recent, and that's largely because between 1939 and 1986, with Big Bang, pretty much the only international market where people would come to London for anything other than Commonwealth business was the Eurodollar market, and that was actually run by the Italians from the 60s. So this idea that it's only about finance is a bit of a misnomer. In fact, London is the home to science and technology. Gresham College spawned the Royal Society, and we have, by the way, just to give you some flavor here, within about 2 miles of here, we have 40 learned societies, 70 research institutes, and 70 universities and 130 research institutes. So one forgets sometimes the scale of it. And amongst our 600,000 workers, we've got 100,000 people in finance. That's 45,000 in insurance, 55,000 in banking. We have 225,000 scientists, engineers, and technicians. 8,000 of the 24,000 businesses in the city are science and engineering businesses. So what we're seeing, and I think what today exemplifies, is the idea that tech and finance are combining. We've been talking about it in embedded finance for some time. We're now evolving words like DeFi and TradFi as we're beginning to see that these areas are really about problem solving. And that's what I'd like us to focus on. I'd also point out that much of what you're discussing today, we discussed in the 80s. I remember in 84 discussing gold certificates and how we were going to put them on a database, and that was actually part of the reason that we were looking at decentralized ledgers for those purposes, ledgers that wouldn't allow people to cheat. We had, believe it or not, we actually had smart contracts. I wrote a contract for Lehman Brothers in 86. We put it on a spreadsheet. That was 1, 2, 3, by the way. Put it on Lotus spreadsheet. And we wrote the contract, and the contract basically said to the lawyer, open the safe once a month. He'd open the safe. We would then do a checksum. For those of you who are young, that's called a hash. And we would do a checksum on the contract to prove that the spreadsheet program was the one that was listed on the contract. We would plug in some numbers from the FT, and hey presto, somebody owes somebody else X amount for a swap. So a lot of this stuff is actually inordinately old. And whilst I do like to make fun of the crypto mob, because I call that kind of gambling tokens, my current favorite joke is, how many Bitcoin miners does it take to change a light bulb? 1 million. One to do it and the rest to verify he's done it. So you see that, but one has to give the crypto crowd credit. They've created a new way of motivating people, and that is kind of exciting. And all the research and the money that's pouring into this is to some degree done because of this, what I consider to be a bubble. Maybe I'm wrong, but the point is all of us in the finance and technical area are benefiting from the fact that the world seems to be in a new phase of investment into getting our monetary systems to work. And I've always defined money as a technology. Money is a technology that communities use to trade debts across space and time. And that technology can be tally sticks, that technology can be pieces of paper, but these are actually decentralized ledgers that have been around for thousands of years. Tally sticks, I'm sure you're familiar with, destroyed the Houses of Parliament. They were so popular in Britain that when they finally got rid of them in 1843, it burned the Houses of Parliament down. But that definition of community is an important one, because that's what I see as the city doing. The city to me has always been 3 words: commerce, community, and charity. So we're here to trade, we're here to create wealth. Secondly, it's about community. We want to build a better world. We in the city, we spend that on better business environment and regulation, et cetera, also on a better physical environment. And then very much about charity, and that's probably an area where I think sometimes our sector needs a little bit more work. Now today you're going to be covering a whole variety of issues, but I might give you just a small pointer, and that's it. If I were in the audience, I'd be wondering a little bit more about the ethics of what we're doing. That sounds like a strange thing to raise, but I believe that we are facing a few problems in areas, particularly privacy. A lot of the systems that we're doing are systems that are going to cause genuine privacy issues. We do this as technologists. It's great technology, look what I can do, but we don't spend enough time on the ethics. Fairness, how fair are some of these systems? And again, those of us in finance rely on competition to be fair. It must be fair because it's competitive, so but actually is that true? And finally, and we're going to see much more of this, and I think this has hampered our sector for a while, explicability. People, for some reason that probably nobody here in the room would be different than me, you raise the word derivative and suddenly they go, ugh. You raise the word blockchain, they go, ugh. You raise the word money and they can't define it. For some reason, there are segments of mankind, but it's our obligation to explain that to them, and we need to find ways of simplifying it. Finally, I would just turn to, in ethics, artificial intelligence. Again, I hate that word. To me, it's machine learning, but we'll let them go with it. And one of the things we are doing right now is we have launched a 695th Lord Mayor's, guess who's the 695th? Lord Mayor's Ethical Artificial Intelligence Initiative. We've done that with the Chartered Institute for Securities and Investment. We opened the doors for students last month, and there's still time to become a student. It's an onerous course. It'll take you about 12 hours online, and it's very expensive. It's about 150 quid. And we've got people signed up already from Citigroup, London Metal Exchange, many of the crypto people, many of the DeFi people. It's a big group of people, the students who signed up. The CISI is awarding a decent certificate for it, and you can take that course. And I'm trying to do that so that we are showing the world that we in finance have seen what's going on in the AI space. We can understand the ethical implications, and we're doing what we can about it, which will be to train you up on the ISO standards that already exist. People on Radio 4 do get my goat a bit with the kind of, nobody ever thought about the ethics of AI, and I'm kind of, well, Isaac Asimov in the 1940s wrote everything about iRobots, so I think that's 80 years ago. I think we've been thinking about this for a while. Nobody's thought about standards. Well, there are actually 3 standards on AI, and they're ISO standards. Any of you who've been in the ISO field will know that they don't just pop out of the woodwork because Rishi Sunak discovers AI. And one of those standards is on, guess what, the ethics of AI. So we're just trying to deploy those quickly, get people up to speed on it. And if you wanted to sign up and join that, I'll rattle it off, www.cisi.org/AI, charteredsecuriesinvestment.org/AI, and sign up, or have one of your development teams sign up, get a flavor for it. Well, look, to conclude, it's going to be a great day. I can only say I'm delighted that CCData is doing this. I've been to one before, as I said. I've always had a good time here, and it's all about learning and connecting, and that is very much, if you look me up, you'll find that is my theme, connect to prosper. And so I hope that today you all built some wonderful connections, and I hope to be in touch with you over the next year. Thank you very much.
Thank you, Michael. And it looks like we're all invited to a free party on November 10th, so I'll see you all there. Okay, so just to let you know that the Vault stage is now open and you can access it through doors towards the back. Their first panel is actually going to focus on quite an interesting topic. It's the challenges around building liquidity for digital assets, which probably a lot of you know that they're very real issues. So on this stage, we're going to focus on the past, the present, and the future of digital assets. It's quite a nice scene-setting moment for the rest of the conference. And I think in current market conditions being quite so tough, I think all of you sat in this room should be very proud of yourselves that you are still committed to the value that blockchain technology can bring, or you're still on the fence about hopping on the AI bandwagon. So we'll figure out by the end of today which camp you're fully in. I would like to ask the panelists if they could come and join the stage. As they do, I'm going to read out who they are, and a lot of them have been involved in many of the boom and bust cycles of crypto over the years. So welcoming to the stage, we have Dan from Bitcoin Educator, Oliver from BCB Group, Nicholas at Chronicle Labs, Michael at Bullish, and this will be expertly moderated by Anna Herrera, who is currently a writer at Bloomberg. Please welcome them to the stage.
All right. Good morning, everyone. Thanks for joining us. So I'm going to start off by asking you guys to introduce yourselves. Do you want to start, Dan?
Sure, I'm Dan Held. I've been in the crypto space for about 10 years. People might know me for my content about Bitcoin or my last corporate role where I led marketing at Kraken.
Hi, everyone. I'm Michael, Senior Vice President, Global Head of Sales for Bullish, based in Hong Kong. Been in the space since early 2020, when we were just a small startup building what is now an institutional exchange called Bullish.
Hi, my name is Nicholas Kunkel. I'm the founder of Chronicle Protocol, which is the Oracle protocol that secures over $8 billion of TVL in DeFi. And my background is being part of the founding team of MakerDAO back in 2016 until we founded Chronicle about a year and a half ago.
And I'm Oliver von Landsberg-Sadi, the founder and CEO of BCB Group. My background is in investment banking. And my mission is to make sure that every legit crypto business in the world gets a bank account that doesn't go away.
All right, so we have a very, very broad topic. I'm going to start with the past. I'm going to ask you guys to vent a bit. How has the past year been? Are you fine? Like from 1 to 10?
The past year, I mean, I've been around a long time, so I've seen all the way all the way back to the 2013 cycle where we had the Mt. Gox collapse. At the time, Mt. Gox represented 90% of all trading volume. I mean, I think people forget how devastating that was. That was pretty dismal. Also, crypto was considered just money for drug dealers and money launderers. Crypto is not well respected. There's no institutions in the space. There's very little content. Other than a few prominent individuals like the Winklevi, no one really cared. I think when we look at the last year or two, crypto has really evolved over this time to become a very mature, and in my perspective, quite mature where it came, from where it came from. So I think we've seen institutions validate it. We've got a lot of enthusiasm with the Bitcoin ETF. That's huge news, including big institutions like BlackRock coming in with that. So I think while we're in a bear market, we've never been in a better place, I think, in terms of visibility and credibility in the space.
Michael, how's it been for you? Because we don't have a 90% concentration, but we do still have around a 60%, which is quite big for a market, right?
I'd say if you were to say 0 to 10, 7 maybe. I mean, it's been a tough year for exchanges and just lack of volumes, lack of volatility. There's a lot of, I think, kind of sentiment from I guess the group around just kind of regulatory scrutiny happening out in the US. But in Hong Kong, where I'm based, actually it's been quite exciting. Things have actually kind of turned 180 since last year. And so there's been kind of like a certain amount of positivity that's coming through from that side of things. For us as a business, it's also been one where the narrative has kind of been, I guess, kind of pulling forward a future where we felt having trusted counterparties is quite important for that next stage of adoption. And so that's really helped us in terms of the way that we've been thinking about continuing to go to market, because we're just approaching the 2-year mark, so we're still relatively new to the scene.
7's not bad, I guess. And Nicholas?
I think it's been quite a positive year, actually. If we reflect on, I think we called it the boom bust nature of this industry. The downs aren't as extreme anymore, right? They're much more buffered through every cycle that we go through, right? I mean, Dan, you mentioned the Mt. Gox hack, right? We can talk about the DAO, right? Hack as well, right? Where we're talking about an extremely large magnitude of the entire ETH supply, right? And an entire chain getting forked, right? And what we're dealing with now it seems more like a hiccup, right? You kind of have global markets going risk off, right? And that includes venture funding, and that has kind of caused, especially the B2C dApps, to kind of struggle a little bit. But in order to kind of fill that vacuum, you've kind of seen the chains step in, right? So the chains were able to raise a lot of capital in the last cycle, right? And they have very, very deep token treasuries. And they're highly incentivized, right, to grow ecosystems on their respective chains. And so they've kind of stepped in to fill the void left by venture capital firms, right, to fund those ecosystems. And so I think there's a kind of a asymmetry between maybe what the narrative is and actually what boots on the ground kind of looks like, in terms of there's an order of magnitude of dApps that are just in biddle mode right now that are going to be launching over the next 6 to 12 months.
Oliver?
Seeing that growth, it's amazing. For me, out of 10, 6 to 12 months scale, I think a solid 9.5. And I don't think that's priced into the markets yet. And I say that not to diminish the trauma that we've faced in so many ways, markets up and down, companies coming and going. But in the fact that despite the relentless near-death experience, Celsius 3 Arrows, Terra Luna, FTX, Silvergate Signature, we're here. And every monster we slay makes it easier to slay the next one. So I'm very positive about the direction, because it is clear, I hope, to everyone here that this is a one-way street, that the upgrade of money and economy and how we do things is one way, but it's a little bumpy on the way. But I'm encouraged that we're here, and that every one of these crises gives us the tools to deal with the next.
So Nicholas, you said it's a hiccup. How long can the hiccup last? Does it depend on the type of sort of business you're running or project? Because obviously, you know, if you run an exchange, volumes are down and you need volumes to make money. And it's sort of, I mean, I guess everybody needs money to hire people, and many firms are firing people. So how long do we have left? Like, I guess you said there are companies that are going to launch, dApps that are going to launch, but how many are at the end of the runway?
I mean, to your point, right, you do see some, let's say, natural extinction, right? And this is primarily a symptom of overinflated valuations in the previous cycle, right? You have a company or a project, right, that raised at 200 million or something. The investors want to see a multiple; they don't want to see a down round, and right, so that company is going to struggle, right, to kind of continue to raise follow-on financing, right? But if you look in terms of new companies, in terms of seed stage funding, the majority of financing that we see right now from the investment side is on the seed and Series A, right? It's not on the Series B, Series C, Series D. And that's where the real innovation is happening.
Michael, what about from sort of the exchange perspective? How long can volumes remain this sort of depressed?
I mean, I really hope not too much longer, right? But I'd say, you know, it's one of those things where the last couple of quarters, we've really felt, I guess, the need to kind of just think about, well, how do you just run a business when it's in a period of stagnation and there isn't a lot of kind of hope in the near-term horizon? And to be honest with you, I don't think it's necessarily something that's specific to crypto. I think it's just general business management and practice, like manage your costs, think about how you're going to grow, build products customers actually want to use. I think there's an element of this whole season that really helps, I guess, kind of this longer-term innovation trajectory. I'm a big believer that, you know, when the tide kind of receded and everyone was kind of not, I guess, kind of just seeing money sloshing around, people really are pressed to either you build stuff that has commercial viability or you don't, and you don't survive. And I think that's been the critical difference between invention versus innovation, right? As in, invention is something that's just, you know, novel. But innovation is when you actually find a real commercial use case for this thing, and that people find value and are willing to pay value for it. And I think that's helped to push people along. I think, you know, for us, as much as we'd like for the environment to get better, I think we found ourselves in a position where we've tried to be disciplined as much as we can to ride this out, and I think we've seen others in the space as well, and I think they're generally signs of good people that are in the industry, players that are trying to build this for the long haul. And I think that's really what we're wanting to see, is just people survive building this thing, doing the right things. Hopefully when things get back into you know, a bull market, that we're going to see, you know, I guess kind of an upgrade as well, just in general of the products that are on the market for consumers and customers, et cetera. So.
Oliver, did you want to add in?
No, I mean, yes, always, but
we can.
Yeah.
Dan. So you've been through different cycles, right? You said 2013. How is this one different? I mean, you mentioned it's better. Or is there anything that was tougher, or anything that, you know, that's, you know?
You know, I mean, when we look at crypto cycles, it's one of the hardest sort of industries to build a business in, because you've got a monsoon versus a drought type mindset. In the bear market, it's a drought. There's no rain, you got to cut expenses, you got to cut down to the bone on headcount. My former employer, Cagney, I haven't been there for a year, went through layoffs where they cut like 30% of people. That's pretty extreme for most other industries, but in crypto, I think it's very appropriate. Coinbase, Kraken, and other legacy players in the space have been around since the 2013 cycle. They've seen how deep you need to cut in the bear. But in the bull, how do you plan for the bull? You know, and that's where you know, your expenses might triple or quadruple, your headcount will do the same. And that's what's really tricky is, you know, if you've got that too bearish mindset, you might not apply yourself in the bull and go allocate capital and go grab market share when the bull run comes back. In terms of how this cycle is different, I mean, honestly, this feels quite mild. I've traveled around the world. I was just in Korea, Singapore for Token 2049. I've got this conference, another one, and then also Bitcoin Amsterdam. From what I'm seeing on the ground, there's still tons of businesses being built. Lots of interest from people wanting to build, join companies, or just interested in crypto in general. So I think this is a mild winter.
if I can attempt to connect these 3 points, I think there's two that's about the quality of innovation, and one about what it takes to be the right size of cost versus revenue to survive whatever it takes. And I think in the past we've seen a lot of amazing innovation solving problems which don't really exist yet. And I think the ratio of solutions to problems is a lot healthier now. And when we go through these bear cycles, we have to figure out what is the right size and shape of your organization to push through. It is the narrowing of scope to those solutions which really matter now. And I think we've seen a lot of that. I think people are building things that are much more immediately relevant and less esoteric.
So one of the things that does seem a bit different is sort of this really aggressive sort of regulatory stance from the US. We had warnings in the previous cycle with ICOs. They did go after some ICOs, but now they're like the SEC in particular is kind of going after everyone. So how has that impacted kind of either your business or your sector? I guess in your case, it's probably been good, right? Because people are looking for more regulated counterparties, but
I mean, I'm looking forward to a time when we have consistent, globally coherent, rational regulation. I think what we saw in the last 6 months in the US was a non-discerning hostility towards the market, which is really anti the trend that we're looking for, which is for European, UK, Singaporean, US regulations to see eye to eye on what a thing is, how to protect the market with that thing, how to make sure that money going in and out of that thing is not from crime. All of those building blocks of regulation, I think, have taken a small step back this year with that with that SEC kind of outlook. But yes, within that chaos is opportunity, not just to be able to service that variety of regulations, but also to be able to feed back into the system and to be visible with a voice that points out what those differences are, so that there's a chance that they do reconcile.
Nicholas, what about from your vantage point within the industry?
Sure. I mean, I think you kind of see two things. One, it's unfortunate that the U.S. has kind of taken this more aggressive stance in the last couple of years, but it's clearly a very partisan issue in the U.S., right? And so, U.S. policy on this can change rather quickly, right? Especially with an election cycle coming up. The other thing that you kind of see is almost like an immune response from the crypto ecosystem, right? So if the regulators go after someone, right, and they use a certain kind of language, right, to put a protocol or a project in a certain position, everyone else notices that, right, and now builds, almost like around that, right, and carves out that piece, right? And so I think you're seeing a much more like defensive and thoughtful building at this time, right? Especially like it's almost a privilege to be building right now when there's not this euphoria with a bunch of users coming in, because it allows people to not have to rush, right? It allows people to take their time and build things thoughtfully and the right way, right? In preparation, kind of like what you were talking about the timing, right? To set yourself up for the next cycle, right? That they're now preparing, right? That they will have the right architecture, right? The right design, the right incentives, come what may.
Michael, the Hong Kong regulators have taken a different stance, right? They've been a bit more friendly. How has that impacted sort of the vibe there? I guess now there've been some scandals recently, but like, how do you notice any difference coming here, or like going to the US and you have some of your colleagues in the US?
Yeah, so I think what's been interesting is, so this year I've also kind of had the chance to go to different spots around the world. And what I've found is wherever there's been kind of this movement towards regulatory clarity, there is an improved confidence around just how do you navigate this stuff. And I think people just want to understand how that works. I think Hong Kong's been really great around, last October, there was, kind of a very coordinated message from the government and the regulators that they're going to make Hong Kong a virtual asset hub. And it was fantastic rhetoric, but most people were wondering, well, will they deliver on this? And I think what's exciting is that they've delivered on quite a bit, including basically a regime now that allows people to be properly licensed, and also that opens up for retail, which is kind of exciting in Hong Kong. I think there's also been a really well thought through approach around this. I was talking to one of the regulators and I was saying, hey, it's great when you've got, let's say a license plan and this path towards it. But if you don't have banking rails, for example, it's kind of like having a Porsche without a highway to drive it on, right? It's like, you kind of need the whole ecosystem to make this work and be successful. And it's been very neat to see the HKMA, for example, being very encouraging to the banks to say, hey, don't have this allergic reaction to banking crypto companies just because they're crypto, right?
Which is not happening here by comparison, right?
Well, but it was this idea of like, you should judge them on their own merits, right? They're technology companies, and this is something that we want to provide, to the banks, certainty around, for example, how they could be regulated and properly licensed to operate in a way that is, suitable to the way that, they want to develop this industry. So I think it's been a generally positive thing in Hong Kong. I think in the last probably week or so, we're starting to see the MAS starting to kick up again. There's been a lot of people announcing licenses recently in the last couple of days, which is also exciting, right? To see kind of that regulatory clarity coming through and momentum starting to happen again.
So there's a Slido question, which incidentally matches with what I wanted to ask, which is great. What are some of the biggest lessons, or what is your biggest lesson that you think you've taken from this cycle?
Well, I think a few of us touched on this before, which was you should build products that solve problems. I think in the bull run, you see a lot of excessive funding of shiny ideas that might resonate, but not really solve a customer problem. And so I think what we see in a bear market is when that tide comes out, what is actually solving a problem, what teams and companies are effectively allocating their capital to go build great products, those are the ones that are going to be left. So, yeah, I mean, it's pretty basic. Just build products that solve problems. It's actually funny because in crypto, there's so many solutions for hypothetical problems, but I've never seen an industry with this many solutions for hypothetical problems. So I would say, just basic product building, solve problems for your customer.
Yeah. If I could maybe
go ahead.
build on that a little bit. One particular framework that I found super helpful around this is this idea of jobs to be done. So it's by this famous business professor from Harvard called Clayton Christensen, right? And his whole thing was go beyond the correlational aspects of things and try to understand causality. What makes people think that this is the best alternative that they're willing to pay money for, to hire for the job that needs to be done? And I think that there's this element of pushing that envelope around how to build products and how to build things into this space. And I think it's, kind of diverting that attention, because there's a lot of brilliant people in this space. Having them solving for these real life problems and coming up with solutions, I think that would really help to accelerate kind of when the things start to pick up again.
Oliver, do you have a lesson learned?
Yeah, gosh. I think the crypto industry is still seen by many as kind of anarchic, chaotic, stick it to the man kind of economy, and it does a good job of giving itself a bad name on a regular basis. I think lessons learned from bear markets, there's a bunch of stuff from TradFi that has either been forgotten or ignored because it's TradFi. Basic counterparty credit risk management was absent. So much so that one of the acronyms floating in the last year or so, it was lost on somebody that it actually related to that basic concept. RWA as a real world asset, it's actually risk-weighted asset. It's how you protect your balance sheet. It's people have not been thinking about the credit risk which collapsed so many businesses last year, to the extent that you had token companies offering yield and in exchange for your deposit, they'd collateralize it with their token, doubling up your risk. It was absolutely nuts. So, in a nutshell, I think TradFi has maturity and the kind of models and frameworks that didn't happen by accident, and that ought to be observed and not copy-pasted directly. And there's a lot of stuff that's irrelevant in the crypto market, but that a lot of a new generation of crypto engineers should look at and build in fundamentally. And that's, I think, what's been missing in the last bear market. Every bear market you can trace, that's a market risk failure, or that's a kind of a basic DD failure, or a credit risk failure. So let's not ignore what TradFi has actually taken decades to build.
And if I could add 2 cents to that, I think there was excessive risk in the crypto ecosystem. And I mean, some of these lenders that were just egregious with how they assess their risk, where they're taking so much risk on one counterparty that it would wipe out the cumulative profits of a decade-old company. I mean, why would you take risk like that? It's insane. I would consider, I mean, most of the risk management in the space was negligent, I think is probably the appropriate term. I mean, even the smartest people in the room, you know, different companies that we consider to be the best, they failed to perform the most basic of risk management. Of course, you had the big Celsius blow up, and those that we all kind of suspected were going to be a little bit, you know, egregious. But I think that was pretty shocking to me, is that there were a lot of, the risk taking was so excessive that I couldn't even I mean, 3 arrows, you know, the whole gamut of all of them. So I think that really truly shocked me.
How many people were calling out the excessive risk-taking at the time? Because I've been covering it since when you were around, and during bull cycles in crypto, everybody's happy, everybody's making a ton of money. You don't want to point fingers and say, hey, that guy is taking on too much risk, because somehow he might be connected to one of your clients. And so do you think actually now people have implemented proper practices to manage counterparty risk? So if, like, say tomorrow some other narrative takes off and volumes start going up and lending starts going up, you have those practices in place? Or will they only come in place if someone tells the firms you must, otherwise you're going to jail?
I have direct visibility of this because, you know, when you're onboarding with a trading counterparty or a bank or anything, you've got your onboarding pack, your KYC, AML, the structure charts. What I'm super relieved to see now is the reverse DD. You know, for the longest time, you could onboard with somebody, and that would, but you wouldn't check them, which was absolutely nuts. You know, onboarding with each other as trading counterparties or as bank counterparties or whatever it is, you know, is a two-way DD, and we're starting to see, you know, when we've got a new client onboarding with us, they're asking us the right questions now. Like, thank you, here it is. So yes, we are seeing more signals of credit risk being taken into account.
Michael, what about from the exchange perspective, right? Or just from like a markets perspective, are you seeing people putting in place the right things so that if sort of things take off, if they are offering lending or margin, it's done with more checks, or like even hiring people who've had experience in this? Because in some cases there were like people doing checks that had never done it before.
I mean, it's kind of like what Oliver's saying, like the trend of more two-way DD happening has increased. I still remember, like, the week of FTX, all of our clients sent me 20-page questionnaires that I needed to fill out, and you know, it was one of those things where, thankfully, we had a lot of the answers like ready to go off the bat. But it was very clear that everyone was trying to basically catch up on what they had not been doing, which is, you know, trying to really dive deep and understand, you know, to what level of transparency do people have providing, for example, things like finances or whatever it might be, right? And so there was a big rush for, you know, I guess a couple months around proof of reserves. That's kind of tailed off a little bit recently. But on our side of things, we were kind of like fortunate. We said, hey, actually, we've got an audit from Deloitte. Do you want to see that? And they're like, we didn't even know that that was a question we could ask. You know, so, you know, there's been more and more scrutiny around this, which I think is generally good. It also, I think, converges closer towards, you know, what best practices people have when they're managing billions and trillions of dollars, which is kind of where we need to go to, right? That's what we want to see, right? I mean, it's funny, the other day we were sitting in Token, and our CEO is sitting next to the CEO of Franklin Templeton, and he kind of did a friendly reminder. This lady over here manages $1.5 trillion, which is about the market cap of crypto, right? So there's an element of there's a next stage that we're all going for, and I think that this pushes the maturity towards it, and I think it's a good thing. People are starting to ask more questions, and I hope that the industry keeps up in terms of being able to provide the transparency that's being required.
Nicholas, are you going to add something?
Yeah, so I think one of the things that's kind of ignored is how successful DeFi was during this kind of downturn that was triggered by this lapse of risk management, right? When you saw the CDFI lenders like BlockFi and Nexo and Celsius kind of blow up, right, due to the contagion, did DeFi blow up? No, they didn't. And actually, these same CDFI kind of companies, right, which were some of the biggest users of these DeFi protocols, did they pay back their creditors? No, they didn't. But guess who they paid back? They paid back the DeFi protocols, right, to unlock their collateral that they had stored in those protocols. And so I think it has to be said, like, how impressive it is that DeFi was able to make that jump from the previous cycle kind of beforehand, where you saw, I think probably Cream Finance is a good example, right, of a DeFi protocol, right, that was just had outlandish risk management, right, and eventually just became insolvent, right, versus other DeFi protocols kind of learned from that example, took very appropriate risk management in the previous cycle, right, and you did not see Aave blow up, you did not see Compound blow up, you did not see MakerDAO blow up, and I think that that should be celebrated a little bit more.
Yeah, I think that is really underappreciated by TradFi, who kind of see DeFi as this big miasma of WTF. It's coded incentives. It doesn't rely on any human's finger on the button to send or not send money, to apply or not apply a yield. It is a market-driven open box thing that you can DD by looking at the code. And yes, that brings its own risks and shortfalls, like platform risk and protocol risk, and like we still haven't really solved the anonymity versus privacy problem in DeFi. But yeah, I mean, to your point, it's there's fewer dragons in DeFi than you'd imagine.
I think there's a little bit of nuance here where DeFi, we've reduced counterparty risk almost to zero, which I think is a huge, incredible achievement. And I love the promise of DeFi, and I think that's what we're all working towards in this space, is we want to build financial architectures that are decentralized and remove that human finger on the button. However, I think it'd be remiss not to bring up all of the protocol risk involved, which is quite substantial. The amount of hacks and exploits that have occurred in DeFi are, I think, enormous. But I don't want that to overshadow its capabilities and its future, but I think that is something important to note.
So what are some of the things that need to change? You brought up hacks, so I guess security, but some of the building blocks that still aren't there if you want to get a big institution to go in heavy? Is it they just don't? Is it there's a lack of narrative now? Is it, we're missing some, is it the regulation? What are the things that really need to be in place still that aren't missing?
So liquidity is still such that you can take spot risk, but you can't hedge it. I mean, there are options out there, but the market, oh gosh, I was surprised to learn this gigantic stat. There is actually a gigantic options market, to my surprise. But to get TradFi engaged in that risk management component of the markets, we need a crypto ISDA. Because right now everybody's got their own structure, and it's all kind of similar, but a standard master agreement that the world can agree on for these instruments would enable large tier ones to engage on a common understanding.
Yeah. Regulation, infrastructure, scale, kind of like top three that come to mind. I remember I was speaking to a sovereign wealth fund in Asia, recently, and he was like, well, if I allocated 1% to this, it would just completely blow out kind of, the guardrails around, how much I can be in the market type of thing, right? Like if I can't actually deploy enough to make it meaningful at the moment, why would I spend all of these very precious resources in terms of people and time to figure it out right now? So there is a little bit of a waiting game around that, in addition to also the things that I mentioned earlier around regulatory stuff. So,
what about users, not of the tokens, and so not investors, but users of the protocols, users of these products that everybody keeps building every cycle we're building? Like, does that matter? Like, do we need at some point to have someone use this beyond? I guess the DeFi protocols get used again within the financial sphere, within the trading sphere, but does someone need to use, like, does Filecoin need to have a lot of users using it for what it was supposed to be made, or does that not matter anymore?
Well, I'm going to take a little bit of a fiery take on this, but
Good. I'm trying to get you guys fired.
Soft pitch there. So yeah,
Strap in.
the Bitcoin and all of the crypto assets, the adoption has primarily occurred through speculation. 2013, 2017, and 2021. Now, speculation isn't this dirty word, it just describes human behavior. Humans will look at a new asset class and decide to speculate as to its future value. The same thing happened with equities when they came around. When people first started to come up with the concept of equity, in fact, the East Indies Company, the speculative bubble that occurred from that, the Bank of England and England reacted so harshly against that they banned any new issuance of any new publicly traded company for 100 years. So speculation for any asset type has always occurred. With all of these protocols, I think what we're seeing is the token this sort of native token that you need like a Coke machine, or is it more of just a speculative instrument? I think most are just speculative instruments, and I'm not sure how many consumers are actually going to solve a consumer problem with these decentralized applications. I do think speculation is actually a utility. I think people want to borrow and lend. All market activities are speculative. Lending, borrowing, buying real estate versus other assets. So would people choose to speculate on new digital assets? Absolutely. And I think speculation is a utility.
So I'm going to take a slightly different take on that, and that it is that price begets narrative, narrative does not beget price. And that if you think about an application being able to get a certain fraction of the pie in terms of like the attention economy, right now it doesn't matter if you're getting 5%, 10%, or 20% of the pie. What really matters is that if once prices start to rise again, you'll have hundreds of millions of people around the world, right, pay attention to this space again, right? And at that point, if you can capture 1% of that pie, that is in orders of magnitude more kind of adoption than you can achieve even in the best of circumstances right now. The fact of the matter is, right, that the kind of common perspective of crypto right now is rather poisoned, right? We had a bunch of fraudsters, which that will always happen when there's easy money to be made, right? And that's kind of taken over the airwaves right now, right? We had Suzu go to jail in Singapore just this last week. We had the FTX trial or should I say the Sam Bankman-Fried trial, right? Start this week, right? And until we kind of resolve some of those lingering negative narratives that people associate with crypto, we're going to struggle a little bit. But as soon as those headwinds are gone, I really think that we're in a really good position.
How do you prevent these sort of situations from happening again? I think there could have been something that the industry could do as a whole. So I'm going to go back to the finger pointing. But if again the money comes back, will everybody be too busy making money to say, hey, look, that guy's a bit dodgy? Because there's like, as you say, the FTX trial starts this week. If prosecutors are alleging is actually confirmed. Like there were some egregious lapses there, right? And you know, so does the industry bear responsibility? Does the industry have to say sorry? There were lots of people who lost a lot of money, right? So will they come back, or will they be like, you know, keep your coins and speculate on your own?
They'll come back. And unfortunately, to your question, right, what can we do to prevent it? A big factor here is human psychology, right? People want to look to experts, right? Especially if they have a lot of like machismo and the like, right? And there's a lot of individuals that will take advantage of that, and if they see an opportunity, they will step into that vacuum, right? So just like we had the Do Kwons and the Sam Bankman-Frieds and the Su Zhus of last cycle and the Justin Suns of the previous cycle, we'll have a whole new crop of characters in the future, right? And it's really up to all of us here, right, to call those out, right? And you know, self-regulation only goes so far, but it's still a critical piece.
Hindsight's 20/20, isn't it? So it's easy to look at some of the big events and think coulda, woulda, shoulda. I was completely taken in by SBF's nerd camouflage. I just didn't realize what it was camouflaging. And I think the difference between these failures and whether or not we can prevent them is that they are at a cadence that exceeds previous markets by, I don't know, 5x. Which means that if the failures are at that rate, then so is the evolution and the success. And we're actually, this is the, I don't know, I think it needs to be allowed to fail as long as the direction remains one that is actually building something better, something that has a point. I think we all need to remind ourselves, what is the whole point of this? It is to upgrade money, it is to make things that have leaned on trust, trustless. It is to democratize engineering and access to financial instruments. If things are failing fast and building towards that, then hindsight is a kind of a moot point.
All right, we have 1 minute left, so I'm going to take the last question, which was, no, it's gone away, but I remember it, I think, is when do you think the next, this is a question, be hard to answer, but when do you think the next bull market is happening? What are your things you're looking for?
Well, I can make up a story for you, and we'll see if you like
cuts.
it. But yeah. So you've got the classic 4-year boom-bust cycle, which is dictated by the Bitcoin halving. The halving is when the Bitcoin issuance schedule, so the newly minted Bitcoins, drops in half. That should be occurring in April 2024. Now, you know, if you believe in efficient market hypothesis, we all know this is going to happen, so this should not be a shock. I think the halving is priced in for us who notice, but the rest of the world does not notice. Bitcoin does lead the market still. Otherwise, we'd see independent bull runs happening outside of Bitcoin. Instead, we see Bitcoin lead, then everything else follows. So I think Bitcoin dictates these cycles. And we should see, you know, after the halving, it's usually 6 to 12 months after, that we see the peak of the bull run. So that, combined with the Bitcoin ETF, combined with all the bad blood being washed out, combined with maybe some narratives that bring back in retail, I think a reasonable estimate would be end of 2024, middle of 2025.
Michael, have you heard of any compelling narratives? I've been trying to figure out what the next narrative will be, because sometimes behind the narrative hides the risk.
Yeah, I think one of the most compelling narratives I've heard was Dan just now. So I mean, honestly speaking, like, I think a lot of the stuff we've just discussed, it's kind of been bubbling, and some of these things just need to get solved for. I think there are some things that could be catalysts, but again, it's just like, I mean, honestly speaking, I'd be in the investor seat as opposed to the exchange if I knew exactly what was going on. But I think what Dan said is quite interesting in terms of like, what are some near-term things to look at that's fundamental to the way the industry is formed and how it's operating.
Because is there anything on the ground that you notice starts to happen before a bull run that might be an indication? So
I don't think it's a ground up type of phenomenon. I think it's more just that you know, the people on the ground are ready, right? They've built the stuff. They're ready for the big influx of attention. But I think it's more top down. right? I think the biggest factor is going to be US elections. It's going to be US monetary policy. And it doesn't hurt that that lines up rather nicely with the Bitcoin halvening, right? So yeah, I would kind of agree that mid-2024 going into 2025 should be some pretty good time for our industry.
Oliver, you have the last word.
As quick as I can.
Minus 1.40.
No pressure. Froth comes and goes, but it's also the most visible thing. The foundation, in the meantime, less visible, is growing. I'm going to mix all the metaphors now. But what we have is, in my view, a coiled spring. There's been so much purposeful build and having the right minds in the right room at the same time, that when the stars align, and I'll give my view on what that means in a moment, when the stars align, that coiled spring just explodes and we pop into bull market that where bull was actually wouldn't be the right word. It would be a healthy market. A healthy market is about 4 or 5x from where we are here today. And what is the trigger? I think it is a lowering of the weapons from the SEC. It is which itself is probably election driven. So I think the middle of the US is probably the single spark that we need to get this thing back on its ground, back on its feet.
All right. Thank you so much, everyone.
Thank you.
Thank you all for that great discussion. Over on the Vault stage, we are going to be having a fireside chat now that is going to be exploring setting the standards for the new digital asset class. If you want to stay with us right now, we're going to be looking at institutional trends in institutional adoption. So I think one of the biggest narratives this year has been institutions coming in and buying up Bitcoin. And that's probably led to historically low volatility in the asset class. If you actually head over to the Vault stage, my co-MC, Ed Robinson, who was at Bloomberg for 20 years, now writes for DL News, this has been one of his biggest narratives this year, the whole institutional adoption of digital assets. So I would like to welcome to the stage Jenna from LMAX, and also James, who is now at Zodia, in his second day at Zodia, was previously at CCData, so no pressure, James, for getting this right and representing Zodia custody. If you'd like to come to the stage, they're going to explore trends in institutional adoption of digital assets.
Sit next to each other?
Yeah.
Cool. Hello, everybody. Thank you, Katie. What an awesome introduction that was. And yes, second day, it's a little bit weird, but great to be on stage. So I'm James Harris. I'm the Chief Commercial Officer at Zodia Custody, which is a FCA-registered custodian based here in the UK that is also backed by Standard Chartered Bank, Northern Trust, and SBI. So thrilled to be joined here by Jenna Wright, MD of LMAX Digital. LMAX Digital have been supporting the institutional ecosystem here out of the UK for a very long time, and we're very grateful for them. They're consistently highly rated in CCData's exchange benchmark review, which is very well followed, and institutions pay a lot of attention to it. And LMAX is very much an institutional venue of choice. So I've got some questions for Jenna that we've prepared, I think, and we'd love to have some audience questions if we've got time. So please do put some questions on Slido. We'll try and tackle them if we get a chance. Jenna, here we are again.
Yep.
1 year on. Do you want to say hi? Introduce yourself?
Yeah, hi. For those of you that don't know me, I look after LMAX Digital, the spot cryptocurrency exchange within the LMAX group. We are exchange operators at the core in foreign exchange. So we've been doing that since 2010, and we launched LMAX Digital, the institutional-only crypto venue, in 2018. So 5.5 years in crypto, veterans.
Absolutely.
Yeah, and here we are.
You've been running that since the start.
I have.
Seen it all the way through. It's
Yep.
amazing. So look, a lot of change in the last 18 months. People have moved, that kind of thing. Firms have blown up. But of all the developments, which have been the most significant to you at LMAX Digital? Have you found any sort of positives in this bear market?
Always positive, James. Yeah, look, it's been the reputational contagion attached to many black swan events that took place last year have had a knock-on effect in terms of institutional adoption. Would be naive not to accept that. But I guess the good thing about what we've been trying to do is operate in a regulated environment like we would in FX and like we have done for way over a decade now. So I guess in the last year, it's provided. Look, we launched in a bear market, and we're back in a bear market. So it doesn't feel like
to be often in a bear market, but
and if you operate in capital markets, you should be used to these cyclical trends. So it's not concerning for us. I guess having a bit of free time where you're not running around like crazy lunatics in 2021 trying to support the trading volumes, you get a bit of time to get your operational setup and in the best position it can be. So this is not new news that we should operate in a horizontally integrated model. No. But the reality is the space has been operating very much vertically for our entire 5.5 years in space. So by that I mean it was okay and normal, and the infrastructure wasn't there for the likes of an exchange to do every part of the role of the ecosystem. And I think that was very obvious in November last year, and which caused the problems. You've got trading arms, exchanges, custodians all doing the same thing under one roof, and no separation of powers.
That's right. So you get this concentration of risk in individual entities, like we saw with FTX, effectively conducting the entire trading stack of looking after assets, trading assets, lending assets. Which is anathema, isn't it, really, to TradFi institutions. They can't do that. And there's an irony there, I think, when you look at the way that TradFi currently trades, it's actually, at the service provider layer, quite decentralized. You've got various different firms doing various different functions that they're very specifically doing. So do you think the market's going that way, digital assets?
Yeah, I mean, it's difficult. I think when we see a flurry when we move towards, real money asset managers entering the space, they will only be able to operate in that fashion. So to your new employer, we partnered with Zodia Custody this year to work with them on the off-exchange settlement piece. We want real money asset managers to feel comfortable that they can park their funds in a custodian and execute on the LMAX trading venue. And the two are very separate. And I think that is the model going forward. Obviously, we would like the ecosystem to come together. It becomes quite difficult as a venue to integrate to every custodian. So the more we can all come together to work together, that provides the infrastructure that asset managers and the likes are used to and are comfortable with. So we definitely need to push more down that route.
Definitely. I mean, I heard one of the previous panelists talk about decentralization, and that's a very interesting theme. It's a long way off from an institutional perspective. But I think here now, on the institutional side, people need to be able to be set up to trade in the way that they're accustomed to, but also, the funding question, right? Institutions don't have the capital until they have it, and that's when they can then match off trades. So they can't just pre-fund a trade. It's not easy to do. So thanks for the hat tip. It is great to be working together again. So just back to my former employer, CCData, they put out a lot of research reports, and one of the things that they put out is a report that looks at the volumes that all of the exchanges trade. And it probably comes as no surprise that the volumes are down across the board everywhere. How do you feel about that? I mean, can you give a little inkling as to how your clients are feeling? Have clients gone? Coming to the table, trading behaviors, just tell me how it looks from your perspective.
Look, I think lack of volatility translates to a lack of volumes. Our position in terms of share of, who suitable peers that we'd benchmark ourselves against, we're happy with our results. It's a tough one, but I guess if there are no arbitrage opportunities, there are no directional trading opportunities. We're in a high interest rate environment there are other ways to generate yield from trading spot crypto today. Where it's been great for us as a group is that suddenly the crypto firms that were trading a ton of crypto and are trading less, they now have FX requirements. So twofold. One, the banking issue, and probably should have highlighted that on the back of all those black swan events last year, when you thought it was over, suddenly the market structure, fiat rails were over too. So it just kind of had a knock-on effect. So we're playing quite a key role there in providing the crypto natives with the FX piece. And then also in terms of lack of trading opportunities, actually there have been opportunities in the more exotic currencies.
Yeah.
So providing an FX hedging venue for those guys has been really important too. So
What kind
good
of
and bad.
exotic FX pairs are you talking about?
Latin America's been interesting. Yeah, predominantly there.
Okay.
So
Interesting to see the jurisdictions that actually care about sound money and perhaps are getting their money debased. There's actually interest at the fiat currencies versus digital assets.
exactly, and then once they start looking at the FX venue, they look at, oh, you also do commodities and indices, and a lot of these clients have market making strategies. So ultimately, they're making a switch from trying to market make other asset classes as well. But for our group, LMAX Digital has been the fastest growing exchange of the 5 that we operate today.
Yeah.
We've now traded over $1 trillion in crypto,
Wow.
which is
That's extraordinary.
37 million Bitcoin equivalent. And I think the metric for us right now is not the volumes, because it's an apathetic market in that it's all really quite flat and boring. It's really about client onboarding.
Yeah.
And we've hit a mark at 750 clients onboarded over the last 5.5 years.
Those
which
are institutions.
we're
all
really pleased with that.
corporate,
Yeah, institutional only. We don't do retail in any capacity. Our access to retail is onboarding a retail broker who has millions of end users, but we just face
But you
that one
face that one,
counterparty. We get comfortable with their AML, KYC, and then just service them. So it means we can be better service providers. And the number that I look at really on a monthly, weekly basis is, we continuing to onboard those clients, because that's really key for us.
Yeah.
And it's looking good. So, we carry on, we're happy with that, and that's the metric for me right now, rather than the volumes and the revenues.
Nice. We've mentioned FX there. What about precious metals? People often sort of put together gold and Bitcoin as being sort of a currency debasement hedge. LMAX trades everything, obviously, the broader group. Are you seeing increased interest in metals, and are people referencing its digital assets at all?
I think we see a ton of gold. I don't know if the link right now is with crypto. And indices, surprisingly. Seen an uptick there, but back to my point, a market maker can make
like
a price
S&P
in any
500,
asset class.
that kind of stuff?
What was that?
You mean, sorry, like S&P 500?
Exactly,
okay.
yeah, FTSE 100.
We have some indexes in the audience today, so that's a great hat tip over to Market Vector over there. So great to see that the traditional products are still very, very popular.
Yeah, I mean, look, Bitcoin's holding up right now. It's had a very good September versus the rest of the asset classes. And September, I think, historically is a bad month. So we're doing okay, and now we're moving into
we held on,
October.
didn't we?
Yeah, we've done okay.
Yeah, and now it's October, apparently. We'll see.
Yeah, okay. So there is hope.
Yeah, well, ask me again in a month.
Yesterday was exciting, guys. We see a bit of a move.
Yeah, exactly. Well, you got your
We welcome
volatility.
those days.
Yes, exactly.
Yep.
So I'm sure your volumes ticked up. They always do when volatility ticks up. Trading picks up because, as you say, there are more trading opportunities. Right. So obviously, CCDAS's event today. Conference season is back in full force, and you've been traveling a fair bit, haven't you? All over the world, probably 3 continents at least in the last month. Can you give us an idea of how institutions tell us where you've been first, but also how the institutions are thinking about crypto there, and maybe a little bit of what you think about the regulators in those areas?
Yeah, sure. So much to the dislike of my children, I have been on all those continents over the last few weeks. Singapore for me was very exciting. I haven't been there for a long time, and the buzz around the Token 2049 event, real client leads, real good content, progressive regulatory approach from the MAS, the tier 1 banks that are engaging, with the MAS, for example, is huge, right? We haven't been in a position to have tier 1 banks looking to onboard firms that are regulated in Singapore or Hong Kong. So that's huge. And I think that is the start of a knock-on effect for, institutions paving the way. Obviously, we are all preparing in some way or another to be ready for MiCA. So setting up in Europe, again, as part of the separation of duties in our business, having some parts in Europe, some parts in Singapore. Maybe we'll have some parts to remain in Gibraltar. A lot of planning and strategic decisions going into that at the moment. And then, of course, look, we are headquartered in London, so if the UK and the FCA do their thing, I think there's a really powerful signal that we will have a framework.
Yeah, the soft whispers are there, aren't they?
Yeah, Treasury consultation, regulating activities rather than the asset class is really important.
Yeah.
And we welcome that. So look, I think just waiting on feedback, getting news there, and of course we'll do everything to be regulated here. It's the hub of the group, so we definitely want the crypto piece to sit in London as well.
Yeah, so to summarize, Asia throbbing, going extremely well, and euphoria is high, institutions are looking at it. Token 2049, I wasn't there this time, but multiple accounts tell me how exciting it was, which is fantastic to see. I think Asia will be a crypto hub. Europe has this framework, which is, it's tough in parts, and there's things that are a little bit weird, let's just say. However, it's a framework, and something to work with. UK framework possibly coming. I notice you didn't talk about the US. So maybe there's a reason for that, but let's try and speak about the US. I know it's been problematic for digital assets. A lot of people there are pinning their hopes on this approval of the spot Bitcoin ETF. How significant do you think an approval would be? How are you positioning yourself? Like, what does it do to the market and then to you specifically?
Yeah. So look, regulatory piece in the US is challenging. However, it's undeniable that I think it's 50% of the world's assets sit in the top 3 US custodial banks, right? So we mustn't ignore the fact that the US is very important to us, to the industry.
Yeah.
And look, we think that it's inevitable that it's not if, it's when the ETFs get approved.
Right.
But slowly. I don't think we should assume that we see a 100K Bitcoin price on the back of the spot ETF approvals.
No God candle? No. That's a shame.
I think it's a 12 to 24 month projection from the point of approval, if I'm honest. Slowly catch a monkey. But it really should be the catalyst for institutional adoption. It's giving the institutions the infrastructure that they feel comfortable with. We're all creatures of habits. So we like to trade how we usually trade other asset classes, and bringing crypto into mix there, I think, will be significant. So for us, we're, to your point earlier, we are a constituent to most of the indices that will be supporting these many ETFs that have been filed. We're a regulated venue for execution. And likewise, we want to position ourselves to be a tool for surveillance. The listing exchanges, if they do get the SEC challenge potential market manipulation, we want to be one of the venues that can be the source of truth for what really happens. So
sharing the information.
So positioning ourselves there to be an important part, the bedrock of the ETF space is a big focus, because we are institutionally focused. That has to be sort of the route we take.
No, I think it's very interesting. I mean, people might say, hold on a minute, what's the difference? Because you've got these, we're talking about spot ETF here, but there are already these ETFs based on futures. Well, the futures are based on the CME, and the CME is already a venue that everyone's comfortable trading with, all the institutions. A rubber stamping of a spot ETF will rubber stamp the next tier down of digital asset exchanges, of course, of which you are one. Yourself and Coinbase, you're very much in sort of in that kind of echelon. And I think that's the key thing, because then all of your Wall Street and Main Street banks have to be connected to these digital asset exchanges. Not just the CME, where everyone's already got a connection, but all of them, right? As in, all the ones that pass the muster of the indexes.
I think it's a nod from the SEC as well, when they do finally approve these, that they approve the asset class. And it should be the start of the knock-on effect of the regulation. So, we get the real money into the space over time. And then I think it gives confidence to those in the market and to build more.
Yeah.
Whereas now everyone's, building, spending a lot of time and effort and resource on building what we think is happening.
Yeah.
You get that over the line, and I think the confidence sort of boosts from there.
So briefly back on the US then, I think there's a tremendous opportunity for the US to say, well, listen, we can approve this finally. We can fight other battles. Some of the other projects are probably easier to go after. Everyone here is trying to do things properly. Most of the people at this conference are talking institutional language, trying to do things the right way, fully regulated, fully compliant. I think the US regulator will just get tired of this and say, you know what, this fight is done. Let's move on, and it will give them a chance to basically save face a little bit. When that happens, perhaps the US is a little bit more attractive, because we've noticed a lot of people leaving the US to build elsewhere.
Yeah, we have, but I think it's temporary.
Yeah.
I think, there are a lot of trading desks that sit in New York, and it doesn't feel right today.
Yeah.
So, let's get over to Singapore and
Correct.
base the hub there for now. But honestly, I was there a week ago, and I'm there twice more in the next 3 weeks.
Yeah.
It's still happening. There are still big events taking place. We can't rule out the States as being
absolutely.
mega,
Yeah, I mean,
right,
look,
for us.
If you were to personalize the States, you'd say it's depressed at the moment.
Sure.
However, that doesn't last long. My experience of the US economy bounces back very hard, very strongly, gets its act together, and of course, it's a wonderful place to do business. So I think the US will be fine, but in the meantime, of course, you've got these other jurisdictions lobbying, jockeying, to try and get the vanguard seat for digital assets, and who wants to be the next digital asset hub.
Yeah, it's competitive.
Yeah.
You're kind of missing out if you don't try and play in the race. So, Singapore was sensational,
I know,
if I'm honest. It was a shock to me. I hadn't been there for a while, and it's thriving.
Nice. Well, looking forward then, crystal balls or no crystal balls, your choice. I think several drivers will help digital asset markets. I mean, obviously, we've got the cyclicality linked to the Bitcoin halving. Bitcoin halving is in April. I think that there's a lot of correlation between digital asset price movement and currency debasement, and so the macro picture probably is important. But how are you thinking about things in the next 12 months? We've got a couple of minutes, maybe talk about how you're setting your stall out. Do you think there's going to be a bull market? That kind of thing.
Yes, I think there will be a bull market.
The when.
I don't think it's like, I think I said it earlier, I don't think the ETFs translate to the bull market. I do think that it is the first thing in a while that will trigger money. And for us, I guess the focus is on being pragmatic about the positioning of ourselves, embedding ourselves as much as possible. Regs are important, and encouraging, the credit intermediation piece hasn't changed for us. We're still very much of the opinion that we need credit intermediation. I think the regulatory piece will encourage that. We're still missing what we have in the FX markets, a prime brokered model, whereby little old LMAX doesn't have to intermediate credit and use its balance sheet, which is obviously limited versus what the banks can do for us.
Yeah.
But we're seeing...
It's beginning to emerge, right? I mean, you've got likes of Hidden Road beginning to play.
Exactly. You took the words out of my mouth. They're doing a
probably both of us work with.
doing a fantastic job of intermediating the space, but we need more of that. They will grow their balance sheet, but we need many PEs.
It's for those of you that are entrepreneurial and can find backing, it's setting up a PB right now, or at least diverting some funds towards moving a traditional PB to look at digital assets. Probably a good business idea. So
exactly what Hidden Road have done, right?
Yeah,
so
exactly.
If there's a few more of those coming into space, we welcome that.
Yeah, margins are still higher on digital assets too.
Yeah.
Although you may be feeling the squeeze at times. But look, I think that's all we've got time for. So I really appreciate the questions. We've managed to weave a few of those in. Jenna, thank you so much, as ever.
Pleasure.
Are we doing this again next year?
Sure. Thanks for having me.
Thanks, everyone. Appreciate your time. Please.
Thank you to Jenna and James for that brilliant discussion. So over on the Vault stage, I want to let you know that there is going to be a panel on decoding the derivatives market, which if you're certainly from a TradFi background, that's going to be a very important discussion to be listening to. So as we just heard from Jenna and James, when we're looking at institutional adoption, obviously regulation is one of the key elements of that. I work in regulated DeFi, and let me tell you, it can be mind-bending to say the least. We've already heard the guys just now talk about the nuances in regulation and really how it's a rich tapestry of differences and different approaches that certain jurisdictions are taking one over the other. So our next panel is going to explore this topic, and I would like you to invite, well, I'm going to invite to the stage our panelists. We have Jeff from BitGo, John Baptiste from Bitstamp, Lisa, who is a UK MP, and this will be moderated by Emma from GBBC Digital Finance. Please join me in welcoming them to the stage.
Good morning, London. It's an absolute pleasure to be here, especially when the sun has his hat on outside. Always nice to be back in town. We will be discussing today future-proofing the digital asset industry, so ensuring growth amidst regulatory uncertainty. I'm Emma Joyce. I'm the CEO of GBBC Digital Finance. Last year, we merged with the Global Blockchain Business Council, and we're now the largest digital asset and blockchain association in the world. And we engage globally around the world with different regulators, policymakers, and industry working towards that regulatory certainty. It's my absolute pleasure to be here with these amazing panelists today. We've already been having a great conversation for quite a while upstairs, actually, so I'm sure this is going to be a thrilling discussion. I'd like to ask my panelists to introduce themselves today and tell you a little bit about them. If we could start with Lisa, please.
Yeah, thank you so much for having me here today. I'm Dr. Lisa Cameron. I'm an MP in the House of Commons, and I have the privilege of starting up and chairing the all-party parliamentary group for cryptocurrency and digital assets in the Parliament. So I've been doing that work now for 2 years. You've all kept me extremely busy. It's a fast-paced sector, and we continue to upskill ourselves in the Parliament to make sure that we can do this dynamic sector justice moving forward.
Hi, I'm Jeff Horowitz. I'm the Chief Compliance Officer for BitGo, one of the largest institutional custodians. Been around 11 years now, and excited to be here and to talk about regulation and what we're doing well and what we're not doing well.
Good morning, everyone. Very happy to be here today. I'm JB Graftio. I'm the CEO of Bitstamp. We have been in the crypto space for more than 12 years, and very happy to share more on our journey, especially around regulation.
So, first question for today. How can governments around the world not only address the risks that digital assets can present, but also really harness the potential from digital assets and the underlying technologies? How do you think governments are working to manage those two questions? Who'd like to go first?
I'm happy to go first if you... I mean, really what we've had to do in Parliament is to get ourselves up to pace with this industry and this sector. So working across the House of Commons and the House of Lords, when I started, it was very much with consumer protection focus, which remains at the core of the work we're doing in the Parliament. I had a constituent contact me, which of course is where all of our work emanates from our constituents who'd experienced a rug pull scam. And at that point in time, we weren't really doing anything in the Parliament. There had been no debates. There were very few questions. But we looked at what was happening across the UK, and millions of people were engaged in the sector. So we knew that there was no going back, that this sector is here to stay, and that actually what we need to do is manage the consumer risks, put the regulation in place, and harness the potential. Because when we looked at this industry very closely with the blockchain technological advancements, we felt we really have a digital generation ahead, and this is like a new industrial revolution, but it's going to be more than industry. It's going to be culture and art, sports, etc. So we need to get ahead of it, and we want the UK to be at the helm of this moving forward. So we've really been doing so much work to bring industry, to bring regulators and legislators together, and consumers, to make sure that we square the circle and take this work ahead.
Thank you, Lisa. Jean-Baptiste, we talk in the title of this panel about regulatory uncertainty, but in Europe with MiCA, are we more in the realms of certainty than uncertainty now? How do European companies feel?
Yes, I would say, if you take into account the regulatory landscape today in Europe, it's very, very complex. It's very fragmented as well. Each country has its own approach on crypto today, which means that for crypto operator, you need to apply for a VASP in some countries, in some type of other licenses in other countries, and in some other countries in Europe, you don't need to have any registration to operate. So as a crypto operator, we need to navigate around this regulatory transition, if I can say. I would call that regulatory patchwork because of the complexity, because of the fragmentation, and it's extremely expensive also to maintain. Which means for us, essentially, MiCA is very important so that we can establish a level playing field across Europe, essentially, to have clear rules for accessing crypto for crypto asset service providers. We feel also that MiCA is important to increase consumer protection, which is the key, essentially, to drive some level of adoption for consumers to enter the crypto space. So what we see in MiCA, essentially, is establishing level playing field, increase consumer protection, and basically helping firms to navigate around the market, to avoid the complexity that we are experiencing today, to avoid the fragmentation that we are experiencing today. And ultimately, that will help us also to reduce our cost in terms of legal fees, in terms of regulatory fees that we are experiencing today to stay in compliance. The key part as well is that with the freedom to provide services in the EU, you will establish your entity in one country, get MiCA, and then you can passport across all EU member states, which is extremely compelling to drive the business, essentially. And the other point is that the rules in terms of governance, risk management, compliance, will be there, which means that it will be clearer, at least in that region, to stay in compliance versus potentially the US, where there are litigation, there are court cases to try to drive some level of clarity in the regulatory landscape. So for us, from a Bitstamp point of view, we are very supportive of MiCA, essentially, for the reasons I just mentioned. Really to try to establish that level playing field and be in an ecosystem where, if the rules are clear, that will drive adoption for consumers, but also essentially institutional players entering the space.
So a positive for industry. Jeff, Jean-Baptiste talked briefly there about the US. A slightly different approach happening now in the US. Do we have a view as to what the US thinks of other frameworks that are happening around the world? And is there a risk on the US not having these frameworks in place soon?
Absolutely. I think we've recognized that we're far behind many other jurisdictions, whether that's MiCA in Europe or Dubai or Singapore, who've come up with a framework. We're still grappling internally. Our legislators write the law, our regulators manage and enforce those regulations, and some of those think that our existing rule book works just fine. And I disagree. I think we have a new innovation, we have this peer-to-peer technology, and our rule book needs to be modernized. I've been in crypto for 6 years. We're still having the same conversations over who has jurisdiction to bring enforcement cases rather than who can actually answer some questions. And what's resulted is we are now in the courts because neither our legislators can pass a framework and our regulators won't answer questions. So we have no choice but to go to the courts, and that does nobody any good. Our investors, our consumers still don't have the protections they need. And we have lost the innovation battle. I think we were one of the first countries to get heavily involved in crypto, and it could have been ours to win. And now we're at the point where, while we're not leaving the US, we are hanging our flags, working on our license in Dubai, because they've taken a very practical approach. They're not going to spend 3 years deciding what's a security and what's a commodity. They've taken 6 rule books and said, what are the risks that we need to address in each of these rule books? That's a common sense approach. We have some principal regulation with the CFTC, but we don't have it like the UK as a backbone. I am worried from being a US citizen that we are losing that innovation battle. There are risks we need to address, but are we going to throw it all out and throw out all the innovation that it can bring?
Thank you. We may come back to that actually, because it's a very interesting, I think, topic in this conversation. But Lisa, going back a little bit to MiCA, obviously the UK is progressing certain regulatory initiatives. How does that compare to MiCA? And can you talk us a little bit through what the UK is doing at the moment, please?
Yeah. I mean, we started off, as I say, upskilling ourselves. So we had lots of industry come to speak to us. We had round tables in the Parliament. We really started from scratch. So we had some meetings where people were talking about fiat, and some of the members of the House of Lords were saying, why are we talking about cars? Isn't this about finance? So, we really had to bring ourselves on quite at rapid pace there from that point of view. From that point, we have done about 18 months now of education in the Parliament. We've had a number of inquiry reports. We've had bills moving through the House. The next stage of our group, and we want everyone who's interested to get in touch with the All-Party Parliamentary Group, because it's your group as much as it is mine. The next stage is to look at international best practice. So we've been to Zug. We've been speaking to legislators there. We've been arranging to go to Paris and Brussels, and we're thinking also about engaging with Singapore and with Dubai. And we want to look at what is the international best practice and where can the UK take a bespoke approach that fits for the framework that we want to set here. But only when we can look at that, because there's going to be, I think, have to be some sort of interoperability as well globally, and a set of standards as well that overarches things, although different jurisdictions will do their own thing to some degree. So, but those are the sort of elements we're working on, what can we pull to the UK? We're not generally the first mover, so we're pleased that MiCA's there, and we can look at that and then look at what we want to adopt and where we can kind of have that bespoke approach for competitiveness in the UK.
That's really interesting, thank you. So you're looking, further than just MiCA, because I think many were waiting to see if the UK would just copy MiCA, or it's interesting to see, we think government is
No, I don't think there's going to be any copying of MiCA, but obviously where things are working, then you don't, no, exactly. the UK doesn't want to invent something entirely new, but we have to have what fits here, and it's a bit like having something bespoke, but also with a competitive edge. And it's, is it MiCA, is it MiCA, potatoes, potatoes, we all have different impressions. So we're learning about it, and we're pleased it's there, and we feel that it's a great step. And I actually had a look at some research that showed that not just is MiCA good for consumers, for protection, but also when you have that clarity, it brings investment. So a lot of investment is now moving to the EU because of MiCA. So I think they're doing a great job. We want to learn from that, and also to create our own bespoke system here.
Jeff, just going back to you very briefly, obviously I know you spoke about what's happening in the US, but obviously we hear Lisa saying that the UK is looking further afield. I have to say I'm a teeny bit more positive than you on the US, only because I think the US has always been such a leader in innovation. I can't believe that they're not going to quickly get it together and try and continue to be a leader in this space. Do you think those in power in the US are looking abroad, are looking closely at what's happening in Singapore, in UAE, in Europe, and thinking about trying to pick out the parts from those frameworks that they like?
To an extent. Crypto's become very politicized. We're fighting between Republicans and Democrats. We did make some progress. We had a market structure bill make it through the House Financial Services Committee and our Ag Committee. It now goes to the full House before it goes to the Senate. Whether it will pass under our current regime, I don't know. But I do like how Mika took a look at, we can't get everything in one bill, right? So they've left off DeFi and some of the thornier issues, but at least they have a starting process. I hope that that's where we get. And maybe some smaller bills, whether it's a stablecoin bill or market structure, that we get some clarity while we work around the edges of the other, thornier issues. Are we afraid, or are we learning how others are doing it? Absolutely. I just don't know if there's the political will in this current administration to take that on and actually make real progress.
Okay, so a lot to wait and find out.
Yep.
Thank you. As we look back on the events of last year, how do we think companies are really ensuring that they have the right compliance and governance strategies in place? Jean-Baptiste, could I start with you, please?
Sure. So I think what happened last year is essentially around the lack of governance, risk management, and compliance from some of the operators that do not exist anymore today. So the key for us is to reassure our customers, essentially, and our regulators and partners that we have been in a space for 12 years now. We have a portfolio of 53 licenses in the world. Compliance first, regulatory first, security first. This is really the message we try to convey. Our financial statements are audited by a Big Four since now 2016. And 1/3 of our excellent employees are working in legal and compliance and regulatory and risk management. So we really want to emphasize that this is important. Regulatory and governance and risk management are very, very important. And Mika will essentially also reinforce that, that point. When you get a license, you have to accommodate the set of controls and governance and risk management. So we look at the last 12 months. Essentially, it's a lack of governance, a lack of probably audits, a lack of transparency, and to re-emphasize to the market. I think the best actors today, like us, for instance, we are really emphasizing on transparency, proof of reserve, risk management, governance, really to give the maximum comfort to our existing clients, to give the comfort also to our regulators. And what we have seen, especially for us, is that we have tripled our market shares, in the last 12 months. So probably regulatory compliance was not really sexy, if I can say, more than a year ago, but it's becoming, the key of the success in that market today. Transparency and regulatory and security.
Thank you. Jeff, would you agree with that?
Yeah. On the eve of the FTX, trial today, right? There were a lot of lessons learned, but it wasn't a crypto failure, right? This was risk management. It was poor governance. It was a bad market structure of having an exchange also be a custodian. The New York Stock Exchange is not a custodian. And so we need to get those, basic principles of separation of duties into regulation and into law. But a lot of the collapses we had were fundamental failures just on risk management. And I think we're doing a better job now than we did then, but could we avoided all those problems if we had self-regulated ourselves and done the right things? I think our industry would be farther along. I think we've taken 2 steps back to go 1 forward.
Thank you. Lisa, should governments and industry be working together and in sync on this issue? And do you think they are?
I think we're getting much better at it.
Okay.
Definitely over the past year. In fact, actually, the upheaval in this industry, in your industry, is nothing compared to the upheaval in the Parliament. I've had 3 prime ministers in the last year, so we've been grappling with our changes too. But I think we have more stability now. We have been working across government with industry, with consumers, with the regulator. The regulator definitely needs more support, we've highlighted that in our inquiry report, that we feel there needs to be much more support put there, because we need to have basic things to be happening, and we're highlighting these to government all the time in questions, in debates, like opening a bank account, still very difficult in the UK for companies. Basic things like getting a license, taking a very long time. Very few companies have made that. So we need to, if we're going to be a crypto hub, which is what Prime Minister Sunak has said his aspiration is for the UK, and we want to work cross-party to achieve that. If we want that to happen, we need to actually tackle not just the sort of high-level policy stuff, but the basic things that you need to do to run a company here as well, like opening bank accounts, etc., giving the FCA many more tools and much more support in order to get their job done in a more streamlined way. So I think we've made a huge amount of progress. The reason I come to these events, and thank you for inviting me, is to have that link with industry, because I think that's just very key in order to get a what works principles going in the Parliament. And as I said, we've been on our learning curve, but only with your help are we getting there. And with such a fast-moving, dynamic industry, we need to have your engagement in order to make this work for the UK.
Thank you. And I have to say, I definitely see that myself too. I really see, and not just UK regulators, but we talk globally to regulators everywhere, and we see that level of engagement has really picked up the pace this year. Jean-Baptiste, do you see that in Europe as well? Are you seeing industry and government?
Yeah, I would say, the ecosystem is less than 15 years old today. So of course it takes time, to build and to deploy a set of controls to engage with legislators and regulators and try to educate on our ecosystem. That takes a lot of time. I used to work in e-money business in the past, and it took ages, to get, e-money directive, payment service directive. So we are experiencing, something very similar with crypto. So I think what we are living today is not unusual. It's a lot of engagement and education, and I would say, some level of influence to try to share our knowledge, the way we are running the business, so that we basically try to align or go in a direction where the regulation is a smart regulation, essentially. So it's not a surprise. I mean, if we look at the ecosystem, it's like 15 years today. There has been a transitional regime with the VASP in different countries, which is a first step. MiCA is probably the second one, and I'm sure there will be a MiCA 2 in the future, essentially in Europe. But of course, we see the same in Singapore. We see the same in the UK, where the regulatory landscape is evolving. And it takes time, but it's also up to us, private sector, to engage with legislators, regulators, working group, and really share our knowledge to make the dialogue the most effective, to build and establish a proper set of regulation. And clarity is the key for us in our market.
Absolutely, I completely agree. Thank you. Does anyone have a view on AI and how, I guess it's a lot, we hear about it all the time in the news. I know it's a very hot topic, and there's a real focus on governance and regulation for AI. How do we think this may impact the world of digital assets?
I mean, I can talk about what's happened in the Parliament. We have a new AI metaverse all-party group that people can be in touch with. I think it's all very linked. We actually had the Children's Parliament come to speak to us about AI developments, and we had lots of different organizations there. One of the first questions was, put your hand up if you understand the metaverse and AI. All the children, very few MPs, very few members of the House of Lords. So we have this digital generation that's happening that we are learning from, the children and the young people. And I think, jobs of the future is my next debate in the Parliament, digitalisation and jobs of the future. And I think we really have to make sure that we give opportunities to young people, but but also for people who have been in industries who want to switch and reskill, because this is going to be transformational, and we clearly have a lot of work to do to understand it fully. So yes, we also have that consumer protection part, and the children said to us, they're very savvy, they said, we don't want to be doing this all day, every day. We don't want to live in a virtual world, but this will change our education. We could be at the heart of a volcano experiencing it. We could be, you know, back in history with Henry VIII having our head cut off as one of his wives. We could, you know, we could do all these things, understanding things, but we don't want to do it all the time because it's not good for our health. And they said very clearly, you need to make it safe. So that's our tasks moving ahead in the Parliament.
Okay, perfect. Thank you. I've just noticed, I haven't been looking at the questions, but we do have questions from the audience. So let's take one. I think we have covered this a little, but we have one question, which is, isn't the lack of standardization of regulations across different jurisdictions a concern for the industry? Will we move towards such direction in the future? Does anyone have any views on that?
Sure, go
I can go first.
Is it a concern? Yes, because I fear that some will go to the path of least resistance, try to go to the jurisdiction where you're going to get a license quickly. Our biggest challenge is, even within our own jurisdictions, whether it's Europe or the UK or the US, we haven't come to a standardization, let alone at a global level. You know, and the travel rule being one of those regulations out there that you need global coordination for that travel rule to actually work. You know, FATF came out and set some standards that you need to share this information, but we haven't tackled what the definitions are, so how can we actually share that information? So it is a concern, but I think it's really up to our own jurisdictions first to lay out that framework that we're comfortable with, and then we can figure this out on a global scale.
Yeah. Jean-Baptiste?
So much. I think, you know, this is a concern. I think for us, the crypto dream would be one set of regulation globally, but of course that's not something we would be exploring. Nevertheless, I think, you know, what is important is we have some, let's say, global standards or market practices when it comes to, for instance, you know, KYC, travel rule, where we try to design a global scheme for crypto operators, which is good. The complexity here is, you know, as long as the regulatory landscape is fragmented, US, Europe, UK, Singapore, what it implies is, you know, additional cost, additional complexity, additional, I would say, almost lack of clarity, and it's not really helpful for us to navigate around the regulatory landscape. Nevertheless, as mentioned earlier, I think our job essentially is really as private sector to engage with regulators everywhere in the world and try to build a more standardized or uniform landscape. And of course, it takes time. Each country or each region has probably a different approach on crypto as well. But nevertheless, the goal for us would be to minimize, you know, the key differences across the different regions for, you know, for crypto. And I think UK and Europe is essentially the same, you know, spirit. In the US, I think we need to wait probably a couple of years to get more clarity on the landscape. And I think Singapore, for instance, is a good place to make business. The spirit is very similar to Europe, so that we see some level of harmonization also between the two regions there.
Absolutely, and we've seen recently the FSB's recommendations. We see organisations like IOSCO bringing, you know, many different players in the industry together, which I think is very positive, and I see a lot of collaboration in the industry, regardless of where a company is based. So I think that's very encouraging. One thing that I think you touched on slightly in talking about this new any new regulation and the costs that it's going to incur, does it put smaller startups, you know, in a difficult position? Are the bigger, more powerful companies in a much better position, and how do we ensure that innovation still thrives?
Great question. I think, you know, looking at MiCA in Europe, for instance, my gut feeling is that the entry barriers will be pretty high for, you know, small companies with limited financial capabilities to make it happen. Why? Because when you get a MiCA license in the future, you need to have robust compliance, risk management, essentially, audit capabilities, strong management in place, and obviously, for small startups, it might be hard, to get to that point. My gut feeling is that we will see probably more consolidation in the ecosystem for that reason, essentially, because the cost of regulation is expensive, which means that I see more global actors with large financial capabilities, potentially to get under their umbrella, some startups willing to enter the crypto space. That's probably how I look at the ecosystem. So I think the short answer is that entry barriers might be high to enter the crypto market in the future.
Thank you. And Lisa, do you ever hear from any of the smaller startups at all?
Yes, I do. I hear from lots of different sizes of organisation. I just think it's really fundamental for the UK and actually across the world globally. That this is like a new industrial revolution. We need to have these entrepreneurs and innovators, and we need to make sure we link it to research, university courses, development, but that we give people the impetus and the funding and the support to come forward and to be those entrepreneurs of the future, because I think with the technological advancements, it's going to be really key for the future of our industry as a whole, that we have a leadership position. And I think only with that investment and support to help people start up and scale up can we do that. So I wouldn't like to see it being overly burdensome for companies and people who want to just develop their ideas and be inspirational for this country, because those are the people we need. We need you going forward, and it's our job to make sure that you have a place at the table and that we listen to your concerns and that we help to enable you to contribute, because I think that's going to be what is at the cornerstone of what I would call digital Britain moving forward.
Thank you. We have about 4 minutes left, so we've got time for one more question, which is, end customers and financial institutions are looking for trust. How do you think security and custody of digital assets will help this? And how long will it take? We haven't covered custody, actually. Jeff, would you mind?
Sure. I think that's a great question. We're a qualified custodian in the US, which means we're regulated. We're regulated at the state level in South Dakota and in New York. And I think investors are looking for someone that they can trust. Who gets examined? What rule books do you follow? There's definitely room for self-custody, but when you're talking about billions of assets, I think you want to outsource that to a professional firm. FTX was an example of an exchange, not a custodian, that custodies assets online and didn't have all the right risk management or didn't have all the right security controls. So I think we're there. There are a lot of custodial players that have taken it seriously, that have spent the money that JB was talking about on security, on controls, on compliance and legal, to make you feel that your assets are secure and that they're going to be there when you need it. I think the lack of regulation and some of the lending that we were allowed and some of the kind of 100x that we experienced didn't go well for those custodians that didn't follow the rule books that we're used to in traditional markets.
Thank you. I think we're going to have to end it there. Thank you so much for your time this morning. Big thank you to Lisa, Jeff, and Jean-Baptiste for joining me on stage today, and I do hope you'll enjoy the rest of the day.
For that insightful discussion. Over on the vaults, we do have a fireside chat that is going to be starting imminently about the evolution of OTC markets. Here on this stage, so we've just heard from the industry about the need for regulation, what that regulation is going to look like, and now we're actually going to hear from the regulators themselves. So the FCA has traditionally taken quite a forward-leaning approach to digital assets with the various sandbox regimes and initiatives that they've had. But we are now starting to see other jurisdictions like Europe, like Singapore and the rest of APAC, kind of stealing the march on London's once forward-leaning approach to this, because they're actually enshrining these rules into law. And what that means is a lot of entrepreneurs are actually going and setting up business in those jurisdictions, which means, are we losing business from London to these other areas? So it's actually a huge boon, I think, for the CCData Digital Asset Summit to have the FCA come and talk to us today about the challenges that they face to not only keep up with regulatory innovation, but also, at the end of the day, protect investors. So please welcome to the stage Helen Boyd from the FCA, and this will be moderated by Alyssa, who is the Chief of Staff for CCData. Welcome to the stage.
Hi, everyone. My name is Alyssa Ostrov. I am the Chief of Staff at CCData. And as Katie mentioned, I have the distinct pleasure today to be joined by Helen Boyd, who is the Head of Department for Capital Markets within the Infrastructure and Exchanges Division at the FCA, where she oversees teams working across wholesale policy issues relevant to capital markets and the supervision of benchmark administrators and credit rating agencies. She leads the FCA's wholesale crypto asset policy work streams and is currently assessing future regulatory frameworks on market infrastructures, intermediaries, issuance and disclosure, and market conduct as part of the FCA's broader commitment to the regulation of crypto asset markets. So after that, after that introduction, hopefully Helen can tell us a little bit about her journey. You've had a really impressive tenure of 15 years at the FCA. When did you first make the break from traditional wholesale financial market regulation into digital asset markets, and what was that experience like?
Firstly, thank you very much for the invite today, and thank you for that very lengthy spiel about what I do. It is a very big piece of work that the department is covering. I should say I haven't entirely taken a break from the traditional finance space. A lot of what the department still do is setting the rules and regulations for the traditional finance space, but we felt there was value in bringing the wholesale crypto policy to sit alongside that work, because, as I'm sure you'll hear a mantra well used through many of the debates and possibly well used today as well, same risk, same regulatory outcome is very much what we're looking to deliver here. So within the FCA, we've been doing a lot of work in the last 18 months to particularly think about what that would mean in the crypto space. What are the specific risks in crypto that we need to be worrying about? And what are actually the things that are actually very common, very well-known risks that we already see in traditional finance? And I think the last panelists were talking a lot about the problems with risk management that were faced by FTX and others. This is not new. That need to have good governance, that need to have good systems and controls, that is frankly bread and butter for a regulator. That is what we're here to do, and make sure that people have clear expectations and that the bar is remaining very high. So my team, I'm very pleased to say, have been growing over the last year. We work very closely with the retail policy side, as I'm sure you can imagine, because there isn't that clear dividing line between policy for retail and the policy for wholesale. And we're bringing forward our ideas at pace to think and work with the industry. I think one of the key messages I'd have is that this is still it is an unregulated space. The FCA currently has quite limited powers, but we are looking at what the future is bringing, and it's going to bring quite quickly as the Treasury moves towards closing its consultation and setting out that new framework. So we're trying to be ahead of that. We're trying to think about what that power will look like and how we can best deploy it to understand the risks, the opportunities in this space. And I am a regulator. I'm going to spend a lot of time probably today talking about risk. Apologies in advance. It's what I do for a living. But we're not blind to the opportunities either, and it's about balance. It's about finding the balance between a good regulatory regime. A clear regulatory regime can in itself be an advantage to a jurisdiction when it's trying to sort of set out its stall in a marketplace that is highly global. People want to know what the rules are. They want to understand the rules of engagement, the functionality that the regulator is going to provide. And for us, it's about making sure that we're on the pitch in the right way and we're creating that balance between the appropriate risk management, but also facilitating the innovation, supporting it when it needs support, understanding where regulatory barriers, perhaps which were traditional finance were appropriate, perhaps need to be looked at again when we're looking at the new and novel asset class of crypto.
Absolutely, and I think on that note, obviously the FCA has stated that crypto assets are one of its focus areas for 2023 and 2024. Could you give us just a little bit of an overview of the legislative and regulatory process in the UK and at what point the FCA enters in this operation?
Absolutely. So the FCA is an independent regulator. Sorry if everyone knows that and that's boring for everyone to know, but useful to set out the stall that we only get our powers when they're given to us by the Treasury. At the moment, we are still waiting for that power to be given to us. That doesn't mean we're blind to the fact that that consultation has been out from the Treasury for some time. It does set out a pretty comprehensive framework, which we are anticipating being substantially where the regime will head. But we do have to wait for Treasury to firstly publish the results of its consultation and then move forward with the legislative part. As soon as that is done, the FCA will be in a position to take forward those new powers and work out what the regulatory framework is that we will be writing the rules for. And as part of that, we are going to want to talk a great deal to the industry. We want to get your feedback. We want to understand what risks you see are prevalent. And many of you, I'm sure, have spent the last 6 months talking about the risks in crypto. It's what people have been spending time on panels talking about. We want to make sure we have completely captured what your understanding of the risks are. We'll want to understand what the challenges are you're facing and what an appropriate risk management approach would be. We want that engagement to be timely. We want it to have wide breadth. We want to hear from all players in the market. And we'll want to make sure that we're sort of drawing that into our framework as well as we can. So there's going to be quite a big lift of consultation in the next few months again, and probably into some years, I suspect. This is a long phased approach that the Treasury is setting out. But we very much see this as a partnership, and we do very much want to make sure we find that balance, the balance between good risk regulation and the right outcomes, and also making sure that we're supporting this new and innovative world.
Absolutely, and just staying in the UK for a minute longer, I think one of the prominent issues that's top of mind this week is the forthcoming introduction of the financial promotions regime in the UK. I think we're just a few days away here. What are some of the key things for our attendees to bear in mind?
Yes, so the FinProms rules, as we refer to them, financial promotion rules, are an important step change. They do bring in the same minimum standards for crypto as for other high-risk investments. And we really think that's important for the retail buyers to understand what they're buying and what the risks they're getting involved with are. So as of the 8th of October, just a few days away, legislative change will mean that all crypto ads will need to be approved by an authorized or registered firm. But we do understand that there are some firms who may need some flexibility. So our rules around promotions, for those firms who do need that flexibility, please come and talk to us and we may be able to extend some flexibility to you to the new year. But we do think this is an important step change for the crypto world to somewhat come to terms with the fact that you have to fall within the UK regime on this particular aspect. I did also want to mention the travel rule very quickly. We are one of the first wave of regulators to bring forward the travel rule. We're very keen that firms understand and adhere to it. It's obviously an important change that will help us understand the risks and the transparency around crypto. So another important piece of the legislative framework. The third that's also perhaps worth the mention, sorry, I'm slightly hijacking your question, is the stablecoin regime, which sits somewhat to the side. It's obviously been consulted on back in 2022. It will bring forward changes to the e-money regulation and also to the payment services regulation for stable coins that are being used for payments in the UK. So that will be an important extra limb of the regime. So whilst I talk about the wider regime on the wholesale side, there are actually quite a few pieces of regime coming forward somewhat sooner.
Thank you for that. And I think you mentioned the travel rule, and I think one of the issues we have here, with the industry as a whole is the global nature of digital asset markets. I'm curious from the perspective of the FCA, how do you reconcile your domestic regulatory approach with an asset class that is by definition cross-border, and how do you cooperate with other regulators as well as in finding that balance?
It's a terrific question, and one we face in TradFi as well, though to a lesser degree because the mobility of crypto is so much higher. It's absolutely fair to recognize that different legislation and different regulators come from a different start point. We all have our own, some very old regulation, old legislative ways of doing things. But the principle of regulatory outcomes allows for us all to be pulling in the same direction. It doesn't have to be exactly the same word-for-word rule to achieve the same regulatory outcome. So we've been working very closely in the IOSCO context as part of the FinTech Task Force, and we're a leading author on the principles that were consulted on earlier in the year, which do set out for regulators what are the outcomes that we should all be seeking and pushing towards. That consultation is now closed, and we're looking forward to working closely with our partners in that to make sure that we get to a well-understood common set of outcomes that we're all aiming at, which will enable firms to be able to operate across different jurisdictions, knowing that the end outcome we're trying to reach is the same. And hopefully that will allow for that mobility of the product as well as the people, such that there aren't these great big cliff edges between different jurisdictions. We do see that as an important part of a regime, important part of global markets generally nowadays. So certainly the IOSCO work we see is very integral, but that's on sort of the overlay of a lot of discussion at international layers, understanding where our peers are, talking to different regulators, understanding their perspectives, and really just keeping that dialogue going, which is something that we care very much about at the FCA. I should also put a mention in for the Financial Stability Board. They also have an interest in the crypto market, obviously from their perspective of financial stability, and that's an important piece of work as well that we keep on track of. So at the international level, I would say there is a general understanding across the regulatory community. This is something where we do need to be coming from a common base, and that is very much the objective we're trying to aim for.
Great. And as we move toward the FSMA regulatory model here in the UK, how would you summarize your expectations of UK participants as we approach more clarity there?
So I'm not going to go and wade through all the detail of FSMA. You'll be relieved to hear. I could talk for hours about how we manage conflicts of interest. I think it's important to perhaps come back to that point that was made in the previous panel and the point I mentioned at the top of this conversation. A lot of what crypto does is very similar to what happens in traditional finance. There's a lot of the same risks. There's a lot of the same kind of behaviors that we need to manage for. They may evolve in slightly different ways, and I'll come back to some of the slightly different challenges here. But through my experience in traditional finance, and I am old enough to have remembered the global financial crisis, I'm sad to say, that there has been a lot of lessons learned. We now have a clearer vision of both what those challenges are and where risks can bubble up, particularly from concentration risk, but also understand that there is the need for balance. Sorry, again, the word balance, but it comes up again and again. So when we talk about conflicts of interest, we understand that firms do have their own commercial interests at heart, but we also need them to find a way to address that conflict of interest when it could cause harm. The FCA's principles are very much still at the heart of any regime we're going to be designing. So that's the protecting the market integrity. So just to unpack that a bit, because it sounds like a phrase that doesn't mean very much, but it's a market that you can trust, a market where it operates with rules you understand, that you understand you're going to get a fair deal in this market. That's really important to me and very important to my department because we deal so much with the capital market space. The consumer protection angle is also hugely important in retail, but it also pins, as I said, there isn't that bright line between the wholesale and retail markets in crypto as you perhaps do see more in the traditional finance market. So we need to make sure that our regime doesn't create a leakage of risk into the consumers. And obviously competition remains one of our strategy objectives as well. We're there to promote competition, and that's about creating level playing fields and making sure that everyone is operating without barriers to entry. On top of that, though, we have very recently, and I'm sure some of you have been following the press around the Financial Services and Markets Act, it gave us a secondary objective, international growth and competitiveness. And we are interpreting that at the moment. There's still some work going on in the FCA, exactly how that will impact us. But one of the key parts of that is around the support for innovation. I think it was mentioned in the introduction about how we've always been quite forward-leaning with regards to innovation. The sandbox has been an important part of our agenda. So we see a lot of what we do now from the FISMA framework being very, very closely applicable to crypto. Having said that, crypto does have some differences, some important differences. The post-trade space particularly is quite unique, novel, could create some additional risks. We'll need to think about that. The products themselves, some look very close to traditional finance, some look very different. We will need to understand all of those risks and spend some time working out how we get to the right outcomes there. So we will probably start from rules and outcomes we understand, but we will not be hidebound to them. We will look at whether they apply properly, and this comes back to where we were just talking about the need to engage well with the industry. We're going to want to understand, does this work? Does this actually get to the outcome we're seeking? Do you think that could create an unintended consequence? How can we perhaps nuance some of these rules to make sure they work most effectively? So I think there's a lot in what we've already thought about in FISMA that I think is really valuable, that there's a lot of risks, business model risks, managing transparency versus price formation versus the difficulties of people not wanting to reveal positioning, distinctions between intermediation and the more traditional venues. These are fascinating questions, but they are not perhaps inherently new to crypto. These are questions we've dealt with and thought about in the past, and we'll continue to deal with and think about in traditional finance and apply that understanding and knowledge in the crypto space as well. So a lot of exploration, a lot of careful questioning, and hopefully, I hope from this audience, a lot of engagement.
Thank you so much for that. And I think, you know, we've spoken obviously about the balance of risk and innovation, and I'd love to just dive down into the details. We just have a couple of minutes here left. You know, what's one risk or issue that you are particularly focused on at the moment? And on the innovation side, what's an opportunity for the market that you're excited about?
So I'm under sort of my usual hat of I have to talk about risk first because I am a regulator and I must talk about it. There are parts of what is still an unregulated market that do worry me. And I do think our message has been super clear about anyone investing in this market is probably doing so at their own risk and should be prepared to lose all or at least some of their money at that point. This is still a very risky asset class. It hasn't entirely matured. Having got that massive risk warning out the way, I can now put my happy face back on and talk about how excited I am about this idea of the new technology and where it could take us. I think there's huge opportunities for efficiency. I'm genuinely excited to see perhaps the disruptive effect of that, to see what challenges that poses, to see where the industry itself takes some of those use cases. The area I have got a particular interest in is the tokenization part of the market. I know that can mean a lot of things to a lot of people, so I'll maybe narrow it down to the way I use it, which is very much about how we take what we would regard as the traditional security instruments and how you can represent them in the DLT, how that could change how trading and settlement and clearing and how that whole process could be revolutionized. I think there's a lot of good in that. I think we need to see more testing and we need to understand where the barriers are, both regulatory and practical. But I think that's an exciting time to be in a market. It does feel a little bit like the time when you've moved from having an iPod to having a streaming service. And I think that's a really exciting moment for the industry to be working through and for us to be part of. The piece of this that, and to just sort of join a few dots, I actually run alongside the bank and in partnership with the Treasury, the Digital Security Sandbox. So this is not our traditional Innovate sandbox. It's specifically being set up to allow infrastructure to test a new rule set that would allow it to do new things with digital securities. Now, it's going to be set up, hopefully opening at end of Q1 next year. It's a completely new way of us making regulation. In the past, we have tended to wait for activity to come along and regulate it, and for that to be the sort of, it's here, and now these are the rules. This is a much more iterative process. We expect it to be a learning curve, and it's a really interesting way of making regulation. So as a nerdy regulator, that in itself is exciting. But the functionality that this particular sandbox will have, I think, will speak to a lot of people in this room about it is there to try out the ideas people have talked about a lot and that we've seen some use cases for. But now there is a place where you can do that and do it perhaps safely and with that regulatory clarity around it as well. So for me, that's one that I'm really excited about in a really, really overly excitable way.
Well, thank you so much for that. I think all of us are in this room because we're all pretty excited for the future of digital assets after a challenging year for the industry. So really appreciate you taking the time to come and share your thoughts with us today. It's been an absolute pleasure.
It's been delightful. Thank you very much for having me.
To Helen from the FCA and Alyssa for that discussion. We are now going to cut to a much needed caffeine break. But when we come back on this stage at 12 p.m., we're going to have a couple of panels where TradFi are going to be giving their outlook for the market. And then downstairs in the vaults, we're going to have a couple of sessions that are going to explore regulation and also DeFi. Please take this time to go and explore some of the booths. We've got some fantastic exhibitors with us today. And thank you again to our sponsors. I'll see you after that caffeine hit. Ladies and gentlemen, the sessions both on the vaults and market stages will be beginning in 5 minutes. The sessions on both the markets and the vault stages will begin in 5 minutes. This is a reminder to let everyone know who is registered for a roundtable session that they will begin in the vaults at 12:25. That's the roundtable sessions in the vaults at 12:25. Please make your way to the vaults and market stages. The next sessions are about to begin. Please make your way to the markets and vault stages. The next sessions are about to begin.
my way. It's clearer in my mind with every song that plays. That I wanna get to know you better. I just wanna know your heart. We can tear it up together. Everything we do is art. And when the stars come out, we can be ourselves. Only when we dance in the dark, in the dark. With the lights down low, we can be who we are, who we are. In the dark. And when the stars come out, we can be ourselves.
Welcome back from the coffee break. Just to let you all know, if you do want to head to the Vault stage, there's going to be a panel on how to harmonize digital asset regulation. If anyone actually has the answer to that million-dollar question, I would seriously like to know. Coming back over to this stage, though, we're actually going to start by looking at the institutional side of things and that sort of TradFi perspective and the outlook for digital assets market. I think many institutions have been eyeing blockchain technology, not least because of the cost savings, the efficiency gains that you can get from employing this technology. But also, real-time settlement can be really significant here because it would allow us to actually understand or have a better perspective on what the risk profile of global capital markets could really look like. And I think that's a really interesting value proposition. So to give us their outlook on how their companies are shaping the digital assets landscape, we have joining us Tyrone from Onyx Digital, which is obviously part of JP Morgan. We have Mark from Wilshire Indexes, Tony from NASDAQ, and this will be expertly moderated by Philip from the FT, whose beat has been market infrastructure for quite some time now. So please join me in welcoming the panelists to the stage.
Hello, everybody. Welcome to the panel. We've already done the introductions, so I'm actually going to go straight in with questions to our very knowledgeable panelists here. We're looking at how institutions are shaping the crypto world, digital asset world now. From my very far distance, it looks as if institutional investment and institutional interest has never been as high as it is now. Increasingly, the institutions big institutions are looking at wanting to get in, perhaps a little bit uncertain about some of the infrastructure that has been built up to now and want to build their own. Let's start with that point. Tyrone, is that really how you kind of see the market now? That institutional interest has never been so high, and in what ways are people actually now getting into this market?
I mean, I think it is definitely high. I don't know if it's never been this high. I remember back to 2015 and 2016 when it was all hype, and everyone was trying to do a blockchain POC and trying to get marketing around it. I think the key difference now, though, is the work that is actually taking place is real. Mm-hmm. We're well beyond just doing proofs of concepts and trying to understand the technology and what it can do. We're now building businesses around it. I mean, Onyx within JP Morgan is a business unit of JP Morgan, right? We have commercial goals. The entire purpose of it is to create products for not only JP Morgan, but also for our clients. And we have real products in the market that are generating real revenue and real cost savings. So yes, the interest is high. I think the other difference now is the landscape has changed somewhat. Obviously there's the pre-FTX, post-FTX world. Obviously, ironically, today is the day that Sam Bankman-Fried's court case begins. And I think what has sort of come to light clearly, very clearly, over the past 9 or so months is the need for that segregation of roles and responsibilities within the broader ecosystem. And so I think that's clearly a big focus that obviously traditional financial services have, but I think more and more in the crypto native space as well now.
Well, what are we talking about here when we say that shaping the digital world? On the one hand, you've got what you might call the traditional crypto world. The big story at the moment that everyone is wanting to know is BlackRock going to get a spot Bitcoin ETF? Big traditional player looking to get into one of the oldest token, an exposure to the oldest token. At the same time, you've got JP Morgan, which is what you're looking at is effectively digitization of traditional assets here. Two slightly different things, I would argue.
They are. I mean, obviously, one of the things that has happened over the past, I guess, number of years, 5 years or so, is the emergence of crypto as an asset class. Mm-hmm. I think that if you look at something like Bitcoin, that's probably at least from my perspective, found product market fit in terms of what it's trying to be. Mm-hmm. Now, I don't think it is the payment system that it was originally proposed back when the white paper was released. But it is still an emerging asset class, and so you do have large asset managers who are looking at it as a way of allocating into it. Mm-hmm. A lot of our focus right now is on, as you said, the traditional assets. I mean, these are multi-trillion-dollar markets that we think are really ripe for improving. I don't want to say disrupting because there's a lot of infrastructure that exists today for valid purposes and reasons, but there is also equally a lot of inefficiency. And so our focus is really on how do we improve the traditional markets, but more importantly than just improving the traditional markets, actually creating new products, those new assets that people can now start to get access to.
Well, let's take those two pathways in turn. Mark, let's start with what you might call the institutions looking at what you might call the traditional markets. That, I mentioned the BlackRock and the ETF. You get the sense that actually institutions really want to trade traditional tokens as an asset class in their own right, but don't like a lot of the infrastructure, the architecture that's been built on it up to now. Not very keen on putting your money with a bunch of 30-year-olds sat on beanbags who mix up the corporate and the personal account.
Well, there's a number of things in there. We're going through an evolution, and that evolution is this: how do we start to use these new digital technologies and blockchain to, first of all, provide a more efficient structure for traditional finance? And institutional investors have started that process. So, if you look at BlackRock, they're already starting to use blockchain where it's efficient to do so. So are other, large institutional fund managers. And there's a number out there who are leading the way. Wisdom Tree, a number of doing that. But if we then think about the sort of tokens and coins, I don't think they are an asset class in their own right, or they won't be in the future. I think some digital assets will become part of what we describe as alternatives, and some tokenization will replace existing forms of trading existing asset classes. A bond is still a bond, whether it's in token form or in its traditional form. But I think we're going to see an evolution, and I think that's going to happen at a faster and faster pace. And the traditional finance that we all know, those rules haven't changed. What we now need to do is get the data, the system, the analytics that enables traditional finance to start being applied to digital assets in all forms.
But you don't see Bitcoin or Ethereum as a kind of a tradable class in its own right, in the same way that.
No, I think they're already becoming part of the alternatives world.
Right.
But I do see tokenization that will expand what we can view and currently trading in terms of alternatives, but also fixed income, equities that currently trade on public markets in security form, they will get traded in token form. It's only a matter of time.
Mm-hmm. Tony, when you're having conversations with clients, where do they sit on this this issue? Traditional, might call it traditional crypto assets, as a tradable class or a stepping stone to something else?
I think I see it as a mix. It's there are some clients who, and it is kind of very much split, right? There are some clients who are kind of very focused on kind of these, especially crypto natives, focus on this as a new alternative asset class, right? And then particularly on the traditional players, there is the kind of that investigation of how can we use this technology to kind of make it what we're doing more efficient, and that's one aspect. It is kind of interesting. I talked to a lot of these kind of like the crypto natives, and it's interesting. I think there is quite a few things that ourselves NASDAQ as a more kind of institutional, traditional player can bring to a lot of these crypto native firms. Yeah. Right. So we talked to quite a few of them, and I mean they're focused on kind of growing this as an asset class, right? And that is their core focus. For us, I mean, from some things that we can bring to support, we feel is kind of two aspects. So one is from a tech perspective, right? Because we've been doing this at scale for quite a while, we kind of really bring that focus upon kind of resiliency and scaling. Right. And this is kind of one of the things that kind of a lot of firms, kind of as they kind of grow this asset class, that they're very focused on that growth aspect, and then that resiliency aspect, the scaling aspect has come second. Right, and then one thing which I think is kind of really kind of being a big topic these days is kind of that kind of compliance regulatory aspect. Right. And this is, I think, going to be kind of really kind of top of mind to a lot of these players. I think in both worlds. I think in the world where we're talking about tokenization, there is already an existing kind of very thorough understanding, right? But in this kind of more kind of alternative asset kind of growing this asset class world, there is kind of still kind of like a learning phase in terms of how do we kind of grow this asset, but achieve compliance, be on the right side of regulators.
Can I just jump in with 2 points here quickly? So from my perspective, when I think about the client conversations that I have, and this might just be a function of the seat that I'm in, but 99.9% of conversations are around tokenized assets as opposed to crypto. Right. It is a huge conversation around how to bring traditional assets on-chain. And when you look at the activity that has actually happened over the past year, you have almost every global bank, broker-dealer, or asset manager doing something either on a permission blockchain or on a public blockchain. And they're still early, you can probably call them experiments, they're pilots. But the intention is very clearly there. This is a technology that people think can actually be that catalyst for how it can be disrupted, how it can be changed, which is clearly what we're trying to talk about here. But the one thing that you sort of mentioned, which I have a slightly different take on, which is I think you said large institutions don't like the technology that's being built. I would disagree. I think that large institutions are very enamored by the technology, and I think that there are a lot of very strong characteristics about it. There's something about a public blockchain that is ever persistent, highly redundant, always available, where you can, at any point in time, through a DeFi pool, get a price for some asset. That's very interesting. I think some of the challenges are just around where the technology is at right now versus what regulated financial institutions need. Whether that's from an AML KYC perspective or a privacy perspective or even just scalability. But the actual technology itself is very interesting.
Yeah, I agree what you're saying in terms of the key challenge, right? I think from an institutional perspective, particularly for that use case, the big challenge is not necessarily the kind of application of technology itself, but how do we apply it and retain that compliance and regulatory compliance, right? And I think there's a much greater understanding right, of how important that step is, right, from an institutional perspective. And I think institutions are spending much more time on that step compared to some of our crypto native peers.
We're seeing that. I mean, but they've got to keep within the existing regulatory structure. So they're trying to use the technology, they're trying to tokenize, but keep within the existing regulatory structure. So in some ways, I think as regulation catches up, you know, that will enable this market to evolve further. And I think you're right, tokenization I think is the really big change, but it will take time. The current forms of sort of tokens and digital assets, people still want to understand that. They want to put that within a sort of traditional finance framework. So we've been asked, and we're delivering things like, you know, some of the taxonomy systems, so you can begin to understand, you know, where's the risks, where's the opportunities, how do I value these different technologies in a different way. So I think there's lots to do, and we're still, I think, at the beginning of this journey. But it's an exciting journey because I think it changes the financial world.
So many different ways with this, we can take this, so many questions coming to mind. Just to go back to something you said, Ty, just about, do customers ever say why they're not that interested in the conversation about trading traditional, what's it called, traditional crypto assets, the Bitcoins, the Ethers? I mean, one thought came to mind as well, maybe the a spot Bitcoin ETF won't actually be that big a deal after all. You know, why the interest in tokenization and not a sort of a trading of some sort of Bitcoin type product within the wrapper of a traditional financial infrastructure, something that somebody recognizes, an ETF or what have you?
Yeah, I mean, you know, to be clear, there is clearly interest. There is institutions who are, you know, specifically looking to allocate into crypto. I think two things. One is, it is clearly the case that with everything that happened in the crypto space over the past 12 months, there has been a reputational hit, and some clients just do not necessarily want to be involved right now. That's both because of the fact that there is a, you know, somewhat of a narrow view that maybe more of crypto, the crypto ecosystem is kind of sort of enabling fraud than what they initially wanted to believe. The other is that regulators are very, very cautious right now around crypto. And so specifically for regulated institutions, it's actually really hard to do anything in crypto. So that's the one sort of bucket, just in terms of, you know, what crypto is providing right now to clients. The other is sort of going back to the point that I made earlier, which is just the scale, right? I mean, the scale of of traditional securities versus crypto it's massive, and that is really where the opportunity is, both from a revenue perspective, but also from an efficiency perspective. So I think it's just, look, I don't really know how big the crypto market can ever really be. I think Bitcoin, the fact that it's sort of maybe more like a stable coin nowadays hasn't helped institutions wanting to allocate, because you know, the days of, you know, massive returns on Bitcoin are possibly behind us for a while at least. So it's not as interesting as a sort of, you know, an alpha generating product as maybe some, you know, early stage token products are, but then you have challenges with compliance and regulatory standing of those tokens. Whereas the traditional securities world is very well understood, right? The opportunity is well understood. So
I was going to say, look, I do think Bitcoin, you know, has a future, as I do think some other digital assets have a future. I think in the short term, there's a huge reputational risk, and I think that's causing everyone, and rightly so, to be nervous. But if Bitcoin provides diversification, it performs differently to equities and bonds, then it has a future, and that's important.
So we've already touched on the subject. Inevitably, regulation comes in. The fact that traditional securities, bonds, equities, what have you, have an entire rule book for each one, and you know, and not just a rule book, but a tried and tested way of trading, clearing, settling. Everybody knows what the way it works, and the digitization of that therefore becomes a more simpler thing to understand. Is that a crucial thing? The fact that framework of regulation is already there.
I think it's it's the exchanges themselves are part of the problem here, in that the functions they're carrying out go beyond what a traditional exchange today could do. So in other words, they're investing as well as, you know, they're acting as an infrastructure. And I think the regulators, when the regulators step in, separate these functions out and have that properly managed, I think you will find traditional exchanges will adopt this technology. I think they're already beginning to do that. So I think that will help enormously, and I think that will clean a lot of this up. I also think we've got a challenge in the sort of the back end, because you're going to go from a T+2, T+3 to a T+0 world. So a lot of that back office and clearing and settlement, that will disappear and will get replaced. And that, I think, will bring lots of opportunities to create new products, and I think that itself will be disruptive for the market.
Tony, you see your regulation is your day job. Mark mentioned, we just talked about how you know, the clarity that brings. Does the fact that European rules, say, you know, MiCA, the fact that that's actually out there, offer that sort of clarity, and is that the thing that people sort of need as well?
I think MiCA is a fantastic example. MiCA offers, I mean, it doesn't cover everything. I mean, DeFi being one of the notable kind of exclusions. But it offers significant increased clarity from a legislative angle in terms of what is expected and required, right? And there's also, even on the clarity, and you talked about the existing traditional markets, right? It draws upon a lot of the framework of existing markets. So from a kind of like, as you said, rule book, or from a compliance professional perspective, kind of MiCA provides kind of significantly more guidance than exists kind of in most other jurisdictions. So you're seeing what's happening in the States, right, with kind of much more aggressive kind of enforcement process from SEC and CFTC. You have kind of certain places where there exists license regimes, but it is kind of unclear kind of like how from a practical perspective, post-licensing, kind of some of the requirements may be. I think MiCA has that kind of framework. It is something that continues to be worked on. We're going to see kind of the additional requirements coming out later in the year, right? But what I believe is that additional clarity kind of gives firms kind of what they need to at least kind of know what to expect. And to kind of go back to Mark's point in terms of the separation, kind of one thing kind of MiCA does imply, and the OSCO papers recommendations earlier in the year also implied, is around this kind of separation of function. Right. And there is that, you could see that in certain regulators where there's a greater view of the kind of business function, right? And there's a greater view from a regulatory perspective, the focus that you are meeting the regulatory requirements of the business function or the product asset class type that you are trading or offering services upon. So if you transmit money, you're obviously needing a money transmitter license, you're holding kind of funds, custody, and those aspects. And
that's a wrapper again that people know and recognize.
Exactly, right? And then I think what you'll start seeing is a lot of these kind of firms start kind of breaking up is not the right word, but I think you'll see kind of firms kind of focus upon these specific functions.
Right. And the fact that you've got that clarity or regulatory clarity in the traditional market, will you always have that sort of catching up process going on in the crypto world? You said that MiCA is pretty good, but it leaves gaps. Will that always be the case with the nature of the traditional market?
I think that is the nature of regulation, just generally. Right? It always is a bit of a catch-up, right? So, and then we're seeing that even now with artificial intelligence and some of the kind of new legislation targeting artificial intelligence, that's also a bit of a catch-up as well.
But I think, so it's interesting because Phil, you're saying there is regulatory clarity for traditional assets, which is true. I think the interesting thing is that when you try and tokenize traditional assets and leverage a blockchain, there actually isn't regulatory clarity, right? It's not that we can just automatically default to the existing rules and regulations without any conversation with the regulators. typically what actually happens is, if we're looking to tokenize some asset, US Treasury, for example, or a money market fund, we have to have conversations with our regulators as to why introducing this new technology is not going to introduce risks. And so it's not the case that it's just blanket, go and do what you want, and the existing rules are going to cover you. We actually have to be very thoughtful about how we explain why the existing rules still apply and why just introducing a new technology should not actually matter. And I think that's where the conversation is sort of a little bit stuck right now, at least why things are maybe moving more slowly than what they otherwise could have, is because we have not yet got to the point where there is a general global understanding of the fact that if you are representing an asset on a new technology like a blockchain, that doesn't automatically mean that all of the regulations and rules go out the window. And so I think that we still have to get to this point where regulators are comfortable with this technology very broadly. And until we do get to that point, it's going to be slow steps along the way.
But some regulators view this as an opportunity. I mean, if we look at Hong Kong Stock Exchange, their regulators are viewing this as an opportunity. They've already authorised 2 digital exchanges. They're inviting institutions to come in and help guide them. They're certainly talking to index providers, asking for our views on what are the next steps. Singapore has made moves in this direction. We look at Germany, we look at Switzerland, look at Amsterdam. We've seen the first ETF on digital asset in Amsterdam in Europe, and that was Jacobi. So some regulators are seeing this as an opportunity, not just a threat.
And I 100% agree that. I talk to a lot of platforms, right? And they're looking at where they're looking to base. Right? And what comes up kind of very frequently in terms of how to decide where to base in Europe or elsewhere is the regulator. Is actually a key aspect of decision. And in terms of kind of what they see, one of the aspects, it's kind of like two parts in what they look for in a regulator. One is that they look for a regulator with a good reputation, right? Because a reputation actually is still very important to them. But secondly, they're looking for a regulator that they can speak to, right? That engages with them, right? So because, and this kind of goes back tied to some of the things you're saying, right? It is kind of like a back and forth explanation process, right? You need to kind of like, it's something that may not necessarily you read the rule book and you apply it to the letter. You do need to be engaged and say, this is what we're going to do from a technology perspective. These is what we feel the rules that we are, an asset class we comply with, and go through our discussion.
We've already touched on how institutions increasingly see tokenization as the big market opportunity here. This is really where it's going. Perhaps Tyrone, you might be best placed to answer this. I want to really get for anyone out there who's not really sure what this actually means. If you could, you guys at JP Morgan have kind of tokenized things within the fixed income market. Can you give us an example of something that you've tokenized, roughly how it works, and what that actually means for not just the bank itself, but also for the customers, the investors?
Yeah, I mean, I think maybe something that people don't necessarily appreciate is how much is actually happening today in traditional finance, firms like JP Morgan. So we have a platform called Untitled Digital Assets. It's a platform for tokenizing traditional assets, like US Treasuries, mortgage-backed securities, etc. We're doing between $1 to $2 billion every day of trading of traditional tokenized assets on this platform.
So it's a treasury?
US Treasury.
So if you take it, effectively you've got the treasury, you've got the security, and you've turned that into a token?
Yeah, tokenized representation of the US Treasury held at a tri-party agent, for example.
And that sits on a blockchain that's run by yourselves?
That's a managed service that we run. So we have a number of external clients on the platform: Goldman Sachs, DBS, BNP, a number of others who we haven't sort of been public about. Every participant on the network has their own node. Right now, it's a fully managed service that JP Morgan effectively manages. But each of these clients have access to tokenized assets, i.e. tokenized treasuries and tokenized cash.
So they're then trading the treasury on your via your blockchain.
Yeah, what they're actually doing is entering into a repurchase agreement.
Right.
So the use case and the thing that people want this specific product for is access to intraday liquidity.
Right.
So right now, JP Morgan and other banks have clients who access credit lines, right? So we have clients who come to JP Morgan. This is in the traditional world, not the blockchain world. And they want to borrow some amount of money during the day. And ordinarily, they would draw down on a credit line to be able to do that. For certain clients, from a regulatory perspective, that actually becomes costly because whilst that credit line is typically free to use, they have to prove to their regulators that in times of stress, and if JP Morgan had to withdraw that credit line, they can still meet their payments obligations. And so they have to hold assets on their own balance sheets to prove that they have reserves, which is a costly, costly process for them. And all they're trying to do here is access some sort of intraday liquidity. They need to go and make some payment intraday.
So even though the UST is on the blockchain, if they then purchase it, legally they do actually own the UST.
Yeah, but I guess the point here is right now the way that they're accessing this intraday liquidity outside of the blockchain product is through a traditional credit line that is unsecured.
Right.
What they now are able to do is enter into a secured financing arrangement, a repurchase agreement, where they put up collateral in the form of tokenized treasuries, and then they borrow against that. And they can be very, very specific about the length of time that they actually need to borrow those funds for. So they can borrow $1 billion for 3 hours, or $500 million for 5 hours, whatever the case is. And where this technology actually comes to the fore is we're able to use things like smart contracts that automate and ensure the delivery versus payment, the exchange of assets for cash at exactly the right time. We can be very precise with the trade terms that both parties are agreeing to. They both have visibility. There's actually no back office process here. The trade is the settlement. As soon as you've actually entered into the trade and you say, I'm going to trade at 9 o'clock and I'm going to settle at 3 o'clock in the afternoon, at 9 o'clock, the trade happens, the exchange of assets for cash happens, and at 3 o'clock, the reverse happens. And there's no middle office or back office processing, which is the sort of the reason why this is so interesting. Access to new products, access to cheaper liquidity, access to cheaper way of actually doing business.
Yeah, I can see how that works for JPM and its clients. You don't have to, potentially there are fewer back office people, there's less money at risk on the table while settlement taking place, access to liquidity for clients. But if every bank is doing that, what's the incentive? How do you actually kind of get everyone out of the silos? JP Morgan, maybe just for example, say Citi are doing it, say Goldman are doing it. Each one is running on their own separate little silo, for want of a better word.
Yep.
How do you turn that into a big market-wide change and not something that's just really good for the bank?
Yeah, and the name of the panel is how are financial institutions evolving the market infrastructure. This is one of the ways, in fact, perhaps not exactly the most efficient way, but you're exactly right. There is a recognition that being able to offer these types of products to clients is value add. And so you do have the situation right now where a number of banks are standing up their own platforms. And by the way, a lot of that is actually somewhat of a function of where the regulatory environment is right now. Banks like JP Morgan, as a US regulated, OCC regulated bank, we're actually not able to directly use public blockchains at this point in time. And so, permission
because you're not allowed to permission.
Yeah, I mean, we are able to, seek a non-objection to be able to do that, but you can imagine that's a fairly lengthy process. And so the permission blockchain environment right now is the thing that we have available to us. So, going back to your point, do you just end up with all of these siloed platforms? Somewhat, but not necessarily. A lot of banks and different players are leveraging common technologies like the Ethereum stack. So all of our work within Onyx is based on Ethereum. We have Ethereum sidechains effectively. Any contract that we write is an ERC, or a Solidity written contract that will be able to be deployed onto a public blockchain. But ultimately, what you are likely going to need is some sort of connectivity between these platforms, or some sort of broader, layer one that financial institutions can actually interact with.
But this is no different from the way markets have evolved in the past. If you think about it, the banks have always innovated, and they've always moved in and dealt with some of these issues and provided for those end investors and found ways around. If you think of international equities, started that way. Think of Forex, started that way. And then they've moved on to sort of public, either exchanges or platforms. So I think the same will happen here, that the banks are starting to provide a way for being able to, the end investor, institutional, to use these types of new technologies and instruments in a way which is beneficial.
But I mean, if I'm, if an equity is tokenized on a public blockchain, how would that affect me as an end investor? What could I see and do that I couldn't just buy the equity myself? If I buy the equity for growth or the dividend, or both. What could I get from a tokenized equity? I mean, the fixed income is one thing, but it'll always be a very wholesale institutional market. We'll talk about the equities market, which is a much broader audience.
Well, first of all, they'll get a wider range of instruments, but let's take an existing example. You take Wisdom Tree. They're providing token forms of some of their ETFs, and they're finding people who want to be able to hold the token rather than the underlying ETF. That's a benefit to them. Now, some of that may be convenience, or some of that may help them in terms of reducing their sort of custodian and other costs, but you're starting to see it evolve in that way.
Okay, to use Tony's phrase, does it scale? Okay, so you've got some people wanting to hold it as a token, but holding tokens means you're responsible, or you've got to find somebody to hold the damn thing.
Not necessarily. They're custodians who can help you with it.
Fair enough.
I mean, also, equities is probably not the right place to start, right? I mean, traditional stocks are probably not the thing that you want to start tokenizing, because they work pretty well, right? I mean, you have brokerage accounts, you get access to. If you're in a developing or developed market, it's fairly easy to get access to equities. I agree, ETFs, there's definitely optimization that can happen there. The interesting things are alternative investments, right? Getting, not quite democratizing access to alts, but improving the way that they're actually processed in the back end, which ultimately could actually improve access. And then you have these newer forms of products that might not be directly applicable to the retail investor, but are very applicable to institutional investors. Yeah. This intraday repo solution that I mentioned that we're doing at JP Morgan is one. Tokenizing money market fund shares, being able to post those as collateral is another. I mean, there are a number of different examples that are much more interesting than just tokenizing Apple stock, for example.
There's a good example in Singapore where there's a small group is actually buying private assets and then tokenizing them, and then those tokens are being traded and given access to investors into what would otherwise be, private market vehicles which may be closed to them. So there's lots of applications.
Tony, is that kind of where you see the market? Or is it you're nodding your head here? Huge, and that's huge, ETF marketplace.
Well, to go talk on the tokenization question that kind of Mark raised, I think there's another interesting aspect for the alternative platforms as well. Right, as I say, for equities, there's already kind of a very large, very efficient infrastructure, which Nasdaq's part of, right, for kind of buying and selling equities. Right, I think for a lot of these alternative assets, particularly these newer ones, that infrastructure is kind of much less mature, right? And some of these asset classes, from a size perspective, don't have that same size to be able to kind of scale that level of infrastructure that may be required. So what a lot of these kind of technologies could apply is eventually kind of, I'll talk about scaling from a scaling up perspective, but there's also scaling from a scaling down perspective, right? Provide the similar levels of efficiency, right, but for more niche kind of product and asset types.
Amazing. We're getting towards the end of here, but I want to ask everybody one final question. That's the same one. We talk about scale. Ultimately, the thing that will drive scale is demand. And is the demand there? And if so, what sort of timeframes are we looking at significant? That one will be able to see significant change in to use that dreaded word, disruption in the market? I mean, is the demand and what time scale?
My view is I think the demand is there, right? I think the application is going to be kind of fairly niche, at least initially, right? I think and my driver is from a regulatory perspective, right? I think from a regulatory perspective, the framework is still kind of catching up, it's still building out, right? I think as the framework evolves and grows over time, across kind of a broader set of jurisdictions, I would see kind of that kind of helping kind of like drive the eventual kind of growth, right? But that regulatory aspect at the moment is probably one of the kind of crimpers of growth in this area.
Yeah, I mean, I would say that there is definitely demand. If I look at our client pipeline, we're going to be at something like 20 to 25 clients on the platform by the end of next year. That's large banks, broker-dealers, global tier 1 firms who are looking to tokenize traditional assets or get access to tokenized products that have tokenized assets in them. So demand is clearly there, and I think that's because of a recognition that this technology can be really impactful and that it is coming. I mean, when we talk about how financial institutions are changing the market infrastructure, one thing is for sure is that it is changing, and it will be changed in probably multiple decades. I think that I've been doing this for almost 10 years now, and we're definitely not as far along as I thought we would be by this point in time. So I think that the timeline is elongated, but it's happening, and it will happen. I fully expect that definitely by the time I retire, everything will be on a blockchain, but that's some time away.
It would be nice to know that your career has been. But does that? I mean, if we're talking multiple decade time, I mean, is that just the natural evolution of markets?
Somewhat, but it needs a change. It needs a catalyst. I mean, you could argue that the dematerialization of shares was just a natural evolution of markets. Okay. Sure, but at the same time, here you have a technology that can fundamentally change the way that people are interacting within those markets, and I think that's the interesting thing.
The
final question
I
to
think
Mark.
a little bit quicker than multiple decades, but I think it will take time, and none of us know for sure. I think the first area we'll see widespread use of tokens, as already described, is in that alternative space, because it's going to expand the range of alternatives, and some niche areas where there's inefficiencies, it can address those inefficiencies. I think when it starts to move mainstream, I can see bonds moving onto tokens. I can see ETFs being the first equities really starting to move into tokenization. I think as ETFs move to tokenization, I think traditional exchanges will then start to provide blockchain technology for trading in this way, because they cannot afford not to. In the same way, BlackRock is getting involved in digital ETFs. Why? Because they can't afford not to. They can see it the future. None of us can say how long it will be, but we can see the future. I think as ETFs, more of ETFs start being listed in token form as well as the current form, as you get more use of those tokens, I think it's inevitable the main exchanges will start to get involved. As they do, we'll get a proper regulated environment, and then I think we'll see growth very quickly.
Yeah, and I'll comment on that since we're talking about exchanges.
Last one, because we're right at time.
That's very true. So from a NASDAQ perspective, we're providing technology, right, for, we may not be trading kind of a lot of crypto assets ourselves. We're providing technology to facilitate the activity across the entire kind of exchange platform lifecycle. Right? And that's our focus now. Right, where that will be eventually, I think that's a good guess.
But what's holding us all back is reputational risk. We're all nervous that because it's unregulated today, or the regulation is weak, that's holding us all back.
And we will have to leave it there on that note. Many thanks to everybody for listening. I hope you've all got something out of that. I certainly have. I'd like to thank Tony, to Tyrone, and to Mark for your thoughts. And have a good day, everybody. Thank you.
Okay, thank you.
Thank you, panelists, for that discussion. Question, how do you build institutional-grade DeFi? Well, if you want to understand what the answer to that is, head over to the Vault stage, because that's what they're going to be exploring now. In my opinion, there's no such thing as institutional grade, but that's just my 10 cents. OK, so back to this stage. We've touched on, in earlier sessions, around one of the biggest developments for institutional capital to move into this space in a meaningful way would be the approval of a Bitcoin ETF in the US. I would say about 90% of global investors are probably locked out of the digital assets market because of the lack of derivatives and structured products. In fact, few institutions can hold Bitcoin on their balance sheet because it's so capital intensive to do so. One figure that I've heard is that if you want to hold Bitcoin, you have to over-collateralize that by 1,250%. So that's just that gives you an indication of how capital intensive this really is. Equally, some people don't want to hold their own private keys to their wallet. So I think whilst the rest of the crypto market is waiting with bated breath to see if an ETF will be approved in the US, our next panel is going to explore the types of financial and structured products that are needed for the digital assets industry for more institutional adoption. So with us, we have Stephen from Market Vector Indexes, Martin from Jacoby Asset Management, Christoph from Numius, and this will be moderated by Eva, who is a top journalist who has written for some of the biggest financial publications in the world, including the FT, Bloomberg, and Wall Street Journal. Please join me in welcoming them to the stage.
Welcome, everybody. Good morning or good afternoon. I think we're running a bit late, so it's probably the afternoon. Before we start, I'd really like to encourage all of you to please use Slido and send us questions. We will try to answer some of your questions, but I'm sure you'll have your own ones, which we'd love to hear and hopefully answer at one stage. So please keep sending the questions whilst we talk. To get straight into it, I'd like to ask the panel to briefly introduce yourselves, what you do, what the company that you work for does, and whether the SEC giving a nod on a spot ETF, this is the easiest question you'll answer all day, whether it's going to be a positive or a negative for Bitcoin overall. Christoph.
I'll start with that, positive. Good afternoon, everybody. Thanks for joining us over lunchtime. My name is Christophe Doracel. I'm a managing director at Numius. We are a diversified crypto investment firm, active across venture, prop trading, hedge funds, and asset management. Our asset management arm is called Fortius. It's backed by Schroders. And we've recently launched our first two funds, fund of funds, and a long-only product as well.
Thank you. Martin?
So Martin Bednall, I'm the CEO of Jacoby Asset Management. We launched the first spot Bitcoin ETF in Europe last month, listed on Euronext Amsterdam. And so in terms of the question about a spot Bitcoin ETF in the US, I think it's going to be hugely positive. And that's because I think the SEC will probably approve all the applications at the same time. I don't think they're going to want to give anybody first mover advantage. And I think what that will mean is because BlackRock is there in the mix, and this behemoth, they will put a lot of their power behind it in terms of sales and distribution to really make sure that they get the sort of go-to ETF, the default ETF. And so so my background is I am ex-BlackRock, so I have some insight into this in the fact that when Vanguard came to Europe with their ETFs, there was comments internally at BlackRock made that they wanted to kill the baby in the bathwater. And so basically not allow Vanguard to get any AUM at all, even when they were, don't let them get anywhere. So I think they'll probably go with that same approach. And then if you've got the power of BlackRock promoting Bitcoin and digital assets, I think that has a major knock-on impact for other products, for other regulators to approve it, and just a real groundswell.
Thank you so much. Steve, can we come to you?
My name is Steven Schoenfeld. I head market vector indexes. We are headquartered in Germany and operate around the world. We have about $30 billion of licensed assets tracking our indexes. And we were a digital asset pioneer, launching our first crypto indexes way back in 2017, which is like 40 years ago in crypto years. We have very substantial capabilities in digital assets, a number of innovative products, and I look forward to speaking about those. We have more than 20 clients with products, including ETNs and ETFs on Bitcoin and Ethereum. As far as the approval in the US, I agree that it's very likely to be that all will be approved. I will disagree with my former colleague Martin. As much as BlackRock will try to crush the competition, it's going to be a very different environment because there's a good half dozen, maybe even 8 or 9 other firms deeply committed to tradable digital assets. They've all got applications in, and some are actually much closer to the crypto ecosystem than BlackRock. So I think BlackRock will be in for quite a fight, but that will still be very, very positive for the overall Bitcoin and crypto ecosystem. I think the AUM potential could double or triple the current amount of AUM in current Bitcoin products.
So, can I just add?
Please go on.
So I've been working in ETFs for over 15 years, and there's never seen so much anticipation around a product launch, around a product approval. So I think it just all leads itself. And yeah, I mean, what you say is right. There's, I don't know, what is it, 14 applications or something like that?
Oh, and by the way, BlackRock didn't exactly crush Vanguard in Europe either.
No, they didn't. They weren't successful, but they tried. The point was that they put the efforts behind it. And I think, having so many, people coming to market at the same time and having that battle and what BlackRock will try and do in that battle, I didn't say they'd be successful. I said what they will do is, put their efforts behind it. And I think there'll be enough to go around for plenty of them. But if I was a betting man, they will have the bulk of the AUM compared to.
What do you guys think about? Sorry to interrupt, but I'm really curious about the timing of the application. What was it? Because you had all these beautiful bull markets. There were better times, to put in an application for a spot ETF than when BlackRock actually went ahead. So what do you guys think about that? What's kind of driving that decision?
Well, I think that well, first of all, crypto markets as a whole. If you look 5 years, I don't know how long you guys have been in the crypto game, but if you look 5 years back, we would never have had a panel like this with this title. Okay, so crypto markets are maturing exponentially. I would say institutional investors are becoming more familiar with the asset class. So there's obviously demand from investors. But if you're an institutional investor, let's say you're an endowment or a pension fund that wants to put $2 billion into Bitcoin, up until recently, you would have to go through a crypto-native OTC desk, or even do something a little bit bespoke with a crypto hedge fund. So it's quite complicated. So this is really like a really good access play to be able to launch a spot, spot BTC product. The other thing is, I think maybe when it launches, things will be a little bit more nuanced than everybody's expecting because, the assets that we're seeing in what I would consider maybe an inferior product, the derivatives-based ETFs, that where investors are penalized by the futures role up to 8% per annum, on Bitcoin. We're going to see a shift of assets from that product over to the spot Bitcoin product. So overall, I think it's, as I said earlier, it's super positive. Maybe a little bit more nuanced than people expect, but as a whole for the industry, it's very bullish.
And any thoughts on the timing? You think it's to do with the sort of maturing of the institutional appetite? Any other thoughts from you guys?
So I think 2 weeks ago, I would have said 9 to 12 months away. This is for the US approval. But sitting here today, I'd say it's closer 3 to 6 months. For the first time, it was just last week, the SEC, instead of completely rejecting the whole list, they've actually asked for comments, which is a a marginal but significant improvement in the dialogue. There's also the Grayscale lawsuit, which the SEC lost, which means they're most likely going to have to allow the Grayscale, the GBTC, to be converted into an ETF. I don't think the SEC wants that to happen and then have the ETF filing still waiting. People should also remember the size of GBTC is over 20 billion, so that alone will be a huge contribution to the asset class. So if
there are no outflows.
Well, there could be, yes. Well, there will be outflows. People have been trapped in it, but they'd be outflows at NAV.
It's about 3%, right, of the
Yeah, and if I had $1 billion in GBTC that's charging 2%, I would also move it to the Van Eck Bitcoin ETF, which is going to charge 65 basis points. So either Grayscale's going to adjust their pricing, or they will have outflows, but it will be in the ETF ecosystem.
So I agree. The mood music has definitely changed, right? From through the loss of the Grayscale case and the Ripple case. And I think your question though was, why an application now? The timing of the application, not necessarily the timing of the approval. And BlackRock has very much changed its tune over the years of it being Bitcoin being an index for money laundering. I think Larry Fink said that. I'm not quite sure how many years ago. To now him saying it's a global asset, a form of digital gold. So that's taken some time to get there, and I'd say that BlackRock are very close to the regulators around the world as well. They have a big team in their regulatory arm and talk often to the regulators. So they must be getting soundings there. And so, again, that's an indication of the mood music changing and the SEC getting closer to approving one of these, because otherwise BlackRock wouldn't have bothered.
I think you raise a really good point there, because there's a big focus on BlackRock. You have to consider their connectivity. So you mentioned, they're close to the regulator, but also their connectivity across the investor space, speaking with endowments, pension funds, et cetera. They're going to be, if they manage to launch the ETF, the sort of go-to shop to, help these people on their journey. Yeah, no, but help these allocators on their initial journey into the asset class. So, I think that's, again, a really positive thing.
Do you guys worry at all about the whole kind of buy the rumor, sell the fact dynamic? It's one of those financial markets quirks, isn't it? That everyone, Martin, you mentioned that this is the most anticipated product launch probably in the ETF space. Are there any risks there that we are being a bit more bullish than the immediate aftermath, perhaps?
Well, I think the conversion of Grayscale is probably one of those where people might have felt trapped and want to get out. Do they move to Van Eck or another one, or do they just get out? Is a potential, that's a bearish factor. I think we've just got a challenge in terms of digital assets around the macro environment and the interest rate environment. In conversations, and I'm pretty new to this, so I'll hold my hand up that, but when conversations we've had with large institutions, they say things like, why would I go into a risky asset that I don't fully understand when I can get 5-6% in treasuries, right?
Treasury is
and so it's a huge hurdle as well. So there's absolute bullish signals, but there's still a bearish environment that the approval may be launched into.
Yeah, I was just going to say that I think it was yesterday that 10-year yields hit their highest since 2007, right? So that's not very bullish for a risk asset, for the risky assets.
But I think a lot more of this dynamic is going to be pure supply and demand. First of all, the excitement over Bitcoin futures, it happened at one of the peaks. We're now at minimum in a trough. And Bitcoin seems to have held very well, despite all the scandals that are being thrown at it, including FTX. But the sheer size of the US institutional market, financial advisor market, self-directed retail investors, it's enormous. And to have a product that will be accessible to them I'm not going to say it will move the price, but the assets will move into these products We've estimated, using some of the statistics that came from when the gold ETF was launched in 2004, if anything close to that occurs with Bitcoin and potentially Ethereum spot ETFs, this could be 150 to 200 billion of inflow into these products. That swamps.
In a year? Sorry, what's the time?
Yeah, over 3 years.
Over 3 years.
You know, it doesn't happen all at once. That's 3 to 4 times the size of the current product set for listed Bitcoin. So that will be very significant. With regard to yield, Bitcoin, like gold, doesn't have a yield, but Ethereum has rewards. We've recently introduced a staking reward index that is equivalent to a total return index in a bond. So it's inevitable that some of the ETF issuers will have a rate of return on a spot Ethereum. And other products will be developed, including hybrid products that combine crypto with fixed income so that there can be a yield, indexes that have timing. The ability of the ETF industry and the structured product industry to use their creativity to come up with solutions to what investors want is going to blossom. And I think that's what part of the anticipation is about as well.
I just want to add to that point on the current environment. I'm going to go a little bit off piece and talk beyond Bitcoin, maybe the crypto as an asset class on a broader level. I actually think right now it's a very healthy environment to be considering long-only exposure. We had a lot of exuberance in 2021, and after that, de-risking, deleveraging, the yield chasers have left the market, the highly speculative investors have left the market. If you look at Bitcoin, at the money, 3-month volatility, it's around in the low 30s. It's very low, so that's kind of akin to tech stocks. So the asset prices have stabilized, and now you're starting to see decorrelation between the different cryptos that are starting to behave more in line with their fundamentals. So when you're considering governance and operational metrics, etc. This environment as a whole, I think, personally, is a lot healthier than what we had even just 2 years ago for the long-only investor.
Where do you see appetite from professional investors, Christoph? Because you guys have a kind of range of products. I imagine the VC arm is not as active as it was a year ago. Yeah, well, to be honest, if you have dry powder, it's a good time to be a VC investor. It really depends on the investor's profile. For example, as I mentioned, we launched a fund of fund. This particular fund of fund invests in market-neutral crypto hedge funds. There are a lot of, this is kind of off topic, but there's a lot of alpha to exploit in crypto markets, and it's still available. And so some investors want market-neutral exposure. I think that for long-only investors, is kind of more in sync with today's theme. The landscape has changed substantially. We're talking about the grayscale product, and we know its structural deficiencies. Now you have over 1,000 long-only products. I think something like 180 billion AUM in these products. You can gain access to single assets, multi-assets, passive, active, liquid venture. So there's a lot of options out there for the long-only investor. So it really depends on their profile. Are there any particular areas that you've seen that were perhaps less active during when the times were good and more active now, when there are a little bit more of an obstacle course to navigate? Well, definitely just, if you start simply with long-only exposure, back in the day it was very difficult to gain exposure to Bitcoin. You had to face a bit of a shady exchange or deal with. You said shady, right? Shady, yeah. Deal with your own, your own custody. It's quite complicated, So the fact that you have these ETPs, and to be fair, the market, and Martin, I'm sure you know this, but the market is very fragmented. So you have ETPs, ETNs, ETFs, trusts, AMCs, so actively managed certificates, but you have choice. And in terms of activity, I'm seeing a lot of appetite, or growing appetite again, for liquid strategies, be it market neutral or long only. Very interesting, thank you. Let's talk a little bit about the landscape today, how institutional investors access digital markets and the appetite, perhaps the regional differences that you're seeing. Can you tell us where you're seeing new appetite from? You know, we know that hedge funds have been active for a while, family offices. Are you seeing some new cohorts coming into the market?
So the US is behind. We've heard this from several panels here today. But the US appetite, meaning institutional investors, particularly endowments and family offices. So I'm not talking about big public pension funds that are going to allocate 0.5% to crypto. They will be the last. But the family offices and the endowments are very interested. They're asking about products. And again, having spot ETFs will enable the whole product development ecosystem. There's a world of financial advisors who will create products based on these ETFs, multi-asset, et cetera. This will be the anchor for them. In Asia, you are seeing strong interest from institutions, and I think they may actually allocate. So even Asian
Even the pension funds, even
sovereign wealth funds are interested. So the key from my perspective, and we get requests for all sorts of exotic indexes, will be how to guide the allocation. And one of the ways to ease this institutional money in my opinion, will be multi-asset class benchmarks that include equities, fixed income, some alternatives, and some very conservative slice of crypto, which would be benchmarked to the same indexes that these products are launched on. That will make the decision easier for these institutions and for the consultants that advise them. And we look forward to working on this whole variety of allocation strategies.
Thank you, Martin.
And I think, so the US does have the fact that there is very limited product. I mean, Europe has had product around for a while, right? More so than the US. So whilst we're the first Bitcoin ETF, there are note structures, there are ETNs that have been in existence for a while. And my understanding is, the AUM that's come into those has mainly been from retail. A little bit institution, and as you say, it's more the family offices, the private banks, but it's not a lot of institutional money coming into these products. And so, that's what, as an industry, we all need to develop that, right? We need to work together as an industry to then bring that institutions and move up the ladder in the size of the institutions and the sophistications of the institutions. So, I've had a number of conversations, and the feedback I get is, we know we need to be doing something, but we just don't know what to do. We just don't know how to enter this space, because it's very different for them. The risk models, the way you trade, the way you hold the assets, that all needs to be developed over time. And just the investment case as well. Understanding the investment case for some of the digital assets, it's just, there's a long way to get that understanding out there.
Yeah, I think we need to be a little bit careful when we use the word institutional in crypto. When we're talking about active investors, today, for being transparent, active institutional investors in crypto tend to be high net worth individuals, family offices. It's not institutional in the TradFi sense of the term. We were just talking about this. And then I think the Bitcoin ETF will help accelerate things. And there are some pension funds and endowments that are active in crypto, but it could be much larger. So I think the ETF will be one of the key factors to unlock that wave of investment. When you're looking at different geographies, I would agree the US is on hold in terms of allocators and allocating to crypto and allocating to the space. Maybe the lack of product is one of the reasons. But in Asia, you do feel that they've been through, they kind of have a first mover experience and an advantage there. They've been through several cycles. They've been profitable in crypto. They've lost money. They've been burnt. They've made money again. So there's a little bit more experience there in Asia, and allocators are a bit more active.
Thank you, and I asked everyone on this panel not to say the word education, so thank you, all of you, for doing that. What I'd like to kind of briefly explore before we go to the audience questions is appetite for existing products, because there is a spot ETF in Canada. Martin, you mentioned ETNs and ETPs available in Europe. Why aren't they flying? What are the kind of issues that you think investors are currently struggling with? What is the a pitch to a pension fund who says, look, I tried on the VC side, look at what happened to that. The regulatory side is unclear. I don't even know where they're going to trade spot Bitcoin, with like all the questions around some existing platforms. So what are the kind of key issues that you think these investors will have to overcome to have perhaps a bigger appetite for these digital asset products?
I think reputation is been damaged. I still get comments like it's a Ponzi scheme, and Bitcoin's a Ponzi scheme, and and other things. So I think the reputation will need to be improved upon, and that's an understanding of what the issues were that have come up, and so you told me not to use the word education, but unfortunately that is what the larger institutions, they don't know what the assets are. They don't know how to evaluate them from a use case, from a risk management. They've seen the volatility and they just don't want to touch it. Whereas what they need to be told is actually Bitcoin digital assets are a great diversifier in your portfolio. A small allocation to digital assets within your portfolio, you need to look at it that way, not just as a standalone investment, and the benefits that the diversification bring to the risk-return profile of your overall investment portfolio.
Is there some research out there to prove this? Because I think a lot of the times, certainly in the past few years, Bitcoin actually moved very much correlated to some of the risk assets.
So there's two types of research. There's the research that is just focused on Bitcoin, and to prove that asset allocation benefit and diversification, a lot depends on your starting point. And as the peaks roll off, suddenly diversification doesn't work. One of the ways we've approached this is having multi-coin indexes, which also diversifies within crypto. Okay. So you get diversification within. We've also created classifications, 8 separate classifications within crypto, so it's almost like sub-asset classes. So we're using the language of institutional investment, of professional investment, to categorize cryptocurrencies. And I strongly believe that I'll try to say this without using the word education. I strongly believe that asset allocation research and seeing how crypto fits with other asset classes is going to be the key to unlock the large institutional investors. On your first question about why hasn't the existing products taken off, some of it has to do with market timing, some of it has to do with size of market. And the United States market is by far the largest market for financial assets. So when it opens up in the US, I believe it's going to have a real knock-on effect, positive knock-on effect in the rest of the world.
In terms of that, a crypto company called Bitwise in the US have done a good study in terms of the returns that, on a rolling annual basis, if you'd allocated Bitcoin to your portfolio 1, 2, 3, I think 4 up to 4%, and going back a long time. And so it's a rolling 12 months, not trying to take away just cherry picking the time period. And throughout the whole of the period that they studied, it was a positive. Adding Bitcoin would have had a positive outcome on the portfolio returns. So and we're doing our own independent study of that as well, because it's going to be one of my selling points to institutions, why they should be buying the ETF that we've launched.
I'm looking forward to reading that.
I just want to bounce off your point about the pension funds that got burnt last year investing in crypto. And you have to feel sorry for the person who was driving the digital asset effort internally, got his investment committee to approve an investment, and then went down the equity route, not the token route. So,
trying to keep it quite
safer, traditional. But we have to underline that had nothing to do with blockchain technology or crypto. It's human fraud. Okay, there's still stigma attached to those events, of course. I mean, they're quite recent, but there's also a lot of silver lining. And I've been in crypto since 2016, always on what you would, I guess, call the institutional side. I've known a lot of the custodian guys who are outside with booths from day one, and the dynamic has changed a lot. So they would have to call exchanges and convince exchanges to be on their networks, their off-exchange settlement networks. So it's pretty hard work. That dynamic has been completely flipped. Now it's the exchanges calling the custodians to get on these networks. And that's driven by the clients who will not trade on these exchanges unless they have off-exchange settlement. So that's a lot. Again, it's a lot healthier in terms of the environment to trade and get institutional investors involved. So counterparty risk was always one big question mark, and I think the events of last year actually have had quite a positive effect in accelerating the improvement in that space.
I guess my kind of question is, does that, you mentioned blockchain technology and that it was human fraud. I guess people could say that blockchain technology hasn't prevented human fraud. Isn't one of the selling points of blockchain technology is that you can make it more transparent, you can sort of create a safer and better and more equal marketplace. Do you think that there are sort of still questions around whether blockchain technology is a good thing overall, or that sort of conversation has split completely from crypto?
Well, blockchain technology is going to be applied to security settlement, to tracking art, to tracking, I don't know if there's still stamp collectors, but I believe they exist, but they will be tracked by stamps. I think there's one stamp collector in the audience that I know of. But it's going to improve efficiency and reduce friction. The fraud.
That's what everyone's waiting for, right?
Okay, the ability to still commit fraud with this is because there still have been unregulated parts of the industry. And the fact that a renowned author spent time with SBF and couldn't see anything wrong with his business model shows that it could exist whether 20 years ago or 25 years ago with Liar's Poker or now. So the technology will keep improving, whether it's blockchain or just computer power or the cloud. It's how regulation adopts to the new asset classes. The United States took a very negative approach toward crypto and said you either have to work within our structure or you're illegal, and that didn't really help matters. I think we're going to see a reevaluation of that pretty soon.
I mean, I think there's a better understanding of the technology of blockchain than there is of the crypto assets that, they're side by side. But I'd say people understand that blockchain as a technology has huge potential across a wide variety of industries, not just financial services. And then they move to crypto and digital assets. It's like, I'm not really sure what this is, though. What part does this play? And again, it's that.
That's
what I see in this.
Thank you. Let's turn to the audience questions. Thank you so much for sending them in. I mean, I guess this is going to be a resounding yes, but let's do it. Is the panel as excited for an Ethereum ETF as a Bitcoin one?
Yes.
I mean, look at them.
I'm very excited.
Yes.
Now, coming back to my earlier point about comparing physical spot ETFs to derivative-based ones, in some ways it's even more interesting for Ethereum because at the moment you have some products out there that are based on ETH, futures. They're penalized by the roll there, but also investors are not receiving the staking rewards. So the negative returns there can add up to about 9% per annum, which is quite substantial. So I think that on and beyond the investment case and the fact that maybe Ethereum has a broader potential in terms of the different industries it can cover, but I think in terms of if you look at it from a pure product perspective, a spot Ethereum ETF would be well received.
Yeah, I agree. I'm actually more excited about an Ethereum ETF for exactly the reason that Christoph mentioned. One, there's a possibility of a return, and another, which there will be a panel later this afternoon, I believe at the other stage, Ethereum has a higher ESG score or a lower carbon footprint than Bitcoin. And so as ESG starts being considered within the crypto space, even though it sounds almost oxymoronic, it is happening. Ethereum will play a key role in it.
And so, so the investment thesis is the interesting piece because it's very different to Bitcoin. So Bitcoin, it's a store of wealth argument, and sometimes that's difficult to get across. Whereas to traditional finance people, whereas Ethereum, that can earn money, right? That gets a staking reward, and then you're getting into the more, you can do discounted cash flow modeling and stuff like that, which is
it's kind of
more
more
what
familiar,
the traditional
right?
guys do, right?
Yeah.
I think Fidelity Digital Assets did a really good piece in terms of thinking about a framework of how you value, come up with valuation for Ethereum, which it's difficult to do, right, for Bitcoin.
For Bitcoin.
And just touching on the ESG angle, so we've addressed this in terms of our Bitcoin ETF, and the fact we've through buying renewable energy certificates, we've addressed the Scope 3 emissions of our fund and decarbonized the energy usage of the network that the fund is responsible for. So we've directly addressed that because that is an important issue, and Ethereum addressed it through changing to proof of stake. So yeah.
A quick follow-up question on this. Do you guys think that the approval will come at the same time, or will the Ethereum ETF be approved a bit later than the Bitcoin one?
Later.
Well,
later?
Later, maybe, because it depends. There's not as many filings now, but if the SEC decides to do a blanket approval, it just depends when people have put in their filings. If someone's had their filing in for 75 days, it might get approved. So it's either going to be just after or a tie.
I think regulators like to just take things easy, and they'll allow Bitcoin, and then they'll see how that goes. And I think they'll wait a bit before Ethereum. So we had the launch of Ethereum futures ETFs in the US yesterday. They did okay. There wasn't a sort of resounding demand for them, but as an ETF launch goes, actually pretty good. As crypto expectations are not so good, but I think it'll be a while after that. A good few months after before we see Ethereum.
Thank you,
Ethereum.
Christoph. Do you have any thoughts?
I agree.
You're good.
Yeah.
Great. Let's go to the next question, which is quite interesting. What do you think of VanEck's announcement that they will donate 10% of their ETH ETF profits into Protocol Guild, which is a fund to support Ethereum development contributors?
I think it's positive and smart. Supporting.
Is it a marketing tool?
Yeah, but it's could be weaved into the marketing message, but I think on and beyond that, it's actually quite a smart thing to do because supporting the ecosystem will only help grow interest in the space. Depending on what sort of projects are rolled out and the traction that they gain, it can also support the price and interest in the underlying ETF. So, yeah, no, I think it's a good thing.
Are you guys going to do this?
Well,
we'll have to now.
Just full disclosure, Market Vector is owned by VanEck, so even
So you think it's a great thing?
even if I wasn't favorably inclined to them, I know it's not just a marketing move because in the announcement, VanEck was very explicit in saying, just as traditional finance will now benefit from the work of DeFi and crypto, we want to give back. So I think it is really much more than a gesture. Is it also smart marketing? Absolutely. But VanEck also decided to price their Ethereum ETF lower than all the others that went out yesterday. So they really want to build the ecosystem. I know that from knowing the people involved in that.
Thank you.
Yeah.
Okay, so we've done that. Compass, FT, Coindex, and now MVIS have launched their ETH staking yield index. How issuers will manage ETP liquidity to use this yield due to queue to stake or unstake? Anyone has an answer to this?
I'll just speak from the index provider. Our staking reward index is designed to accommodate the slash rate. So in other words, it's a realistic return that should be fully investable, i.e. fully matchable by an ETF issuer. So we don't expect the first product that would track our staking reward total return index to have any problem because we're realistic about the rate.
Thank
you.
And
I would assume the other index providers did it as well as us, but I can't be sure.
We'll ask them.
Yes.
So the good thing here is that you can have a sort of total return index,
Yes.
which what people are used to, right? So
Yeah.
from an equity perspective, you've got the price return, and then the total return is the the dividend yield less tax on top. So here you can have you get into, again, more familiar sort of realm of TradFi. So doing a staked Ethereum index and therefore having the ETFs track that is just makes good sense.
It's easy to incorporate, I guess, into your current thinking, right?
Yeah.
Great. I think we've sort of touched on this, but let's go. Gold surged 350% after the first ETF approval. What's going to happen to Bitcoin? I think the audience would like a number. I don't know. Are you brave enough?
Yeah, it will go up between 0 and 350%. I'm 100% sure of that.
That's a very nice range.
Yeah.
We'll go with that.
Yeah. Any minus?
Or higher.
Good. So yeah, you see, I told you we're keen to answer your questions. And the last one we have from the audience is, what is the prospect for a multi-asset crypto ETF?
Well, that's 100% going to happen. So again, in Europe, you have multi-asset crypto notes, ETNs, today. There's definitely the proof of concept out there in Europe. And yeah, I think again, there'll be regulatory. The issues there of doing those is on the regulatory side.
Yeah.
What will the regulators allow? What do the exchanges allow? So I think my understanding is that the exchanges today in Europe, the top 10 is okay, but then they start to get concerned around liquidity. As an ETF provider, you have to look at liquidity. You've got to be able to, you've got to be able to come in and out in decent size every day, because potentially that's what's going to happen with an ETF. So that's the critical factor: is what's the liquidity of the underlying coins. And we have to look at volatility. We have to look at liquidity, because that's what regulators look at, and so we need to do that. But absolutely, they'll be here.
Yeah, you're confident, yeah.
No, just to add to that, I think it comes back to the diversified versus concentrated debate. Crypto is quite a unique market where 70% of the market cap is concentrated in BTC and ETH. But then you could think that's a pretty good proxy, but essentially you're missing out on a lot of the themes that are out there, and that will see, I think, quite important growth going forward. So a multi-asset crypto ETF, I think, is, again, the prospects for that are quite positive.
Yeah, I mean, ETFs are tools for people to invest in the marketplace, and they're meant to make life easy for people. And so you can't just offer a Bitcoin, Ethereum, a Solana, a Ripple, whatever it is. You've got to bring that together to make it nice and easy for them if they want the diversified exposure.
Yeah.
Well, we're going one step further in multi-asset indexes. So, of course, there's the logical gold plus Bitcoin, or multi-asset equity, fixed income, and crypto. But we're also exploring thematic indexes. So, for example, we have one of the world's most popular esports index that goes very well with metaverse-related coins. So we're going to look in the thematic space as well for this. I have no doubt that these indexes are going to be popular with issuers as the approvals start rolling.
Yeah.
Thank you. And we're going to just, I need to squeeze this question in. Just very briefly, guys, do you think that the crypto market structure as it is today ready for this spot ETF? Christoph? Does it need to change?
It is ready. It's fine.
It's ready.
I think it's ready, yeah.
There's liquidity.
Yeah. There's plenty of liquidity providers, traders trading this who are embedded in the ETF infrastructure.
And also the ecosystem for ETFs in the US will test it. Nobody's going to launch the ETF without the APs, market makers, going through the testing. The existence of futures will help as well. So it is ready, and bring it on.
Well, you heard it here first. We are ready. So please join me in thanking the panel, and thank you for not saying education. Thanks very much.
Only one.
Thank you.
Thank you, panelists. We are going to take a much-needed sustenance break now. Lunch is going to be served in the exhibition hall. You should have all been given a lunch token, which you can use to redeem against any of the street food vendors that are dotted around. When we come back, we're going to have a couple of really good sessions, which are focusing on probably one of the biggest buzzwords this year in crypto. And no, sadly, I'm not talking about the FTX court case, but I am, in fact, talking about tokenization. So we will see you at 2:30 for the next sessions. Ladies and gentlemen, the roundtables will shortly be starting in 10 minutes downstairs in the vaults, including the importance of infrastructure and market integrity in digital assets, the future of staking, crypto derivatives, tokenization, and how data is driving digital asset growth. Ladies and gentlemen, please make your way down to the vaults and to the market stage. The next sessions will begin in 2 minutes. The next sessions will begin in 2 minutes on the market stage and downstairs in the vaults. Please make your way to the markets and vault stages. The sessions are beginning now. Please make your way down to the vault stage and to the market stage where the sessions are beginning now. Okay, hi, welcome back after our lunch break. So, you may have heard this phrase, this is the year of tokenization. And also, if you've been in this business long enough, you might have heard that every single year since probably about 2018. However, this year kind of hits a little bit different. We're kind of in like a perfect storm of factors and elements that could actually possibly make this year the year of tokenization. For example, high-profile collapses like Celsius and FTX meant that if you're on-chain, there's been a flight to quality or the need for quality assets on the blockchain. Equally, there's been advancements in regulation that's driving institutional adoption, which we've heard on sessions earlier today. And this is manifested in the growth of different asset classes actually moving on-chain. So for example, we've seen the rise of US fixed income products now sits at about 660 billion. The tokenized gold market cap sits at more than 1 billion. It passed that in March this year. So this next panel is going to explain and discuss why the rise of real-world assets on-chain is attracting interest from traditional financial institutions. Now, this panel will be taking questions from the audience, so if you'd like to submit one, please use Slido to do so. So joining us now, we have Duncan from Aberdeen, Simon from Archax, Jürgen from Taurus, Morgan from Ava Labs, and this will be moderated by Emily, who is a journalist for Bloomberg. Please join me in welcoming them to the stage.
All right. Hi, everybody. Thank you for joining us on this panel. We're going to be talking about tokenization, real-world assets. I'm sure you had a great intro just now to all of that. I'm joined by some really great people, but I'll let them introduce themselves. How about you start, Duncan?
Sure. So I'm Duncan Moyer from Aberdeen. We're a global asset manager, and I lead the digital asset strategy of the company.
Good afternoon, everyone. Simon Barnby from Archax. Archax is an FCA-regulated digital asset exchange, broker, and custodian.
Such a booming voice. I'm Morgan Krupetsky. I run institutional business development at Avalabs. Avalabs is a for-profit software company building infrastructure and tooling to really drive forward the growth and adoption of the Avalanche blockchain.
Jürgen from Taurus. Hi, everyone. For those that don't know Taurus, we're an infrastructure provider for digital asset custody and tokenization. End-to-end, really, hosting nodes and so on. My role is on the partnership side, leading the strategy globally.
Great. To start off, I guess, for those who are in the room who may not be familiar, Morgan, do you want to give us a rundown of what you would define as tokenization, or define as a real-world asset, I guess, in this sense?
Sure. So, well, from a tokenization standpoint, you could just think about the idea of tokenizing something as creating a digital representation of it on a distributed ledger, often referred to as a blockchain. The assets that can be tokenized can be everything from financial assets like equities and fixed income, all the way to physical assets like commodities, wine, and even ideas and information like IP and digital identity and kind of everything in between. So the idea and the concept is pretty broad-based. When we talk with a lot of financial services institutions, in the first instance, it is kind of a focus on financial assets. And so far, the more crypto-native community's best term for it is RWAs, real-world assets, but that's generally what we're referring to.
Yeah, you were saying earlier you prefer off-chain assets.
Yeah, just because among like regulated buy and sell side institutions, and a lot of this audience probably knows RWAs refers to risk-weighted assets in the more traditional world, and so the idea doesn't necessarily resonate from like a label perspective, but generally we've been referring to the idea of tokenizing off-chain assets and kind of bringing them on-chain. And
we're quite lucky because we have two people here today who actually work together on tokenizing real-world assets from Archax and Aberdeen. Simon, from Archax's perspective, what do you think tokenization looks like right now? Where is the market at in its journey and the evolution of that?
Yeah, I mean, it's full disclosure. Aberdeen are an investor in Archex, and we're working together on several projects. But yeah, it's been an interesting journey because I think, as Katie touched on the way on her intro, every year has been, this is the year of tokenization. This is the year when asset tokenization is really going to take off, and clearly that year hasn't really come yet. But I think it is beginning to change now, and and I think actually the work we've done with Aberdeen and Aberdeen investing in us, and then work we're doing with other asset managers and large financial institutions just kind of shows that there is a change, there is some momentum building, and it feels like there is a shift. And I think every other year that people have talked about, this is the year of digital securities or security tokens or whatever they were called at the time. It was kind of more of a people willing that to be the case rather than any sign that it really was the case. The technology has been there for some time. It's just the real thing that was going to change was kind of institutional adoption, or a move from the institutional side of things to get involved in the tokenization space. And that takes time. As soon as institutions are involved, regulation kicks in, so you have to have clarity around regulation, at least in one jurisdiction where some traction can be gained. And institutions are slow moving because they're regulated entities and they have to be sure about what they're doing. So I think there is a genuine shift now. And actually fund tokenization, certainly from our perspective, I mean, we're kind of cross-asset. We're not aligned to any particular underlying asset for tokenization. But fund tokenization certainly seems, for us at the moment, to be one of the ones that's gaining real traction and momentum and seems to be a focus of interest institutionally right now. So.
And I mean, as an example of that, Duncan, why don't you tell us what you're doing at Aberdeen to wrap all this tokenization stuff into your business?
Yeah, so I guess we've been working on tokenization for a few years with Archex, so it has taken some time, and it's a bit of a phased approach, starting with Archex tokenizing their interests in our money market funds, and then being able to offer that externally, and then hopefully with more kind of products in the pipeline there, and then working towards a full I guess securitization, so for regulated tokenized securities on funds, which is a bit of a more complex operating model, so it takes a bit more time. You have to work with more traditional service providers to get that over the line, and that takes time. And then that then leads on to individual assets after that. So this is kind of the phased approach we have.
And where do you say you're at in your journey? Like, how much more do you think there is to go for Aberdeen and tokenization?
Oh, loads. I mean, look, we've got money market funds available, right? So there's just so much more. There's much more you can do. The tokenization part is the kind of like the easy bit. It's everything else around that, and you need to make. There's no good just tokenizing a ton of assets and then not thinking about the distribution channels. So there's so much more that needs to be done around the edges to make it, to kind of bring it to life. So we've got a long way to go.
And Jürgen, you were saying earlier about how the impact of the last 18 months has been quite drastic for some businesses. How have you seen demand from clients or clients coming to Taurus? How has that changed for you as a result?
Yeah, I mean, if I compare it to about 18 months ago, where everything we have seen most of the use cases from institutional clients, i.e. banks, was around crypto, staking, see how they can put together a business case as well and get approval for it internally. Really to a shift completely into the tokenization space, where you see probably 80%, 90% of the engagements or the discussions we're having now is around tokenization use cases. So custody aspect doesn't go away, but it's really the shift from, okay, let's look into the space, because there's really opportunity. I think Simon alluded to it. There is always kind of like this, coming up, because crypto went down, should we now focus on tokenization? And once the bull market kicks in, we go back again to crypto. I think what also changed is the environment on the interest side. Interest rates have gone up, which means discussions we're having around stable coins, deposit tokens with banks, that becomes more meaningful, because if you have, let's say, T+2 settlement, because there's obviously no DVP settlement, right? If it's T+2, you have a lot of liquidity trap. So in this cash, like putting that on chain, is something where if banks work through it, I think there is a efficiency gain to be had, and that's I think is a changer now as well, because other than that, tokenization was there before. It's just how can you find fit within the banks, and that's look, we're working with approximately 30 banking clients globally, and they see. So you mentioned funds. From our side, it can be equity, it can be debt. I think we don't have seen not a killer use case yet, but there is a lot of traction to it. Many of the things probably behind the scenes, and more announcements coming out. But there's absolutely that the technology behind it is not going to go away. And tokenization is a new means of really building up and building this out for next years to come.
Yeah. And Morgan, where would you say the demand for tokenization is coming from in terms of sectors? Is it coming from banks, asset managers? Is it coming from crypto? Like, where would you say that demand stems?
Well, I think there's a difference between the demand to operationalize it as a use case and the demand for the underlying asset. On the former, to what you were saying, you're getting large majority of not only the traditional institutions that we speak with, banks and asset managers, but also a lot of more kind of crypto native individual teams who have come from the financial services industry, now pursuing different types of asset tokenization protocols. We're seeing a lot of that. And we're seeing a lot of interest really kind of across the spectrum in terms of liquidity and types of assets. Generally speaking, in the first instance, either on cash and cash equivalents, and then on the other end of the spectrum, more alternative and illiquid assets, private equity, credit, infrastructure, and real estate. And that's, generally speaking, where a lot of the financial institutions are focused, largely because those are the most operationally intensive, least standardized assets that are set to benefit the most in the first instance from putting certain aspects around fund admin, reporting, accounting on chain. And that's therefore where a lot of people in the first instance are focused. When you talk about the demand for the underlying assets, I think that's a different story. And I think, and Duncan, we were talking about this the other day in terms of where the demand is coming for your tokenized money market funds. I think in the first instance, when you talk about more liquid assets, money market funds, T-bills, the go-to-market strategy for a lot of institutions and individual teams has been really focused on the more crypto-native community, DAOs and protocol treasuries. And I think that, there's certain kind of hurdles around that, which we can definitely kind of go into, but I think that's where we've seen the demand kind of pop up in the first instance. But I think generally speaking, when you're talking about demand, blockchain and tokenization is just a really boring but updated wrapper in terms of accessing a specific asset. So I think for a retail investor, accredited investor, or even qualified purchaser, the idea should be that they're being given access to a totally new and novel asset class that potentially they don't have access to otherwise with lower investment minimums. And tokenization and blockchain just happens to be the means by which they're able to access that thing. So again, a really boring concept, but it should be kind of like a gateway to enabling a lot of individual accredited investors in emerging markets to have access to things that potentially historically they haven't had access to.
And Duncan, would you say that's where you're trying to get to with Aberdeen and putting your projects on chain? Is it getting to retail or to those professional individuals?
Yeah, I would say anything from smaller institutional down, because it's not just the retail that miss out on the big opportunities in, let's say, private markets. If you look at even the multi-billion-dollar institutional investors, their private market allocations are generally very, very small, particularly if they're, let's say, an endowment or a public plan or an investor like that. So that there is a gap, I think, in the market that's not being met today. But that's not to say there aren't benefits for the largest institutional investors. I think if we talk about all these assets that are going to be tokenized, they got to come from somewhere. And it's the asset owners today are the big institutional investors. If they're going to tokenize and fractionalize their investments, they're going to get a liquidity benefit, but they're also going to expect a yield pickup, right, from those fractionalized investments. So there are opportunities across the spectrum of investor type. But yeah, this is the story. This is what we're in it for.
And Simon, how many kind of corporates are thinking about tokenization in this way? Are they thinking about doing things that aren't financial, things that are financial? What are you kind of seeing at Archax in terms of inbounds like that?
Yeah, I mean, I think it's a little bit split, and it goes a little bit back to what Morgan was saying. At the end of the day, this is just a new technology. You know, a security whose record of ownership is stored in a spreadsheet is pretty much the same as a security whose record of ownership is stored on a blockchain. It's just stored in a different place. So in some respects, there's nothing new. And taking traditional assets and creating digital representations of them, so what? Well, there's all sorts of benefits that can come from it, particularly efficiency gains. And you know, if you look at the equity marketplace, the post-trade world is hugely inefficient. There's lots of intermediaries. Everyone's got their own books and records. You end up lots of discrepancies. There's reconciliation. So the technology can deliver huge benefits of efficiency to existing traditional off-chain assets by bringing them on. And I think institutions are really interested in that because that will take some time to build traction. It'll take some regulations to evolve to realize some of the benefits, particularly in post-trade, but that's hugely exciting. Anything that saves institutions money is hugely exciting. And then you've got kind of the other side, which is the technology is also being used to create innovative new instruments. And Bitcoin was the first and great example of an innovative new instrument. But there's lots of others. I mean, for example, we're working on some regulated tokens, so they look like securities, they're regulated like securities, they have an ISIN code, but they give you direct exposure to ETH or other proof-of-stake yields. So I think there's a variety of things. I think for institutions to get interested in that sort of far end, the cryptocurrency side of things, those that are in are probably still in, but those that aren't in are not getting in yet because the market's been over the last 18 months it's been a roller coaster ride, and so people who aren't involved have taken a step back, and people who are involved are being pretty cautious. And you've got the left-hand end, which is kind of the efficiency gains and like the work we're doing with Aberdeen, Duncan Aberdeen on the money market fund, opening it up to a new potential investor base. That's hugely exciting and interesting. And then you've got that kind of middle ground, which is sort of giving crypto exposure through regulated instruments to institutions. That is interesting too, but it's probably only interesting initially to those that understand the crypto world, that can see the benefits that they want to get exposure to through a regulated instrument. So I think it depends on which part of the tokenization journey you're talking about, but there is institutional interest in each. It's just for different reasons for different institutional players.
Yeah, I mean, you acknowledged the period that we're in at the minute. In the last bear market, there was a big focus on blockchain, not Bitcoin. It was kind of the way that investors who were already in the market kind of rationalized away what was happening with prices and potential losses in that area. Is tokenization and real-world assets kind of the buzzword of this bear market, Jürgen? What do you think of that kind of development and this sudden focus on this area where there wasn't really a big focus before?
Yeah, maybe just one point to add to Simon's comments is about the inclusion and the expansion of investor base. I think it's especially important when you think about private markets. So we have done projects, and that's now Swiss specific, but we have done projects with companies that have a big community, want to build something new and want to raise some equity. Now, going out there, listing it somewhere in a stock exchange is very expensive, right? But you can reach your investors, you can get new investors by actually using tokenization as a means, going to a marketplace and doing the book running there. And they were able to raise quite a significant amount of money to fund their project. So I think there is a lot to it when you think through, and I think the more we move on, the more of those projects we will see. Depends on the countries as well, because some are more advanced when it comes to regulatory aspect. So that is one. To your other question around the tokenization side. I mean, an interesting thing that that we have seen is really, if you think about it, bull market, you have a lot of projects that are suddenly cropping up from everywhere. Everybody gets really excited about different things, money is being thrown at. When it comes to the bear market, many of these projects disappear again. But the ones that stay are the ones that initially, where the business case adds up. And now, talking about engagements we have with financial institutions, that some of them had to pivot as well. As I mentioned before, their business case was around crypto buy and hold and staking. At some point, top management said, sorry, we can't really support that anymore. The ones that looked at tokenization of assets, of funds, of debt, and so on, these ones, they still see them through. So even though we have a bear market, maybe the investments are not there, but these projects still get funding, and that's what we're working on, and that's what they're working through as well. So it's good to see. Look, as I said in the outset, it's not going to go away, and it's really, the technology is there to stay, because it makes things more efficient, and it's just about finding the right business case as well for it.
I mean, Morgan, what would you say to that, the idea of, when FTX collapsed, when everything was happening last summer, a lot of people came out of the woodwork saying, well, okay, so now it's time to build. We're going to spend this time building. Is this the fruition of that? Is this how we're seeing people build, and this is the next technology for bull markets to come?
So I started at Ava Labs 4 days before Terra happened. So my timing was impeccable. And before that, I worked at Citi for 12 years. And so I came into this role thinking, this is going to take forever in terms of pulling institutions along. I'm going to have to sit there and explain the merits of blockchain. And especially after FTX, I will say I've actually been extremely pleasantly surprised by how progressive those institutions who've become public about being progressive in this space, how despite the developments in the crypto market over the past 18 months, how they've continued to forge ahead with their initiatives, and do a lot of internal and external stakeholder education about how there is a difference between kind of the developments over the 18 months and the underlying capabilities of the technology. And why this is different, and maybe it might be a version of blockchain, not Bitcoin, but a lot of them are looking at it from a business-first perspective, where they think about their pain points in their day-to-day businesses, their strategic priorities, and kind of their client base and their core services, and then taking a use case-first approach to, can blockchain and tokenization / smart contract logic address these pain points and drive forward these business imperatives. So in that sense, I've been, again, extremely pleasantly surprised with how, despite everything that's been happening, we've been seeing these institutions forge ahead. And obviously, it doesn't take overnight, and a lot of them have been at it for many, many years now. But it's great to finally see things kind of coming to fruition. And I think part of the reason why, quote unquote, this time is different, there's a lot of reasons, but I think part of it is you're finally starting to see major C-suite executives from buy and sell side firms touting the future is tokenization, and really kind of driving the space forward in that sense. Plus, you have the advent of DeFi and all that brings from a composability and programmability perspective, which, despite the fact that tokenization isn't a new concept, the kind of capabilities of DeFi really kind of allowed people to kind of visualize greater utility over some of these assets on chain.
I mean, Simon, would you say that DeFi is something that traditional institutions are interested in? We've seen tokenization plays from banks like Citi, but it's been, tokenizing their own deposits, not necessarily been embracing everything that crypto is. How much of the trends at the minute that we see are really true crypto trends, or is it just versions of that banks are comfortable with?
Yeah, as with all these things, I think you have to define what you mean by DeFi. I mean, is DeFi distributed finance or decentralized finance? It's kind of, you have to define what the term is maybe. I mean, certainly I think in my mind, and I think also institutions is a pretty broad term, and it kind of gets used for everyone from an individual professional investor up to one of the large sort of global investment banks and everyone in between. And certainly at one end you've got the hedge funds and maybe people who have more control of money and can make operating in the alternative asset space, who will get involved in things earlier and try things out, and maybe kind of the DeFi world where we're seeing things like borrowing, lending, staking, yield, and all those things going on. I think that is of interest to that portion of the sort of institutional world. But at the other end, then it's so far away from a focus for them right now, and that's partly because of regulation. I think innovation is always ahead of regulation, and what's been happening in DeFi is hugely exciting and hugely innovative. But the regulator is yet to catch up, and I'm sure some things in DeFi probably should be regulated, and at some point the regulator will catch up and start to regulate them. Now I know there are people, in fact, we're doing it too. We're looking at DeFi and looking at how can we leverage some of those exciting pioneering things, but in a institutional regulated way. And I think when things like that begin to happen, then you'll get sort of a broader interest from this sort of the overall institutional world.
That's something actually, so we found that really resonates with a lot of our financial institutional partners of using DeFi applications, but in a way that facilitates traditional assets and kind of upgrading legacy infrastructure and institutional ways of working. So maybe forking some of the open source protocols out there and making them more institutional grade. It's something that we call on-chain finance or OnFi. Feel free to use that.
Not another one.
OnFi. But it's a way that I think a lot of institutions have kind of, for lack of a better term, wrapped their minds around. I can use this tech, but in a way that is still abiding by the laws, rules, and regulations that I need to, but in a way that still helps to create these efficiencies, unlock historically locked capital, collateral, all these things that you can actually use the tech for, but in the context of your traditional business.
I mean, so yeah, that kind of brings me to my next question. I think the big debate with tokenization is permissionless versus private chains. Mostly we've seen bigger institutions, traditional institutions, get involved in the private side of things. It's something that they can control. But we're now starting to see some move on to networks like Ethereum. I mean, Duncan at Aberdeen, where are you at in that level of comfort? Are you happy going fully permissionless, or is it still a journey for you?
Yeah, so we made a decision at the start when we started this that the future would be on public blockchain, and so we started working with Hedera Hashgraph, but it's a public permissioned deal. It's a DLT. So for us, that was the right mix of having giving the public part, giving the potential scale in the future, but having a governance framework that we felt would resonate really well with, our risk committees and board, and the groups that we were going to interact with. So that's the kind of area that we want to be in. But yeah, I mean, in the future, I think with the right safeguards, permissionless could be it. I would love to see our funds tokenized and traded through a DEX, because if you look at traditional finance, retail increasingly makes up a bigger proportion of assets traded, and I think that world, like decentralized exchanges, work very well with individual investors. And if you want to have the biggest scale and potential for your offerings, this is where we need that. That's an additional part of liquidity that will make it a reality. We just need to have the right kind of controls in place to make sure we can do it within regulation.
And I think also, if you think back to the post-trade space where we said there's all sorts of huge efficiency gains for the market as a whole, in the post-trade space, if everyone's got their siloed blockchain or their siloed permissioned owned technology, that's never going to happen. Unless you have some kind of common interoperable solution, you're not going to get those post-trade gains, which is what is quite exciting. So.
Yeah, I mean, Jürgen, how are you navigating those conversations?
Yeah, it's a bit like you don't want to have fragmentation of markets again, right? You fragment all the markets, you want to be inclusive, and yet you work in different pockets. How do we do that? Well, like from our perspective, we're agnostic to what clients want, but what we have seen from a client base is, yes, everybody starts off private, so it's good actually to hear from Duncan then that public was what they be a bit in a smaller framework, but that's what you want to go for. So the private side is what's predominantly there, but more and more looking into public blockchains as well. Just because, as time moves on, risk teams get more comfortable with it, compliance team gets more comfortable with it, and more importantly, regulators get more comfortable with it as well, right? This whole thing is an educational journey. You can't just change an industry it's a transformational journey, so you can't just change the industry by saying like, okay, this is the new world and that's how it is, because everyone else around you will say, no, we have done it that way and that has worked and that's true, and kind of like what we have seen in last year with many companies blowing up, just strengthens the position on the traditional side to say like, well, we did this since 100 years, why would we change something? And everybody runs around. So it takes time, but my sense is, and what we've seen, there will be a shift away from just doing own pockets of little POCs and little announcements to be more inclusive. And I think, look, that's my personal opinion, I think it's the right way to go, but it will take time. You can't just do it from one
I think part of that also is X amount of years ago, the only options were public permissionless and private permissioned and nothing in between. And over time, we've now seen hybrid solutions and chains come up that kind of offer the best of both. And in speaking with a lot of institutions, I think a lot of them, to your point, Duncan, foresee a target state in some way benefiting from public blockchain infrastructure and development, DeFi innovation, native integrations, but that doesn't necessarily mean that they can therefore obfuscate the laws, rules, and regulations that they're governed by. So now we have these hybrid solutions that enable them to kind of get the best of both in that way. And then in addition, there's multiple levels when you talk about permissioning, there's also multiple levels of permissioning. So just because you put a security on chain doesn't mean now you can't follow security, or doesn't have to follow securities laws. So you can still implement permissioning, whether at the wallet level, the token level, the blockchain level, multiple levels, to still kind of technologically manifest that kind of compliance, that compliance rule within the context of the on-chain asset, but in a way that still kind of follows broader public permissionless chains writ large.
And if we think about this from a crypto perspective, probably most of what we've been talking about now is trying to answer the questions for institutions in the traditional space. But if we think about it from the crypto perspective, a lot of what we've seen in tokenization is things like treasury management. Platforms like Maker buying up hundreds of billions of dollars in US treasuries, but tokenizing them so they're still accessible. I mean, if we get into another bull market and those yields that we saw last year in DeFi return, we've had a question on this from the audience, do you think that those opportunities for tokenization that we see now are going to fade in demand, or do you think they're going to remain? I mean, Simon, what do you think?
Well, I'd be interested to hear what Duncan thinks.
But
no, you come in a minute. Yeah, I mean, ultimately, I think all these different instruments always have a place. It's just sometimes one comes to the fore because of prevailing market conditions over others. So, there may be ebbs and flows around where the level of interest is. So, maybe as things change and the interest rates come down and the DeFi yield looks, really attractive again, maybe things will change. But it does come back to what we were saying earlier, is that, for institutions to get involved in DeFi, a lot has got to change. I mean, okay, for some, they're involved already, but for the mainstream institution, it's quite a challenge. I mean, Duncan, what do you think?
Yeah, are you going to be investing in DeFi protocols one day?
Maybe one day. But I mean, I work at an asset manager. I think probably within financial services, asset managers have kind of felt the rise in interest rates, the hardest. As investors want to move assets out of risk assets into money market funds, I guess largely in deposits, and I don't see why it would be any different in digital assets and in crypto. But in an efficient market, you should be able to provide that kind of those options for people to move in and out of these different opportunities.
I mean, Jürgen, where do you think tokenization is mostly running into obstacles at the minute? Is it regulation, like we're always hearing, or are there other obstacles that we haven't really considered yet?
Well, regulation is one side, but for some of the assets, I mean, there's structures in the traditional side as well, from a securities perspective, and many of these things can actually be translated over to the tokenization side. I mean, Germany has done that, Switzerland has done that, so you can take bits and pieces of that. I think what needs to be looked out for in the tokenization side is you need to see it holistically end-to-end for the lifecycle management, because it's not just you tokenize something and you put it on chain, but what are you doing with it, right? You need to create the liquidity, you need to create markets for it, you need to have a secondary market to trade it as well. That is all the things that actually should be at the forefront as well, and how do you build a smart context around it to call upon the different stages when you think about, shareholder votings, other, paying out dividends and so on. So, and this it comes more and more, but that hasn't really been taken into consideration. At least, when I look back, that's just not there. It was just about, we want to tokenize something, but why would you want to do that? Right? It's kind of like the thinking behind it.
And Morgan, how would you so that's one side of things, the market spread, trying to find liquidity for the markets of things that you're tokenizing. But you were mentioning earlier about real-world assets that you might tokenize that probably wouldn't fit into that bracket. Physical things like wine or art, or not all of it is kind of up for sale. Some of the time when you're tokenizing, it's for other purposes. What are the opportunities for those things being tokenized, and then what are the obstacles are they facing?
I mean, I think in general, by tokenizing things like wine, whiskey, other things, again, to the extent that it could be made like more of like a digitally native issuance, I think that's something that becomes like appealing for individual investors in terms of giving them an opportunity to invest in things that historically they haven't necessarily had direct access to. But I think whether you're talking about physical commodities or more traditional assets, I think one of the big challenges, again, is this question of distribution. I think a lot of initiatives initially started during the last crypto bull market, where I think a lot of people in the first instance thought just because you tokenize something, there's crypto capital that will inherently want to obviously buy this asset. And now that we're in a crypto bear market, people are realizing, that's not necessarily the case. So in my mind, the kind of exciting part of the Holy Grail is really when you're kind of on your Fidelity or your Schwab app and you're flipping through and you're seeing like equities, credit, and now you can invest in alts. And like that, in my mind, to the extent that you can kind of plug in a lot of these tokenization initiatives and projects into traditional Web 2, whatever you want to call it, distribution channels, that I think we'll start to really see kind of a pickup from a demand perspective, not because it's tokenized, but because it's a new asset class, whether it's wine or alts or whatever it is. But it's already integrated into forums and channels where people are already onboarded and already KYC'd, and they just now have a greater opportunity set from an investment perspective.
And I was just going to add, I think that's really important because there was a belief, and maybe there still is sometimes with people, that if you tokenize someone, suddenly it becomes really liquid.
Yeah.
And that's not the case. You can't magic up liquidity. But I think what tokenization can do, or what the technology can do, is unlock liquidity that's currently locked up. So you can kind of let things realize their natural liquidity where currently maybe you can't. But you can't just magic it up from anywhere.
Like a crappy asset is a crappy asset.
Well, yeah, whatever.
if you don't offer it, no one's going to have any. It needs to be there for people to buy it, right?
Yeah.
So.
Well, that's a good takeaway, I guess. We'll see what comes out in the next few years. Thanks for joining me, everybody.
Yeah.
Thanks.
Thank you very much.
Thanks.
Thank you.
Great panel. I'm a little bit biased for working in the tokenized sector myself, but anyway. Okay, so if ESG and crypto is your thing, then head over to the Vault stage now, where there's going to be a panel exploring the sustainable practices in the digital asset landscape. So the panel that we just heard now touched on sort of the macroeconomic factors and elements that are impacting or driving the impetus for tokenization. Now we're going to turn our heads as to how these same factors are actually impacting the digital asset sector. So there's been many investment theses for different coins. Is Bitcoin an inflation hedge? Does it behave more like a tech stock? And this next set of panelists are from companies that make up key components of the digital asset market. And they're going to discuss how global macro trends impact digital assets. And then I promise you that we will pause to hydrate for a coffee break afterwards. So also, this panel will be taking questions from the audience. So if you want to use Slido, you can submit your questions to them. So please welcome Mona from Tokenisation Investments, Johan from Wintermute, Nikita from Fasanara, and your moderator for this panel is James from Webben Group. If you could all give them a round of applause.
I guess who?
We'll go over there.
So afternoon, everyone. My name is James Newman. I run Global Business Development at Webben Group, which is the Alan Hard-backed incubator for Web3 and fintech innovation. Looking out there, I honestly can't think of a more timely topic than the intersection of crypto and macro. Over the last year, we've seen global central banks raise rates many percentage points. We've seen stubborn inflation, while regional bifurcation, fiscal uncertainty, and of course, upcoming elections next year create a vast amount of uncertainty out there. Clearly, timings around a central bank tilt are front and center of conversations both sides of the aisle, and we've seen Ethereum and Bitcoin rally this year before falling back to relatively subdued levels where we see them today. This backdrop creates a number of risks, but also opportunities, and one of the most interesting changes this year has been the crypto's decoupling and correlation from traditional assets. On the flip side, we've seen a number of institutions looking to adopt Web3, in particular around Bitcoin and Ethereum ETFs, further blurring the lines between digital and crypto markets. Now, there's a number of different places where we can kick this off, and I'm joined by a very esteemed group of individuals to my left. I'm expecting this to get quite lively, so I will pass over to Mona to make introductions.
Sure. Hi, everybody. My name is Mona. I am an investor at a venture capital fund called Tokenisation Investments. We're a German publicly listed VC on the German Stock Exchange, and we focus primarily on financial services, Web3 infrastructure investments, pre-seed to Series A.
Hello, everyone. My name is Nikita Fadeev. I'm part of Fastnara Capital, which is London-based hedge fund. I've been in operation for 12 years. Run about $4 billion in assets. I started the crypto effort 5 years ago, and so we have a couple of funds, but our flagship is a market neutral fund that we've been running for the past 5 years.
Cool. Johan speaking as such. So I am a co-founder at Wintermute. I overlap essentially venture and the BD side of the business. I've now officially moved to Singapore. So very happy after spending 12 years in London to come back here for a few weeks. We have grown to be the largest spot crypto market maker in the world. So we do about 16 to 20% of the volumes. We have a derivatives business that we run from Singapore that covers the rest of the world, but essentially that covers about 26 underlyings and covers a lot of OTC counterparties of the likes of family offices up to the $40, $50 billion hedge fund. We have a venture arm that has about 100 investments across the space, so purely on balance sheet. There's no LP capital, but that has about $100 million of deployed capital. And we're slowly iterating on new forms of incubation as such. So if you're building in a crypto space as such, don't hesitate to come to us for either investments or liquidity provision as such. Yeah, very happy to be here.
Brilliant. I think it's best to start quite broad. So, Johan, what do you think are the most important themes on the macro crypto side that you're paying attention to?
So, for background as such, so I used to, my previous ventures as such, and my first ever job and my last ever job before becoming an entrepreneur as such, was being a derivatives trader, so trading rates and into central bankers. I also blame Super Mario Draghi and Trichet and so on to actually keep me away from cryptos, because they would tend to give a lot of messaging that would sort of make it sound like it was impossible for Bitcoin to survive, which you knew that wouldn't be the case if you had read the white paper, which sadly happened to me a bit too late, of more 2017 when we started Wintermute. But the themes have been, I think the space have been quite sheltered from macro until about 2020, I would say. I think it was actually quite isolated from, let's say, the first ICO boom was essentially what I would like to call the Bitcoin wealth effect. So you had Bitcoin going up and a bit of Ethereum going up, and essentially people didn't have any fiat rails and couldn't put the money anywhere, and they just wanted to. We saw through that basically 2017 ICO boom, and I would pinpoint more the first macro, like the genuine impact of macro on the space in 2020 with the state balance sheet money printing from COVID essentially. With the first aspects of the downsides of macro impact and sort of like the financialization or the digitalization of the space, when you start to see the crypto assets essentially correlating with the rest of the financial markets. And it's often easy to describe how that happens. You end up with a hedge fund that just goes and buys some crypto. They also happen to be long equities. They also happen to be long oil. When the equities goes down and oil goes down, they have to take some losses, and they have to finance it. And even if crypto may still be up at the time, they'll have to sell it, and then, there's a bit of correlation that happens through that aspect. On the positive side, we've seen a lot of money printing that actually ended up flowing into cryptos at the end of 2020 and especially 2021. I don't know if you really put it as a macro factor, but essentially COVID and having a lot of traders at home helped a lot of fintechs and the overall Web 2 to Web 3 fintechs, and helped a lot of crypto exchanges and a lot of the space to be a lot more active. Nowadays, the grand scheme of things, as you mentioned in your introductions, well, interest rates as such, I think DeFi summer wouldn't really happen in the current rate environment. So I think there's a bit of like reshuffling about what we do in the space on that front. And and I think it's just I think on the plus side, crypto is very much seen as a new asset class, and we see that through our OTC business. So we've onboarded now more than 1,000 counterparties as such, and it's taking shape as such. It's very much seen as a new asset class. So with the downside of starting to be affected by the crypto space, by the macroeconomics.
Yeah, agreed. Thank you very much for that. Nikita, I'd like to bring you in here. Given we touched on the Fed policy, interest rates, how are interest rates and the cost of capital affecting the investing landscape?
Sure. So obviously, the cost of capital is a central component of making trading decisions, especially when you run some high or leverage strategies. And so what's interesting is, so there are, in my mind, two components. One is allocation to the asset class, and obviously the traditional players have historically haven't been maybe too active. Maybe they were coming in through the likes of Genesis, Celsius, BlockFi of the world, and kind of lending them, so they lend into the asset class. But obviously, that being out of the picture, now there are fewer and fewer ways directly to invest in the space, and having some bond-like or fixed income-like returns, and because there are fewer options, and the TradFi options are pretty compelling, especially adjusted for risk. Like crypto doesn't offer the risk premium that you would hope, and so that's kind of one part of the equation. The second is within the space, right? And so I think the rates are only affecting the first part. So the treasuries, wherever they trade, they impact kind of size of the DeFi market, but only up to an extent. I think the kind of correlation causation part is quite light these days, because there are very few people, or fewer than before, where people were chasing yield and deploying to DeFi and to all sorts of market neutral strategies and whatever else. So now with that being less and shrinking, so that's kind of where there is high sensitivity to the rates. But within the crypto, so be it on centralized exchanges and where the rates are there for the margin trading, or be it on some of the DeFi lending pools, or wherever other areas of the market where you would expect some correlation. I'm not sure there is very much structure, just because the people that are, again, sensitive to it are not really participating on the crossover. That said, obviously the availability to lever up, availability to borrow, which is another way that this happens, is a bit higher. But to be honest, it's not that rates increased 5% and the cost of borrowing for those kind of strategies increased 5%. They kind of stayed similar, maybe a little bit higher, but it's highly depends on your risk profile as a company. So it could actually be better now than it was before rates started to increase. And just depend again who you are and how you do it.
No, thank you for that. And Mona, taking this a step further and kind of looking forward, do you have any thoughts around a Fed pivot and what that might mean for dollar liquidity and what that might mean for general asset prices on the crypto side?
Yeah, so maybe just trying to frame it such that so it was, yeah. Sorry,
if you want to answer, go for it.
No, well, I think I'll just pass it on. I got confused, sorry.
In general, I think right now, I think we've seen the Fed maybe slower the pace, or at least we won't expect as extreme rate hikes at present. There's maybe a pause. I mean, we know inflation is a lagging indicator, so there might be a bit of a pause to understand, what happens. At least there's no further massive rate hikes in the last announcements. But what we, I think, generally see in the market is that obviously when the rates are very high, asset prices are low. So if we get rate cuts in the future, so if there is a pivot, then of course we will see there's more liquidity in the market and there's more demand therefore for assets, so prices of assets will go up due to that. I don't think we will be seeing an actual pivot in the sense of cutting rate or rates for at least 8 months based on historical events. I would say probably the majority of central banks this time next year are probably going to be considering rate cuts, but it's still a while to go because we definitely have several aspects that we have to consider in the market. And also I think the Fed's role is also to make sure that there's not an early bet on rate cuts, because we have other risks like rising oil prices, for example, that are also potentially impacting inflation, which is obviously the job of the Fed to reduce inflation, to get it back down to 2%. And then obviously we could also talk about the quantitative tightening that is happening in the market. That's I guess a second tier measure that's being taken as well to combat inflation. And if that's getting taken to effect, or if that is working, of course that will also be a factor that will essentially reduce a monetary supply in the market, therefore then be able to affect inflation positively, so lower inflation, therefore be another pathway to the cut of interest rates, and therefore, of course, also for us to have asset prices that are a bit more interesting for at least the digital asset space.
No, thank you for that. Nikita, I'll come back to you. It's becoming increasingly clear, as Johan said earlier, that digital asset prices can't be judged in isolation, and you need a macro overlay, especially looking forward. How are you viewing that kind of crypto macro, crypto traditional asset correlation, the breakdown, the shift? What are the themes and what are the things you're focusing on? And what are vol markets saying?
Well, so one of the biggest forces that could even overcome the laws of physics is the liquidity in the market, right? So when it's ample, then some things, and in crypto in particular, you don't need to look too far to find examples of things that are quite surprising in terms of certain valuation, certain metrics that would raise your eyebrows. And so effectively, I think one of the biggest trends is just general people's appetite and availability of options. So when there was sustained period of very low interest rates, people always chase the returns. They go towards less and less liquid, higher and higher growth opportunities, and delaying the profitability, just selling it to the next guy who has the same framework to think about it. But when these habits break and losses, severe losses are incurred, then it's revaluation procedure that takes place. And so now that we live in a pretty different market environment, that's even though crypto was in November 21, that was around the all-time highs, was doing buzzing in activity and everything. But then as the tabs got closed, then the market obviously suffered the consequences. But then I think the space has seen a lot of improvement since then, a lot of maturation, and there are like a few trends that are crypto specific that are opening a new flows of capital. So traditionally, it's been the venture that was the way for the TradFi guys to deploy to the space, because that's kind of sits somewhere on a balance sheet. It's very similar to the traditional fintech venture. So we just check in 5 years, 10 years, and see how it goes. Obviously, because crypto turnaround on the venture was much shorter, especially during certain periods of time, then people were forced to reevaluate a little bit. But still, venture was by far the biggest way that institutions were investing, and now having many options to hold some of these commodities like Bitcoin on the balance sheet directly or with ETF whenever that happens, that could be pretty impactful. So I think like overall market picture improving little by little, so inflation situation is definitely in a much better place where it was than when it was. Economy in the US at least is still quite resilient, so that could create a pretty compelling story for the asset class, yeah, it will be pretty interesting to see what happens.
Agreed. I think it's interesting talking about market structure and the impact of interest rates, in particular around the type of investing strategies taking place on both the VC and the liquid side, and the type of also the primitives that are being built by institutions and also crypto natives. I'd like to touch on this with you, Johan, first, the type of things and how the market structure is actually being affected by, for example, the high traditional interest rate environment now compared to the low one previously.
The obvious thing is obviously if capital is more expensive, it's just more expensive to borrow, you want to borrow less, you get less leverage as such. We had a macro and a micro effect of less deleveraging in the crypto space. As most of you know that we had Celsius, we had BlockFi, we had Voyager, we had quite a lot of the lending platforms. So for us to, like, not showing any secrets on the business as such, but we essentially moved from let's call it a 6x leverage on equity to about 2x, not to say just trading our equity for a few months at the end of last year. And 2x seems to be like the soft spot where we get whatever 16-20% of the spot market share as such. So it's sorry about this. It's very much, there's been quite a lot of effects or factors against liquidity as such, liquidity provision as such. There's been some positive development on essentially access for institutional money as such. So we've seen more and more third-party validation. The same way I entered the crypto space in 2017 with an ex-Marshall Wace who essentially just revalidated the idea to me and was building another venture. And essentially I think everyone needs a bit of a comfort, especially when you come from TradFi, to actually go into the crypto space. And as this eternal ETF discussion, I think Van Eck made the first application about 10 years ago now, or was it the Vinkovive or as such? But it's been long running, and I think it's probably less impactful in terms of generating new money coming into this space. But I think it's probably more impactful in terms of branding and in terms of understanding of new money coming in for the crypto space. Is essentially one of two things: it's either institutional money or it's retail money. So if you think it's retail money, it's more like probably you want to be more in the meme coin. Be invested in the meme coin as such. And if it's institutional money, it's basically BTC and ETH. It's basically things that are well understood by an investment committee, and admittedly in the long enough term by an investment committee, even at a pension fund or an insurance fund as such. So it's very much what we're going for. In terms of relationship to interest, it's true that there's actually multiple effects. Actually, some unforeseen effect, where even in terms of talent. You need quite a lot to actually build an ecosystem. But in terms of you need capital, we also need talent, and we've actually seen really good talent going back to TradFi for some reason, because that last year, FX was pretty active, commodities were pretty active, and we see that coming back and forth. So I think it's good and bad, because it means also it's bad, because we lose some good talents here and there. But it's very good because now we have champions on the other side who know of the company and the good culture that we have, and then who can champion us at banks, XYZ, and so on, in terms of just familiarizing those institutions with crypto as well. So there's quite a wide range of macro effects as such on the space, but yeah.
Given you touched on the institutionalization of digital assets and the incorporation, arguably, in portfolios, And Mona, I'd love to get your thoughts on the kind of portfolio diversification of using crypto, which you've seen this huge kind of decoupling, decorrelation, and how you're thinking about it from investing on both the VC side and the liquid side.
I would say in general, I mean, like with this whole decoupling, I mean, we obviously see the crypto market still following macroeconomic trends to a certain degree. I mean, interest rates, inflation do, of course, affect this, and obviously if there are interest rate cuts, there's more interest in higher yield-bearing assets, so therefore, you know, naturally there's a look into the crypto market tendency. What I think the very big difference, and that is also what I think is important when you are an investor to analyze, is the differences that are affecting the cryptocurrency market, both in terms of startups' equity, but also liquid tokens versus the traditional financial market. And I think you can group that in 4 buckets. The first one would be market confidence and adoption. The second, regulatory frameworks and advancements in the regulatory space. Then third, technological advancements, and finally also liquidity. And maybe to shed some color on what I mean with that when you evaluate as a VC, but I think also as an individual investor or as an institution, interesting to look at, for example, in the market confidence and adoption, upcoming things are, for example, the recent ETH futures ETF. You know, Valkyrie, I think, was already approved. The others are probably going to follow. If the Bitcoin version of that, the Bitcoin futures ETF, is any indication, it's actually bearish, right? Because that was kind of the top, and then it actually fell pretty much after that. So that's something to look at, to watch out for, to understand, is it similar, is it different in that respect? The spot Bitcoin ETF, the approval on that, right, is an important factor that could be a catalyst to look out for. Then right now we have the FTX Sam Bankman-Fried court case coming up. Again, maybe there's some bombshells that will be revealed during that. That could cause a lot of volatility. Again, something to look out for when you evaluate specifically, you know, liquid trading strategies. And then, of course, things like stablecoin regulation in the US being quite, well, tricky for banks at the moment, but then in countries with a lot of debt, so the stablecoin of the yen, for example, or the euro stablecoin are probably quite well received because in the Eurozone, for example, it helps to subsidize the debt of poorer members, for example, right? So these are all factors, I think, to evaluate and also to be aware of that. I think when institutions get more involved in crypto assets, there might be actually more correlation, right, between crypto and traditional finance. So those are maybe factors in the first bucket to consider. And then if we look at the other ones, maybe a little bit shorter, but just to give you a few examples from regulatory perspective, and that's something as a VC, if I invest in equity, I think is really important to evaluate, is to understand what are the frameworks in place. And I think a big movement is that actually there's been a accounting regulation that's, I think, set to be in place by 2025. In the US, I think fair value accounting, that's probably going to provide some certainty on how to actually account for crypto on your balance sheet as an institution in the United States. And that's probably a pretty big advancement to, you know, be aware of. Then, of course, MiCA or MiCA framework in Europe, and then countries like Dubai or Hong Kong or maybe even the UK saying we want to be crypto hubs. Again, very important to keep an eye on that and be aware of that, and also understand where companies are registered and how their organizations are set up. I think are really, really important aspects to consider in terms of regulatory aspects. And then, of course, technology. Something like the Denkun upgrade from Ethereum, I think, is a big advancement for layer 2s, for creating scalability and cost efficiency methods and measures. So things as such, you know, create a market volatility, possible large upswings, but as well as also if you're looking at VC investments, is your investment, you know, does these kind of upgrades, do they actually cause an issue for some of the investments that you've made, right? Maybe they're solving for the same problem that now Ethereum is solving with upgrades as such. So I think those are all factors to consider. And of course, you know, we can't forget if we look at liquidity in a very broad way, the Bitcoin halving in April 2024, again, probably a catalyst, right, for a potential pump in the market. So I think all of those factors are, I think, important to evaluate both as a trader, as somebody who looks at liquid markets, as somebody who wants to invest, but also as a VC investing in companies with tokens, but also with equity, because essentially you need to think forward for the future and not just at the immediate, because this landscape is so fast and changes so rapidly.
Thank you. And given you touched on it, it would probably be remiss of me not to jump on the fact that you talked about the Bitcoin ETF. Nikita, do you have any views here, and how does the macro backdrop fit into that picture? And also, can policy be driven from the crypto side here? Do you have any timelines or any views on when there might be approval?
Well, maybe I have few ideas, obviously, but can't be particular concrete on because that's not really what we spend too much time thinking about. But the few kind of starting points is that the deadlines that are upcoming. So there were a lot of positive motion around Grayscale case against the SEC. So I think the deadline for the final decision is coming up sometime soon. Obviously, there were preemptive decisions on BlackRock and a few other ones last week. So I think the next one for them is towards January. I think mid-January or something. Probably once one approved, then all of them will be approved. And I think structurally, again, it will be really, really impactful. I think above all, it will be huge validation for the asset class for Bitcoin, and there will be a lot more channels for investors to invest in. Like the tracking error will be much less, because hedging with futures, the current products are not ideal. Obviously, counting out the grayscale, unless you have a view, and then this could be a pretty compelling product. And having the army of distributors, within BlackRock's, Fidelity's, Franklin Templeton, and so on of the world, could be quite powerful. And I think it will be quite, it will be a big deal for the asset class again, and the market microstructure will be changed to some extent, and in quite quickly, and then in the medium to long term, with greater proliferation of similar products, it will be progressively more impactful, and we could finally start to see a bit more diversity in the types of market participants. You kind of historically seen the HFT firms, and then kind of retail, not so much around the mid-frequency or short-frequency guys, just because of the general liquidity of the asset class. But I think having an ETF, I think it will be a validation, and it can be a door opener for a lot more strategists, a lot more market participants to get involved.
Well, thank you for that. And you touched on a very pertinent topic, which is liquidity. And I know it's not necessarily a macro topic, but I think it's worth addressing. Johan, Nikita, what are your views on the evolving market structure, and what does this actually mean? I know you mentioned it regarding high-frequency trading, but how is that going to affect markets going forward and the types of businesses that you're both in?
So we've, it's part of, you can blame us partly. And well, there's a one factor that we decided pretty early on. I think if you're an entrepreneur as such, or even in trading, you don't control the environment. You just have to adjust to it. That's one constant. In terms of adjustment to the ecosystem, it's been, we have moved back from trading about 350 tokens to a bit less than 200 tokens. Some of it is more about just us being conservative on the regulatory side, but some of it is just simply, if there's, we talked about cost of capital earlier, then if everything you trade as a has a leg that's essentially a stable coin, and your stable coin leg costs you an extra whatever 5 or 6 points as such, then you just have to be a bit more careful about what you trade. That means more sort of blue chip trading as such. It's probably also a reflection of less retail trading per se. So I think we were just talking about sort of the next, there's hints about what the next when this next spring or summer is coming. I think for me it just comes from one of two sources. It's either retail or it's either institutions as such, or both ideally at the same time. And then institutions is very much blue chips as such and British covering. We've seen some shift OTC as well. So I'd say we trade as a percentage of the volumes, we trade more and more OTC, which is probably more akin to what we see in traditional finance. It's probably traditional finance. It used to be more on the floor, and it probably explains why some of it has shifted to the screen. Even if in markets like some of the markets like the Euro stocks have actually grown quite well together, actually, between the screen and the OTC market growing together. But I would say it's been more of a shift onto OTC for larger blocks. And larger blocks are not necessarily huge blocks. They would just be like $100,000 per clip. And yeah, we see more and more sort of traditional finance type of liquidity provision around sort of direct to API. So more models that we see in the FX world. But beyond that, we just focus on building, and then there's not much else we can do.
Thank you. Nikita, any thoughts?
Sure. So liquidity, I think obviously is much less than what it was, at least like on the screen. If you look at the depths of order books and so on, but that's not to say that you can't trade large quantity, you can't be efficient and execute big amounts without much slippage and without much price impact. But then it's kind of becomes progressively harder for the newcomers, and naturally I think that should be a service that's provided to the end clients and through the OTC, for example. So there are all sorts of new ways that you could source liquidity and get really favorable terms and plug and play kind of setups, such that you don't need to connect to 10 exchanges, have fast connection, and negotiate everything and so on. So it becomes much more commoditized and much easier, more easily accessible. But obviously there is dividend like in everything for doing the hard work and actually being able to do it yourself. So it's kind of becomes two distant worlds. So the HFT firms and market makers and high frequency trading funds, they're kind of keep on getting more and more percentage of the market share, and there it's not so much that you throw in one huge order in one exchange, but you kind of manage it really efficiently. And then the other market participants, they leverage these HFT firms, and they get the service for them. So it's kind of evolution a bit of the market. OTC has been part of the market for a long time, but now I feel like it matured, and there are more and more established players that are offering it, and overall services quite good. So yeah, liquidity to summarize, is smaller, but then again, you need to be like if you know what to do, then it's kind of pretty good.
Cool, thank you. Given we've got about 5 minutes left, there's a few quite interesting questions from the audience. I think the first one I'd like to touch on, and Mona, if you take a stab at it first, is what do you think the macro impact from AI will be in this next cycle, and how do you think it impacts crypto?
In general, I feel like that AI is, we do see AI being used, but I think it's not used as much as some of us think, because we might use it, we might use ChatGPT or other similar, providers of services that help us make texts quicker or write emails or create graphics or so. But I think in terms of actually seeing a real clear macro impact, I think we have a while to go, to be honest. Also because if you look at a lot of the companies that are coming out with AI solutions, they're often just built on top of something that exists like ChatGPT, and they're not actually really making a big impact or have a massive amount of user numbers, similar to what you also see in some of the blockchain verticals, of course. But I do think that we have a while to go, even though we see AI spreading like wildfire, to actually see a macro impact. I think will be not this, but next cycle.
Thank you. Johan, any thoughts on thinking about incorporating them into strategies?
We do to a degree, but it doesn't. I mean, you can use AI for essentially, automation, very much some elements of optimization and some for the discovery, essentially. I think it's very much used for some automation at this stage, so it's not necessarily transformative to a business like ours. Our business is pretty simple. It's just simple to describe, but very difficult to execute. For market making is essentially this: what's the price? How wide are you quoting? How big are you quoting? And that's about it. And then you just need to multiply this across 80 venue and trade 4 to 6 million times a day. And then this is where the implementation is a bit more arduous. But essentially, there's just this. So we don't really have many elements of AI in the business. From the venture perspective, we look at a lot of things in terms of how do you bring insights from especially financial data. AI people love to talk about AI and financial data because it's extremely noisy. And actually, if you're able to get some form of insight from financial data, you've got a form of holy grail. The only way I know how to make money from financial data is by two ways: the banking model, sort of a long-term, short-term sort of arbitrage of interest rates, or the liquidity provision model, where you just get paid. You push into a position by someone else who wants to get into a certain position, and you get paid, to take that risk. So I'm probably not the best person to answer that question as such. But in terms of the impact we see on different firms building in the crypto space, I think the only one that really comes to mind is probably WorldCoin as such. That's allegedly is, registering all these people to put them on OpenAI, I think, or so it's one of them. There's a few local teams that are linked with, I think it's not Blue Ocean, it's an Ocean AI. So there's a few projects that have been out there, but AI and blockchain itself doesn't necessarily goes on too well as such, just because of scalability. In terms of the macro impact, we know all the potential changes to our lives, where we should essentially have everyone should use ChatGPT and should have a virtual PA, and then have allegedly about 25 researchers working for yourself every day, essentially as an equivalent. So I think it's more impactful to our individual lives nowadays, but at the macro level, in our space, we don't really see the impact. But maybe Nikita, maybe on the fund side, maybe you see that more.
So I think for us, we use it just for productivity gains, I would say. But in terms of strategy development, I wouldn't say it's a primary tool for us. We try to incorporate it, but it's more of extension of our tool set that we have, and just a way how to get to a solution for certain type of questions. And for productivity, I think macro impact will be when productivity increases. So if we could do the same job with fewer people, then higher productivity, then that starts to have quite large, or depending on the scale of it, but that could start to have impact at the macro level, but that will probably take a bit of time. But then again, with these things, you never know. Things can turn around quite quickly.
No, thank you for that. Given time, I'll ask one last final question, which is, looking towards the end of the year in 2024, do we think crypto prices have based? When might the next bull run start? And any price predictions, if you're willing to give them, or any views on the market?
So we're fairly market neutral. We do obviously have a venture arm, and we do hope that prices go up from the venture perspective. But essentially, we don't really know how to make money, things that go up and down as such. So taking this lightly or putting more my former macro fund manager hat, I've repeated it a few times, but I think the easier filter, and it's not financial advice, but the easiest filter I like to use is if you think that the next retail wave is coming, then you should be into brands as meme coins, as the Dodge and the likes. If you think that the money will come into the space, or the new money will come into the space from an institutional point of view, you just need to think of just like an investment committee member, and you just think that, essentially BTC is moderately well understood, Ethereum not always, and then maybe some of the, let's call it the emerging economies of the L1s, of the Avalanche, Solana, and so on of the world, that have big enough of a brand, big enough liquidity to make it worthwhile for fund to think of deploying there. So that's, but then in terms of pricing, just no idea really.
Again, not financial advice. Probably macroeconomical situation by the end of it should be quite a bit more favorable. There could be quite a few crypto catalysts, so probably more likely higher than lower.
I mean, I would say in general for this year, I don't really expect, the ceiling that we kind of expect for Ethereum to break. But if we look at maybe this time next year, when potentially interest rates are starting to be cut, again potentially, then I think there is a likelihood that there will be a upward price action with Bitcoin halving, coming, etc. as well. However, I don't think that we'll have the bull run next year. In my personal opinion, I think we have a little bit more to wait. Therefore, without necessarily, again, giving any financial advice, but I don't think we have, the end as near as we might all hope. But I think in 2025, there are several macroeconomic catalysts, as well as the points that I've alluded to earlier when I was speaking, that could drive prices upwards.
Brilliant, thank you, and thank you everyone for joining us.
Thank you.
Thank you.
Okay, we are now going to finally pause for our final coffee break of the day. Please don't forget to visit some of the fantastic booths that we've got in the exhibition halls today. And then if you do stay with us, I've been promised cocktails and DJ at an after party that has been sponsored by Copper and LTP. Before that happens, we do have two final sessions. One is a fireside chat that's looking at decentralization, and the other one will be interviewing VC and investors about where they're planning to put their money. So please do come back and join us for that later on. Enjoy. The final sessions on both the markets and vault stages will commence in 10 minutes. That's the final sessions on both the markets and vault stages will commence in 10 minutes. Ladies and gentlemen, please make your way to the markets and vault stages. The next sessions will begin in 2 minutes. The next sessions will begin in 2 minutes on the markets and vault stages. Thank you. Ladies and gentlemen, the sessions on both the vaults and market stages are beginning now. The sessions on both the markets and vault stages are beginning now. Okay, on to the final proceedings of today. Thank you all for staying with us. I do promise there is alcohol at the end of this rainbow. So over on the vault stage, there is going to be a fireside chat with Copper and LTP. They're going to be talking about how to navigate opportunities through custody and prime services. If you want to stay on this stage, though, we are going to finish off today with a bit of a bang. So the first session is going to be a fireside chat on decentralization. Now, the debate around centralization versus decentralization has traditionally been quite binary in nature. You know, people prefer one over the other. From the trading perspective that I have sitting at Swarm, I can tell you that it feels more of a scale. So we must think about the benefits of both and how they can complement each other. For example, DeFi offers you self-custody, no market hours, 24/7 trading, and transparency of the blockchain. But then if you need to be able to remove counterparty risk, you need centralized elements like KYC and AML checks, for example. We're going to have Mike come on from Figure now, and he's going to have a fireside chat with Eva, and I want to see if he agrees with the points that I've just made. So please give them a round of applause as they come to the stage.
I've just looked into one of the reflectors. Hello, good afternoon, everyone. Thank you so much for joining us for this fireside chat, which is very brief. We only have 20 minutes, so we're going to get cracking. What I'd like to do before we get started, though, is to encourage you to send us questions. We'll give you the opportunity to send us questions. We'll try to answer them. If you don't send us questions, we're going to finish 5 minutes early and start drinking. So please send us questions to preserve our health. Right. Mike, please, could we start with you giving us a brief intro of yourself, of the company, and why you're here today?
Sure. So I started my career back in the late 90s at Wells Fargo, so traditional financial services, and I ran capital markets and product development, proprietary trading for the bank. I left in 2000 to do my first startup, which was a wealth management technology that I sold to Broadridge. I left that to start a hedge fund that I still run today. It's become a family office, but got me back in the markets. And then in 2011, I started SoFi with some colleagues, grew that, and obviously a public company today. And then I left in early 2018 to start Figure. And the whole motivation behind what we were trying to do with Figure and what I think we've been able to start accomplishing is we have this fundamental belief about blockchain and blockchain's ability to transform markets. And that belief is really rooted in the fact that blockchain does two things that are incredibly powerful. It allows you to displace trust with truth through native digital assets. So it allows me to look at an asset and know for certain the composition, the ownership, the history, and it allows you to transact bilaterally without counterparty risk or settlement risk. So when you intersect those two things, you can start creating markets you're agnostic to your counterparty about. That's a huge deal for financial services because we think about how do financial services markets work, everything is intermediated. So when we trade stock, there's 7 parties that sit in between a buyer and seller. When we swipe a debit card, there's 5 parties that sit in between a buyer and seller. Those intermediaries represent trillions of dollars of market cap. So if blockchain's successful in what it needs to do, you can disintermediate that to just the buyer and seller and free that $1 trillion that sits in between up.
Now, do you think that's happening? Because my impression is that it's actually going the opposite way. It feels like rather than blockchain replacing existing financial market infrastructure and market structure, it's just actually become yet another asset to trade via financial intermediaries. We have PBs, we have custodians, we have exchanges. The same intermediaries. What's going on?
So it's a great question. And so let me start off with, we've had an enormous amount of success on blockchain on certain asset classes. So we began originating loans on blockchain in 2018. We did the first warehouse that year, did the first securitization in March of 2020, did the first AAA rated securitizations this year, and more recently just did a transaction where the bonds themselves are native to blockchain. They're not on DTC or Euroclear. And so to date, we've done about $15 billion of transactions on chain, including $1.5 billion in third quarter of real world asset transactions. So there is activity that's happening, but I think you hit on one of the salient points, which is the premise of blockchain, that trust versus truth and the ability to transact bilaterally is predicated on decentralization. And the crazy thing is crypto is a necessary component for blockchain to work, and most crypto trades on centralized exchanges. And so there's no doubt an irony of that, and that's one of the things that we're leaning in to try to change.
So what's real decentralization? What does that mean to you? Because the IOSCO just a few days ago said that a lot of the DeFi applications and DeFi platforms actually just masquerade as decentralized entities. There's always someone responsible. You can always find that person. So what does that mean to you? What's a real decentralized exchange versus a centralized one?
So you can start off with the exchanges today predominantly aren't even close to being decentralized. So if you think about how a Coinbase or a Binance or an FTX before it imploded worked, you have the custodian, the marketplace, and the clearing all happening under one roof. So there's no financial market that actually works like that. So everything is bifurcated out, because when you have all that under one roof, you can introduce malfeasance. And we obviously had a lot of malfeasance a couple of years back. But even breaking those things out, the challenge that you have, in particular for things like trading across multiple level 1 networks, is the assets or the tokens aren't sitting on that same network. So trying to encumber them is proven difficult. And the default that people try to lean into is, okay, we'll use the custodian as a trusted oracle. So the custodian will represent, I have Bitcoin, I have ETH, I have whatever it is that I want to transact to. And the problem with that is you're trusting the custodian. It goes back to that trust versus truth. And people would say, well, why can't you trust a custodian? And I'd say, well, Prime Trust and Fortress were 2 great examples of why not to trust a custodian. So the industry in general has been developing technology, in particular around MPC, multi-sig wallet structure, that effectively allows you to identify that there is an asset in a particular address, to shard the key for that address in a way that no one entity has unilateral control of it. So a qualified custodian can still function as a custodian, but they can't take the asset out of the address. And in doing so, you can actually create a true decentralized construct. And so I think this is what we've been missing. And I think that this is not just around trading crypto, it's around trading securities, it's around trading other assets. We need true decentralization to realize the actual value proposition of the technology. And that I think is starting to happen.
And this decentralized world that you envisage, it sounds like it still has custodians, it still has those intermediaries. Is it regulated?
Yeah, and that's why the custodian's there, because as an RIA, you need a qualified custodian. The SEC still requires that. And so, but that doesn't mean that the custodian's actually a true intermediary, right? What they are is a part of a process at the regulatory.
But I imagine they collect a fee.
They collect less fees. So for example, when we did the first securitization of blockchain assets, we had a thesis that we could save 90 basis points of cost from origination through to deal expense. And part of that savings was around getting rid of the indentured trustee, reducing the cost the custodian charged, because now they're there as name only. They're not actually taking possession of documents and holding on to them. And when we did that first transaction in March of 2020, we ended up saving about 117 basis points of cost. So there's real value that's coming to market through this.
What's stopping this decentralization story, and what's pushing it towards the centralized exchanges? Because let me put to you my theory, which is that people want a complaints department.
So when I first got my alternative trading system through the SEC, so I have a broker-dealer and an ATS, and the ATS allows me to trade blockchain native securities. And they self-settle, self-clear. It's the only ATS that exists to do that. And we did the first marketplace for our own equity back in November of 21. And when I was working with FINRA to get approval for it, I sat down and they said, well, who do you call when a trade breaks? And I made the mistake of saying, well, a trade can't break because you have to encumber the bid and encumber the offer.
Wrong answer.
It was the absolute wrong answer. They threw coffee at me and told me I was an idiot. And so I very quickly said, well, you call the administrator. So I made up an administrator. I've created a phone number for the administrator. And for 3 years of running that marketplace, no one ever called the administrator. So if blockchain works the right way, you don't need a centralized admin.
Okay, let's talk about a news story I read recently, which kind of is puzzling a little bit for me, because you're clearly advocating for decentralized market structure, but apparently you're also wondering about buying FTX.
So what I can say to that, it's been in the press, and that we have interest in it. Let me rewind it a little bit and set some context for it, which is, I believe there's a way to establish a truly decentralized marketplace, and I believe that you can adopt best-in-class things like netting and cross-collateral margining. So for example, when you trade on blockchain marketplaces today and you run a long and a short position of the same asset, you have to independently margin each side of that trade. That doesn't make any sense. You should be able to net it. You should be able to have more than just one asset as collateral against the trade. So there's value in netting, there's value in cross-collateralization, there's value in better margining. So margining that's fully encumbered where you actually have security, and there's value in the ability to offer up collateral into the process. So it's public, it's part of the Celsius bankruptcy. that we've been designated as a loan refinancing agent for that transaction. And what we're doing is lifting out $300 million of loans and $500 million of collateral. That collateral will go into Delaware grantor trusts that we can then lend into a marketplace as for the ability for borrow and for short. And so I think there's a really interesting backdrop. What I like about the bankruptcy transactions, it's very unique, is if someone wanted to go to the SEC in the US today and do an S1, the SEC, for a blockchain company where the security is trading native on the blockchain, it's not trading at DTC or in a traditional centralized market, I don't think they'd allow you to do it. But US Bankruptcy Code has a provision called 1145, and 1145 allows you to issue the equity through the bankruptcy court. The SEC will allow you to do that, and then that allows you to actually create a public equity native on blockchain. So you can imagine if hypothetically we were to bid in and restart an exchange, how cool it would be if that exchange was public, trading on itself.
Would it be cool?
That'd be pretty cool. It's a milestone transaction. And I think what it would do is it would demonstrate that it's not just crypto on decentralized marketplaces. It's equity, it's things like our loans and asset-backed securities. You know, as I said, we've done $15 billion of those things, where basically it's an everything marketplace. So what you should have is one place that you go, and the value of being able to go from Bitcoin to public equity to ETH is incredibly high. And there are people that would absolutely drive liquidity into an ecosystem that could support that. And I think that's what we're getting very close to bringing to fruition.
Very cool. Please send us the questions because we only have a few more minutes left, and then you guys are up, you guys asking the questions. Because you know, you've mentioned that you worked as a trader, you had a hedge fund, you sort of sold companies. What's interesting for you about this space? And you know, what would be the sort of thing that makes you go, actually, you know, sod this, I'm out?
So the key about what we're talking about with the marketplace, for example, is you're not just getting rid of Euroclear or DTC. You're not just getting rid of the LSE or the NASDAQ or the NYSE. A true decentralized exchange, you don't need an introducing broker. You don't need Schwab, TD, Robinhood. They all go away too. And so the level of disruption that you're bringing into the marketplace is massive. And you couple that with, you know, transactional activity, interchange, getting rid of Visa and MasterCard. You're just talking about trillions of dollars of market cap reallocation that's going to happen on the back of this technology. And people have been talking about this for years, you know, 5 years, 6 years. They've been arguing the promise. And the blockchain industry has done a phenomenal job shooting itself in the foot on a regular basis. So it started with the ICO fiasco, then the NFT balloons, then, you know, FTX. It's just been one problem after another. I can tell you that there's real world transactions going through right now that by design don't have an enormous amount of publicity around them, but are transformative, have major financial institutions participating, and can demonstrate real economic value. And that real economic value is what's going to be the catalyst to actually get this to the next step. And it will happen very fast, and it will happen over the next couple of years. You're going to see a massive transformation through blockchain.
So do you think that there is, you know, at the moment, the way that traditional financial system is set up, clearly, you know, there are lots of winners. You've got lots of people collecting, you know,
Right.
a fee and making a living along the way. So what exactly is going to drive this shift? Because it sounds to me like it's a very tough value proposition to turn up to someone and say, hey, you know that thing you make millions from yearly? We're going to make that better, but you're not going to make that money anymore.
So the key is to understand the right markets to go after, where the decision makers are the ones that benefit from the technology. So for example, you know, if you look at, I sell mortgages to JP Morgan, I sell them on the blockchain. They get instant delivery. If I sold them mortgages the old way, Deutsche Bank would take possession of the file, they'd charge them money, and they'd bring it over to them and deliver it to them. JP Morgan's thrilled to cut Deutsche Bank out of the process and get the loans faster and save money. Now, if I went to JP Morgan and said, hey, I want to use blockchain for levered loans and CLOs, they'd say, well, wait a minute, we earn float for 120 days it takes for the loans to settle. We don't like that blockchain use case. So we have to find the use cases where the proponent or the advocate is the one getting the economic benefit, but fortunately there's a lot of those.
Can you give us a few examples, please?
Sure. So interchange. So JP Morgan is the largest issuing processor in the world for interchange cards, but they hate paying Visa and MasterCard to sit in the middle. So what if you had a stable coin, a regulatory compliant coin, that they could go to all their business customers with and say, look, I will set you up to take this as payment. And then JP Morgan becomes merchant acquirer and issuing bank, cuts out issuing processor, Visa, MasterCard interchange, Square and Stripe, and is the merchant bank on the back end. So I think you're going to see these things happen. And of course, they're predicated, I said, if they had a regulatory compliant stablecoin. I think what you'll see coming out of the US, even though the US is very challenged from a regulatory standpoint, in the next several months, you will start to see security versions of stablecoin that yield, that are public securities and that are freely transferable peer-to-peer and institution to institution. That is going to be a seismic shift into the market, and people aren't prepared for it yet.
What about central banks and regulators? You mentioned, regulators briefly earlier. What role do they play in this new ecosystem? And actually, do you see banks in this new world?
Yeah, I think that obviously there's a lot of discussion around CBDCs, central bank digital currencies, and the reality is they're better than stablecoin, because stablecoin goes back to that whole point I started the conversation off with, which is you shouldn't have to trust anyone. And when you have a stablecoin, you have to trust that there's assets behind that coin, versus if it's dollars or pounds or euros, it's dollars, pounds, and euros in digital form. So I think there is a role for the CBDCs. I think in the US, the Fed has an extremely challenging position, because the launch of a CBDC would be the end of the banking system as it's defined. And that's
a retail CBDC, I guess.
That's right. And it would be a significant, and that's really where the value is, because you have real-time payment that in terms of institutional settlement or cross-bank settlement, there's other ways they can do this where they don't need blockchain. It's really getting to retail for transactional commerce to avoid interchange.
Well, I don't know, I come from a world of FX a bit, and there's SWIFT, there's CLS, there's a lot on the settlement side, I think, that can be potentially improved.
Absolutely. So a bearer asset can solve the cross-border remit problems that you have, and so it eliminates the need for SWIFT. You don't need a messaging protocol. This is what, if you go to the US, there's these things called Coinstar, where you go to the grocery store and you dump all your change in them, and they give you out an Apple gift card. The number one reason that those are used today is to buy Bitcoin to move it to your relatives who don't live in the US, right? And it's just illustrative of how much friction there is in money movement processes, that people are doing it through a Coinstar terminal with Bitcoin.
Thank you. Look at that. We've got some questions just before we got to our drinks time. Thank you. Would traditional service providers like fund administrators and auditors still be required?
So, until you get the assets on the blockchain, you're still going to need some combination of fund administration and audit, because you're going to have to validate that the assets are actually there. Once the assets become digital, I think you're going to change the construct, and the whole notion of a qualified custodian eventually goes away, because as a customer, I can look through and I can see the assets are there and prove it out.
Does that need a lot of, I hate this word, but does that need a lot of responsibility and education from the users? Because at the moment, you don't need to worry about those things.
Today, 10 of the top 20 mortgage companies in the US use my tech to originate assets. Those assets are all on blockchain. They have no idea they're on blockchain. They don't need to know it. It's just technology to them. So I don't think it's any more of a significant hurdle if it's designed well than any other technology and adoption for technology.
Thank you. What do you think will be the potential catalyst that can act as the inflection point for DEX trading dominance in crypto?
One could be lifting a giant old centralized exchange out of bankruptcy. So that could be a real catalyst to do it. We're going to take a run at standing up a true decentralized exchange that cuts across multiple assets, that will have the involvement of very large market makers facilitating liquidity on the crypto side. And whether we're successful or not, we'll see. Whether that involves lifting a company out of bankruptcy, we'll see. But there is a dearth of solutions in the marketplace right now, and someone needs to lean in and do it. And so, we're going to take a shot.
One question from me, please. How do you guys make your money?
So we have two different functional business lines. So we have a lending business line that does blockchain origination, blockchain securitization. It's now working with Goldman and JP Morgan to do blockchain TBA and pass-through markets. That company this year will make $300 million of revenue and do about $60 million of profit. Then we have a markets business, which is the broker-dealer, the ATS, the money transmission licenses, all of the things that we need to stand up the decentralized exchange and challenge the centralized exchanges. That's more in the tens of millions of dollars of revenue number right now, but there's a path to ramp that pretty significantly.
So a similar way, but just charging a bit less and fewer intermediaries.
That's right, and really the revenue that comes off of that's coming from the margin lending and from the asset management component, not so much the transactional fees.
Thank you. And the last question we have is, why do you think the adoption of tokenization by asset managers and originators is so slow?
So I think there's two reasons for it. One is people tokenize the wrong things, and I bristle at the word tokenization because I go back to like IBM's commercial where they say, we use the blockchain to track your strawberries. That's a stupid application of blockchain. It doesn't make any sense. Like, how do you know where the strawberries are and maybe someone swapped them out? The blockchain doesn't have eyes.
Someone might have eaten it.
Right, and so I think there's been a misguided emphasis or focus on what to tokenize. It only works if it's a native digital asset and it starts its life on the blockchain. You have to have immutable history from the origin to the point in time that you're looking at it. That's what's valuable. The other aspect is tokenizing, not just things that aren't native digitally, but the wrong things that with the false premise that you can create liquidity. So a lot of people feel I can put real estate on the blockchain, all of a sudden it'll have liquidity. You don't have liquidity unless you have homogeneity and you have market making. And so this is why we haven't seen a lot of success historically. I'd say we've had a lot of success with private company stock, with closed-end funds, but not the kind of success I think we have when we start leaning into crypto on a DEX basis, and public equity certainly on a DEX basis.
And a final question from me, please, is do you think that there is still a lot of BS in the crypto space, and do you see it getting better?
I think a lot of it was humbled or normalized in the bankruptcy issues that we just went through. I think the fundamental issue, first off, the idea of tokenomics being driven by scarcity now is finally out the window. We don't have to deal with that anymore. We have to deal with, there needs to be an actual true revenue model of that accretes into that token to get that to work. And crypto is necessary for blockchain to function, in particular proof of stake blockchain. It's a necessary component, but it has to have a very clear use case of how fees generate into that and support it. And I think the industry has been humbled in normalizing itself more to those use cases. And this is part why you see so much emphasis now on real world assets. Everyone started going around talking about RWAs, and I thought they meant risk-weighted adjustments. I didn't know what they were talking. And I'm the biggest risk-weighted asset originator out there at 15 billion. But we use provenance, which we now have in Europe, where we've done I think now $10 billion of locked asset value. So that trend I think is very illustrative of people actually getting real about the technology.
I think this is a good place to finish. Thank you so much, Mike. Please join me in thanking Mike for his contribution.
Thanks.
Thank you.
We are onto the home stretch of today's content. So if CBDCs and digital money is your thing, then please make your way over to the Vault stage now, as that panel is going to be discussing that topic. Okay, not to be biased, but I do think we might be saving the best panel till last. Okay, everyone wants to know where the money's at, right? Where's it going? What are people looking at? What's the product market fit? And I think it's safe to say we all probably still want to know what happened to the fundraising back in the bull run and where's that money gone to now, how has it been spent? So our next set of panelists are going to be exploring exactly this topic. So joining us, we have Lior from Spartan Group, Vanessa from Agley Ventures, Samantha from Rockaway X, and Rob from Dragonfly. This is going to be moderated by Trista Kelly, who is a long-standing markets reporter, previously holding positions at Bloomberg for many years. She's now heading up the fantastic team at DL News, and some have even referred to her as a markets maven. So please put your hands together and welcome the panel to the stage.
Oh, good questions. Hi, everyone, and welcome. I'll get right into it because we're preventing you from going to your beer. If you all could introduce yourselves, that would be great.
Hi, everyone. My name is Vanessa Grellet. I run a Web3 early stage fund called Agley Ventures. I started my career in traditional finance, working for about 10 years at the New York Stock Exchange, doing acquisitions and investments. And then I became one of the first employees at Consensus in 2016, stayed there for a few years, and then joined a few different investment funds.
Great. I'm Rob Haddock. I'm a general partner at a Web3 fund called Dragonfly. We're a little over $2 billion of AUM. Prior to that, spent a decade on traditional finance, launched crypto at a large hedge fund, spent a decade doing both growth equity investing and M&A within fintech and technology companies.
Hi, I'm Samantha. I work for Rockaway. We're, since 2018, a crypto venture fund. We invest across stages, but primarily early stage companies, tokens. I'd say we're very technical. We have an engineering team that tries to dig in with the protocols we back. Prior to Rockaway, I also started my career in traditional finance. I got, I guess, closer to startup world, and then a little step back to VC, and I was at DCG for about 4 years prior to joining Rockaway.
Hi, everyone. My name is Leo Groen. I'm a managing director at Spartan Group. For those of you not familiar with us, Spartan Group is a venture capital firm and digital investment banking group dedicated to this industry. We're founded by 3 former Goldman partners based out of Asia. We have our offices in Singapore and Hong Kong. I'm based in Switzerland, and we cover the globe from early stage venture. We run a liquid hedge fund as well, and one of the most active M&A and deal makers in the space. Pleasure to be here.
Great, I'll get right into it. $41 billion over the past 18 months, and yet I just saw a PitchBook headline today that said the US-based VC funds posted their worst quarterly return in 10 years. What is it like on the ground for allocators and VC funds just like yourselves?
So I saw the headline too. I think this encompasses all VC funds. So we're in a very specific category where we can invest in equity, but also equity and tokens. And that has a very different return profile than traditional equity. So think about it when you invest in a Web2 startup. If you come in early, maybe the startup will do all the series. Maybe they will be acquired. Maybe they do an IPO, but the chances are very slim. Whereas if you invest in core protocols, and really good teams, there is liquidity exit that comes in after a few years. So it's very different than what we see in the Web2 VC space. The other thing is a lot of the VCs also have liquid strategies, which suffered greatly, I would say, in the past 2 years in the crypto space. So I would take that with a caveat, that general statement. I don't think the Web3 funds are in the same situation. I think a lot of funds raised a lot of money before everything collapsed and have a lot of dry powder and have kind of stopped investing when everything was overvalued.
Yeah, I mean, listen, I think I agree with some of that. I think broadly though, we are in some of the same situation that everybody is, and it's a venture problem, and it's less of a crypto problem, and there's very specific reasons that crypto is top of mind. But outside of AI, crypto funding venture funding is basically dried up, right? And this is true because people are worried about raising their next fund. They really want to extend their fund lives. They're thinking about what their marks are supposed to be. When am I supposed to be marking things down? How do I write those down? How do I have that conversation with the allocators and the LPs? And this is true in crypto and not crypto. And so we, to your point, have a unique part of the market where we're getting feedback quicker on our token investments, and they're going public, quote unquote, earlier, and we're getting price action because of that. But either way, we're all in this place where people are concerned about venture broadly with a rising interest rate environment and risk on assets being repriced appropriately. And so I think it's crypto venture and some of the reaction that's happened looks not that dissimilar from the rest of the market, at least from my perspective.
Yeah, I don't have a whole lot to add. I think that's true. What you're feeling is just VCs have customers, right? And their customers are their LPs. And the reality is, if you don't know where your next kind of your lunch is coming from, you're going to deploy more cautiously. You're going to think about where you do. Your behaviors will shift. So you might You mentioned markups. You might want to lean in to support an existing investment as opposed to swinging at a new bet. I think at the top of the cycle, you saw a lot more entrepreneurialism in VC. So you saw these kind of like emerging managers raise small funds really swiftly to have niche expertise. That bodes well for entrepreneurs that fit within that, right? If I'm raising for a really specific type of gaming fund or something, I think in this environment, when people are more cautious, they defer to those firms that they've seen do it many times over, and you just see a little less like new entrants into the space.
A flight to quality, so to speak.
TBD if size is quality. I think the irony is probably in anything, the higher AUM, higher capacity, your investment universe is constrained, and statistically that usually means worse returns. But I think it's defensible, right? So if you're a pension fund and you already have high exposure and you're going to write another VC check, it's in the same way it's easier to write, go for Blackstone's next fund if you're already in the others. You feel that you can take that to the board a lot easier than backing a first-time manager. Or a new strategy that you have no exposure to previously.
It's always easier to write a check into somebody you already know, that your investment committee already knows, that you already have a relationship with. And I think we've seen this where there are people who have an allocator who has maybe 6 managers in their portfolio who realize this space is not big enough for me to get actual alpha with 6 different managers. And so what do I need to do? I need to pare that down to who is actually quality, right, to your point.
For the sake of weighing in, I'll add a slightly more controversial view on why it is different in crypto, as opposed to the broader market, which I agree it follows many of the trends of. But in reality, crypto venture capital before 2016 didn't really exist, right? There were no funds who were set up with a dedicated strategy, at least on the venture side, so predating many of the crossover liquid strategies who were starting to allocate more to private markets and early stage token opportunities. If you do the math right, that means within a 7-year period, that is the extent and life of most of the venture funds. I assume all of us are in that bucket as well. And reality is most venture funds are structured on typically a 7 to 10-year period. So realistically, most VCs in this industry have not returned outside of specific distributions and dividends they've paid out along the way, have not actually returned the capital that was committed to them on day zero. And I think that's a very unique dynamic that we have, which is linked to the opportunity set of this sector, industry, movement, or whatever we want to call it, was certainly perceived as, and fundamentally believe it still remains to be, an outlier sector which will continue to grow at a faster rate than anything else. But the reality is that so much happened in such a short period of time that not many people have actually been able to show credibly track records of returning capital to LPs, and ultimately that's what matters to LPs. They want to see that money coming back. They want the track record of exits and dividends and distributions paid out, and frankly, there's not enough people in the industry who have literally had to come to that point where they're starting to exit positions.
I think there's the vintage that we're in, which is started in the dearth of 2018. I think there's a decent amount of funds that have DPI from that, but outside of that vintage, I agree with you. There's no DPI in the 2020, 21 funds.
Exactly.
The other difference I want to mention is really when you think about how the valuations of the Web2 investments are going to be impacted by interest rates, you have a unique opportunity to invest in protocols that are disconnected from DCF models, that have tokens that are not securities and are not going to be valued like securities. And so when you think about that, think about the opportunity in the next 5 years when interest rates are going to come down, but not as much as we've seen before.
You talked a little bit about exits. If you were you said backstage, if I were an LP, I'd be asking about the exits, but you don't really have to worry about that because you invest in tokens. So can you talk a little bit about that?
Well, I think, as Lior mentioned, a lot of the investors did not manage dynamically their exits. So when they got liquidity from a token launch, they just held on to the tokens without taking risk off the table. And sometimes, even if you come very early, you're not going to make the multiples that you're expected. So I think if you're investing in tokens, you really need to think about that and about opportunities to stake the tokens that you have and get additional returns. I think for the exits in the pure Web3 equity projects like DAO tooling or developer tools or things like that, the exit are going to be really difficult. We see a lot of applications that are being built. Also, that's going to be difficult. I think the easiest exits we see in the space are really the financial infrastructure, the custody, the exchanges, all that, which is more attuned to traditional business models.
Anything to talk about exits?
Yeah, I think through this cycle, I think this space will mature out of it. And I mean that from the investor mindset, that you do have to ask, and LPs are asking you, where are their exits kind of that are nesting or like, what is it called, kind of, ripening in this portfolio. And you start to see that for some of them, I think especially because of crypto, there are companies that it's a lot harder to see that pathway, because either there's a regulatory issue that feels like it would preclude a public listing. There's not a natural acquirer. You have a lot of stuff that started as open source, right, where there's IP issues around an acquirer. And so you sort of step back and you think, do we have so many in the hopper, or how do we help them find that path to? And I guess it's probably dividends, right? It's that you hope that in a strong market, they become a profitable business and they return capital in that way. But it's certainly just something, like when we even look at deals now, I find in a way I was never doing years ago, saying that another criteria has to be really what is the path to any liquidity on this. And if you're making a bet and you're saying something like, well, at the top last time, their competitor could have sold, then you have to ask, what is it about this team that makes us think they would seize timing, right? What makes us think when so many others have failed? And to Vanessa's point, in the same way as investors holding on kind of held on at the helm, right? Had hubris and said the next valuation, higher, higher. So you're adding more probability into the equation, and you need to be aware of that as an investor. It's not just is it a good idea? It's sort of, how would you get cash out?
Yeah, I mean, crypto VCs have historically been quite bad about thinking about liquidity and exit. And I think that's in part because, there's a lot of hubris, especially when a lot of crypto VCs were, actually coming in and getting established. But I do believe that part of it has also been there's like an incentive structure misalignment that happened, especially when there was this idea that I do an early stage deal, I get token liquidity, and I trade out of it. And now VCs who are typically partnering with early stage companies and they're helping them build and they're helping them recruit talent and they want to see them over the long run are saying, hey, I did your round a year ago and now the market's run up and now I'm going to trade out of your position, and treating it more like a hedge fund than a VC. And that's created a little bit of a push-pull that when times were good was fine, but now you need to be more thoughtful about, and the projects and the companies themselves are thinking, who do I actually want to be part of my cap table, or I want to have a long-term partnership with? And we're starting to see a lot of the protocols themselves, by the way, who maybe had tokens originally, maybe splitting the equity and the token from a foundation versus a kind of labs corp or something, or raising even though they are a application and a DApp and they have a token and governance token and all that, are actually raising into an equity company now, because they are trying to be more thoughtful around incentive alignment, which I think has been something that we've all still been figuring out as an industry over the last couple of years.
You mentioned hubris. How can you compare this cycle versus maybe previous cycles in the past? Because like you said, this industry is so young, and it's been mostly bull run for the past few years. So
I think the previous cycles all happened in a zero interest rate market. So it's really interesting. We've had 15 years of bull for everyone. And so I think it's the first time when, the narrative that crypto is a hedge and everyone's going to fly to crypto when interest rates go up. We see that's not the case. Everyone is risk off. So, investors are just risk off. And so we need to figure out what's different and what we can bring to the table that's different from traditional tech. Or other open source projects. I think it's a great time to test the next cycle of halving, and see if that was true. That holds true in high inflation markets. I think, having gone through the previous crypto winters, this is night and day. We have, billions and billions that have been poured into projects, infrastructure, protocols, hundreds of thousands of developers working on these projects, and a true aspiration. Now, we've seen the attention shift a little bit to AI, but we've seen that people understand, institutions understand that this is going to be the next version of the financial infrastructure. Enterprises understand that is the next version of how they're going to interact with their clients and incentivize them to come to their brands. So I'm very positive at what's going to come in the next 10 years. I was just in New York and speaking to a lot of institutions who are not saying much, but I think they're well prepared for the ETF launches and other trading and other tokenization perspective. By the way, RWAs and tokenizations always come back during crypto winter. Like, we don't know what to do, or we're going to do tokenization. So, but I think this year around, the institutions are ready.
So I just quickly weigh in on this, because I think it's a common misconception, and there is a lot of reasons for us to be pessimistic about the outlook at the moment and the state of the industry. I think the reality is people have had a lot more to lose in this last cycle, right? Fund sizes were bigger, wealth that was created was larger, and therefore when you feel the dips and you see the losses on paper and in your pocket, it feels very different. But if we actually look at many of the landmines, let's say, that have happened over the history of this industry, I mean, the price correction that happened post Mt. Gox and things along the way, prior, again, if we go back before 2017, for us to only have been down, and talking, let's say, BTC ETH, for things to have only come down 50%, let's say, post what we saw in 2022 last year, which was a whirlwind and multiple level catastrophe in literally every aspect of this industry, speaks a lot to the strength and resilience of this industry and the community behind it and people's belief in it. And yes, of course, every winter's different, and I agree, we keep coming back to RWA and real-world asset tokenizations, always sexy in a bear market, but things are not that bad. And I think we need to recognize that the level of sophistication and market participants has actually come a long way, and that's a very positive thing for the long-term trajectory of this industry.
Yeah, and I think separate from prices being resilient, another reason to be optimistic would be when capital is too cheap, you just have a distortion in markets, as in you fund things that don't have a right to exist, right, in a normal environment. And that should tell you that when the competition for capital is more fierce, right, in the same way equity markets still play out, you have more of a balance, a swing back to value, you should see projects normalize, right? Capital should go to better things, and that should also elucidate what really has legs, right, as a business, as a use case in the space, and what doesn't, right? And I think we're starting to see that where, okay, things that are more sensible get funded at the right prices, and that's usually a good thing for actual development.
Well, that's a great segue then. So where's all the money going, and what are the really exciting, innovative projects? I know before we came down here, we talked a little bit about Asia and how exciting that region is. Rob and Lior, especially, talk about that a little bit.
Yeah, I can start. Where's the money going? Listen, I think there's basically two different markets right now, right? So there are, the very crypto native group of, investors who have been around the space for a long time that are constantly looking for what is, the next tech innovation, right? So we see a lot of that, focus and mind share happening in things like, different types of cryptography. We see it happening in zero knowledge. We see it happening in things like decentralized sequencers and, this technology infrastructure that people see as maybe enabling a kind of new paradigm within crypto and outside of that. You then have, who are the very, traditional financial savvy people who have entered the space or are doing this kind of part-time as part of a broader mandate. And things like RWA are, top of mind. I'm old enough to remember when Blythe Masters on the front of Fortune, I believe it was, and said blockchain, not Bitcoin in 2015. That seems to be a conversation I'm having again with these large institutions. We see it in, and in stuff that's easier for people to understand. So trading infrastructure that's like more regulated and pulls apart, the brokerage and the exchange model and the clearing model, wallets, things like that. But I do think there's also, the geographic point, which is Asia versus the West. And the West is definitely very institutional access, institutional infrastructure focused, and there are a lot of people spending time on that. And the East is the only place where you see, at least in my perspective, people excited about consumer applications, right? And part of that's because in the East, they view trading and gambling and gaming as kind of the same thing, and people do it interchangeably, and it's all fun. But it's a very different mindset, the approach there, and it's a very different way to invest in types of things that are seeing traction there than there is in the West, where it's all kind of institutional infrastructure. But I don't know if you...
Yeah, no, fully agree. And just, to provide some context and color to that from the Spartan side. So we have 2 dedicated venture funds. One's focused on DeFi, basically trustless networks for the financial infrastructure, which I think is, second nature to anyone in this industry and what we're trying to do and achieve. And the second is gaming, right? And I think that the whole thesis around why gaming is important and why there is an appetite for things beyond just the financial fabric itself is because at some point, we need applications and reasons to be using this fabric that we've all been creating. And the term infrastructure in this industry gets thrown around endlessly. It's exciting. It's a great way for people to not be able to price things and see limitless upside potential on your investments. And very much excited about that as well, because fundamentally believe that this is the infrastructure and fabric of the future of all rails that we work with and transfer value on. But at some point, people need to engage in that. And the way we engage in these things is far more sophisticated than just myself as a retail consumer buying and spending money and transferring assets. I do a lot more things with my time. There's a lot more ways to engage in that. And I think where the industry has struggled to date, even some of the original projects like Brave Browser, for example, been around for a long time. A lot of these applications have just never really gotten the full momentum and community support to actually compete with a Google Chrome or be better than that. There's a lot of people who are deeply passionate about this space, but still have never actually used a Brave browser, for example. And I think those applications need to come from second nature. And what I see in Asia is exactly this, let's say, dichotomy between the two is, on one hand, there are applications being built which are non-crypto native and inherent in themselves. And then the other side, which is, again, let's say the non-regulated side of financial markets, as you've said. And then there's a lot of people in the West, and especially Europe and more regulated oriented places, which are still focused very much on the infrastructure level. How can we do these things in a compliant way, which looks a lot like just replicating the old world, which, frankly, how exciting is that? I have my questions and reservations around that too.
So
what's exciting?
I think you need to look at where value capture is. So it's either in deep tech, either on the consumer and end user side, right? So these are the 2 things. And so on the deep tech, it's the protocols, the infrastructure, the ZK, very exciting. I think everyone should just be spending their time there, as I do. But I think that's where we see the innovation right now, and that's where we see an innovation that can be monetized, unlike what happened with Web 2. And so I think spending time on the infrastructure, on the oracles, on the protocols, and we've seen a shift towards the EVM infrastructure, especially after the Luna and FTX collapse, because where are all the developers? Where are all the transactions? Where are all the exchange of value? They're on EVM chains right now. And so we've seen a concentration and the confirmation of Ethereum as the global settlement layer. And so a lot of innovation is going to come from that space. I think on the end consumer applications, I think if you're trying to build Web 2 equivalent consumer applications on a Web 3 stack, we're not there yet. However, if you want to build like financial infrastructure for the existing incumbents to come in, to have custody, to have the crypto rails, And if you think of, I think that's also very interesting. If you think of payment, what are we going to squeeze out of the fintech payment space right now? The only innovation they could have is crypto rails and crypto innovation to make it more efficient. So I think there's tons of opportunities, but there's different ways of seeing where the value is going to be in the short term, medium term, and long term.
I'm surprised you say payments when we were talking about exciting things. Like, can't really think of anything more boring than payments.
PayPal, who's creating a stablecoin on Ethereum. And then the other thing, which I think is different, I'll come back to your previous question, what is different from the previous crypto winter? I think open source won. I mean, this enterprise chains, et cetera, they're just not getting traction. And so when you see a PayPal launching a stablecoin on Ethereum, you understand that open source has won. And in the future, everyone will tag their applications and their infrastructure on open source software, like it has done on the Web 2 stack.
Sam, what are you excited about?
Yeah, I'm just thinking about kind of the infrastructure application discussion here. I think, sometimes when VCs try to defend their contribution to this world, they'll say, well, we fund innovation and we fill a gap the government can. And I think I do feel now there's that trade-off here. Like, there's more liquidity because a lot of this infrastructure stuff has the tokens, I guess. And I'd say cynically, it frees investors like us from making a real bet on adoption in a space with a use case. When you can say something like, I back, and I did this for many years, like I still, you see, I back the plumbing. Like, I'm not making a bet, but however it goes, I'm in the plumbing, right? And it's like, take some balls to actually, like this guy, I guess, saying I'm going in for this game, right? Not like one of the 5 infrastructures for the games. And so I do feel like that we have that, if the next cycle is not just the same speculative, there has to be more that have the gumption to back a real application. And probably that means founders that look different, right? It probably means less a guy who says, I want to do another layer 1 because I also worked with the team at Facebook and my 2 other colleagues did one, so I should too. It's going and finding a guy who's a domain expert, right? Who's like, I'm in biotech and I'm really pissed off that I can't share my trial results with the guy at Pfizer, I don't know. And going to him and saying, do you have a playbook for how this technology can help, if you believe in it? And so I hope that the next cycle looks different in that way.
To that point, though, I do think the cycle has changed a little bit, and this is kind of an offshoot, but what I have seen anyway is in 2021, and I think we were talking about this a little bit earlier, but how there's a lot of club deals, and everybody's like just getting into everything together, and we're like the whole market's going up, and we're all going to be we're all going to do well, and et cetera. And what I've seen this year that has changed is people are saying, okay, where am I going to make a concentrated bet, and I'm going to actually act like a VC acts typically outside of crypto, and that's actually the change I've seen from at least the most successful, to the point about have and have-nots earlier. People in the space, and I think it kind of reiterates your point.
We have a question from the audience about altcoins. So, considering increased circulating supplies, particularly due to VC vesting, do you think smaller altcoins can rise again, or will token inflation prevent this? Vanessa.
I think each token has its own token economics, and some get it right, some don't get it right. I think we won't see a lot of the altcoins recover as much as the blue chips at this stage, because if they don't have traction, if they don't have their token economics right, I don't think they will be able to rise as much as they did before. But there are some cycles in the investment, so the blue chips rise and then the altcoins come in. So it really depends on your risk appetite, and if you think that that it's going to rise to where it was, but I'm not sure.
I'll add, I mean, my 2 cents on this and what I think the challenge in the industry, my answer to this would be it depends on what time frame you're looking at, frankly. The challenge that we have is a lot of the projects, especially in 2021, who have raised significant amounts of money, they raised at a, let's say, healthy valuation that was effectively priced into what they were doing, and that's where their books are marked. Realistically, the price they paid for that token is not the price that this thing gets listed at, assuming that happens within the 4 to 5 year vesting schedule, because what you've bought in 2021 was a locked token for that period of time. So you've paid actually a much higher price for that token. And when people start looking at what the price gets listed at and where it's trading at, it becomes a very difficult thing to reconcile, because you're seeing this thing trade, to be honest, this year, 80% down from where it started, and you're still holding a locked position on that token, which means you're more than 80% in the red on what you're holding. It's a very difficult thing to reconcile. So I think the reality is the industry will become a lot more sophisticated and adapt to those realities, which sounds so intuitive now. In hindsight's always 20/20 and very clear to everyone, and maybe we got carried away at that period of time with some of the valuations. But I do believe in the notion and concept of aligning incentives between token holders, be it VCs, professional investors, and members of your community and ecosystem, and contributing to that structure of a long-term success of a project. And that's what this whole movement and space is about, is aligning those interests. So I do think over time, the price action will correspond to the right incentive structures. I just don't think that we got that right in the last few years.
We're out of time. Any closing remarks that I didn't ask?
No, just want to share that it's still a very exciting industry, and I hope that everyone here is convinced of that, and that the future will be an exciting one.
Yeah, I mean, I think there's no doubt, to your point earlier, that this feels very different than the last time everybody was concerned about where crypto was going. And I think both from an innovator's perspective and a capital allocator's perspective, we still, I'm very encouraged by where we are today, even within the broader macroeconomic and price action.
Is that because of the institutional interest from this time versus last time, or more?
I think it's in large part because of that. Because there's not, when 2018, when Bitcoin went from 19 to 3, I think, I was still working at a large traditional financial institution at the time, but we had been talking about crypto for our clients, and everyone said, they wiped their hands and they said, that was fun, we're going to go home, let's get back to our real jobs. And that is not happening now. And people are positioning themselves for what they believe is, essentially a new paradigm of open source software, which is what crypto is.
Yeah, and also the regulators, as you've noticed, are paying attention. So why would they pay attention to this, multi-small billion-dollar industry if there was not a real change that's being brought to the financial system, to the way we interact with value, et cetera? I mean, it's not a threat to the existing system. It's going to help the existing system be more efficient and bring more value to people. Yeah.
Thanks for joining.
Thank you.
Thank you very much.
All right, well, that concludes today's agenda and the CCData Digital Asset Summit. I'd like to say thank you to everyone for coming and listening today. I think despite the market conditions being very bearish, there's a lot to be excited about and reassured about in terms of progress from on the structured product side to the regulation side to institutional adoption through tokenization. I started off by saying that all of those elements would be covered today, and it's safe to say all of our panelists delivered on that. We are now going to have a party in the exhibition area, which is kindly sponsored by Copper and LTP. If any of you have ever been to a Copper event before, you'll know that they know how to throw a good party. So thank you all for coming, and I will see you all at the bar. Thank you very much.